It was not designed that way. And if you continue to rely on said squiggly lines, such as EMAs, MACD, SMA, if you continue to rely on these things, you will not be successful. You will not be successful on the charts. You have to understand that the charts can only go one of two ways, up or down. Okay? The candlestick. I want you guys to understand that these candlesticks can only move in two directions, up or down. And everything is based off of levels. Why do you think you see price reacting at the same area? For example, say you have market going in an uptrend, okay? And market found an area of resistance, okay? So an area of resistance is going to be an area where people decide to sell at, okay? So you're going to have sellers here. If price decides to come back up, price has a good chance to short at that same area, okay, of resistance. Since people sold there the first time, has a good chance to sell there the second time, okay? And then you're going to have areas of support. And these are going to indicate buying zones, okay? And even if it doesn't congruently happen like this, a setup can commonly look like this. I call it the support mirror, resistance mirror, or the stack mode mirrors, okay? So you might see a setup that looks similar to price might come up in my rally past the resistance, you know, come back down and then mirror the resistance, you know? Very common. You have setups like this for a downtrend type of setup. And then for an uptrend type of setup, could definitely look like this. Price might bounce here. And then price might come back up and then validate it again. So even though it invalidated at this area here, it decided to come back up over here and then go in an upwards direction. Okay. So we have to understand the market is a vertical chart. You're looking at a vertical chart. That's why I do not want you guys to fall into the indicators traps. Okay. Now, there are going to be some pretty good indicators. Okay. Volume. Okay. A lot of people don't even know what volume is. What is volume? Volume is going to be the amount of orders placed at a specific area or time. So volume is the amount of orders placed at a specific area or time. That's going to be volume. So that's the term you always hear. So you want to be buying at key areas of support, okay, because it's going to have most of the volume there. You want to be selling at key areas of resistance because most of the volume is going to be there. Now, let me go ahead and give you guys some secret sauce here. Way more powerful than indicators. Okay, understand that sometimes in the market, resistance can be broken and turned into support. Okay, resistance can be broken and turned into support, and then price can bounce in an upwards direction. Just the same way, support can be broken and turned into resistance. Okay, so resistance can be broken and turned into support, and support can be broken and turned into resistance. Even if it doesn't happen this cleanly, it can happen something like this. And price might run through there, come back up, turn this resistance here into the support later on. Okay, go to the support area, support, say price decides to run under here, come above it, and then come up again. Boom. This area of support made this area of resistance created here. Okay. So I make it simple for you guys, man. I do not want you guys to be struggling. Okay. There's going to be times life is going to be hard. The charts are going to be hard. People are going to be doubting you. People are going to be hating you. And there's going to be times you might not even believe in yourself. And all that doubt has to be killed. Okay. And indicators equal doubt. If you have to rely on indicators to trade, then you can't be a profitable trader. Okay, if you can't just look at the chart and be like, okay, I see why price bounced here, 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 and here, then you cannot be a profitable or successful trader. You will continue to struggle. You will continue to go through hard times. Okay, and it's going to be very, very hard for you to elevate. And the indicators are what's holding you back. So I want you guys to do this. Okay, for a year, no indicators. Okay. No indicators. Just read the candlestick chart clearly. Read it raw. Read it raw. Okay. That's what I need you guys to do. So for a year, no indicators. And I want you guys to just go hard, man. Go hard. Put in 16, 20-hour study sessions. Live on these charts. Understand every single micro reaction. Understand why price bounced at every single area that it did. Understand why price sold off at every area that it did. We have to get the full congruent picture. We want to get to the next level and we're pushing harder than ever. We're not stopping for nothing. Okay, this is real therapy for me, guys. Just sitting here teaching you guys these charts. I'm so passionate about this. You know, I live for God and I live to just get people out of financial poverty. I don't want to see anyone struggling. I don't want to see you guys blowing up your accounts or committing suicide over the markets or just going through any financial hardships. I want you guys to be successful. I want you to get to the next level. And I want you to win. Okay? And I want you to win. And best way to win on the charts, okay, is you have to have your setup. Okay? Follow your heart. Okay? If God put it in you to trade, trade. Don't let anyone stop you. Don't let anyone stop you. You have to trade. Okay. Whatever's inside of your heart, you got to go with that. You got to do that. It's going to be times you're going to be feeling doubt. It's going to be times you're going to feel like, oh, it's not for me. I don't know. But God put it inside of you for a reason. So go hard. Okay. Follow your heart and follow your setup. Okay. If you tell yourself, I'm only going to play break and retest. Okay. If you're a break and retest trader, why are you trading anything else other than break and retest? Why? If you're a mirror trader, okay, someone who trades resistance or support mirrors, okay, why are you playing anything else other than mirrors? You need to, if you're a trend line trader, okay, why are you playing anything else other than the trend lines? Okay. That's the things. You have to follow your heart and follow your setup. And most importantly, follow God. Okay. You can get successful. Investing, it's important in this world. Okay. The more shares that we buy, the more companies that we can help, the more that we can help each other on this earth. Okay. Faster healthcare products, more communication so we can communicate with our parents, grandparents around the world, etc. Okay. Investing in the stock market is crucial. It's important. And don't let anyone else stop you guys from doing it. I'm very, very passionate about teaching this. And if you want to learn more about it, and if you want to get a free stock watch list, I should see you at stackmode.net. Stay prayed up to God. Keep grinding. Catch you in the next one. Peace.
Inflation is back, and it's eating your savings alive. A dollar today buys less than it did yesterday. Government prints trillions. Central banks scramble. And everyday people, They're looking for an escape hatch. Enter Bitcoin, the digital gold, the inflation killer, or so the story goes. But is it really a hedge? When inflation spikes, does Bitcoin protect your wealth or just add more chaos to the fire? Tonight, we rip open the data, the history, and the hard truths. No hype, no slogans, just the numbers and what they mean for your money. This is the showdown you can't afford to miss. Let's find out who wins, and let's see if Bitcoin is a real hedge against inflation. Inshallah, if God wills. Okay, so let's go and let's talk about inflation versus crypto. And let's answer the question, is Bitcoin a real hedge against inflation? And this is going to be an online, in-depth analysis. Let's get into it. So what is inflation in the first place? Inflation is going to be the sustained increase in the general price level of goods and services in an economy over a period of time. And the key effect, okay, it erodes purchasing power. Simply put, your money buys you less than it did before, meaning that it's going to cost you more money for certain things than it did within the past. That's because sometimes the dollar loses value. Okay, so this is why people invest in things such as diamond, gold, and now we have things like Bitcoin, which is going to be a representative of kind of like a online version of gold. Okay, we don't completely know how much gold is available. We don't know how many diamonds are available either, but we do know how much Bitcoin is going to be available. And Bitcoin has a cap of around 21 million of it. Okay, so you know how much of it is going to be left available to buy, and the scarcity is already going to be implemented and set in stone, unlike certain other things like gold or diamonds. So, for example, let's talk about some inflation, right? The power of your money. So in 1990, right, a cup of coffee cost $1. So that means a $20 bill will buy you 20 coffees, okay? And in 2024, the same coffee will cost you $3.50, meaning that a $20 bill would now only buy you 5 coffees. Significant difference, okay? It might seem like a slight increase, going from $1 to $1.50, but it's actually a big increase over time, especially when it comes to real estate, apartments, houses, etc. You know, rent, mortgage, and stuff. Back in the day, houses were a lot cheaper. Now things are a lot more expensive, a lot more lucrative, and just changing in certain ways. So the main causes of inflation, right? So inflation comes from multiple factors. One, it comes from the fiat currency, and the fiat currency is going to be whatever government that you're involved with. Say you live in Thailand, then you're going to be working with the baht. Okay. If you're in China, then you're working with China's currency. If you're in the US, you're going to be working with the US dollar, etc. That's what fiat currency is, your country's currency. So inflation comes from demand pull inflation. So too much money chasing too few goods. This happens when strong consumer demand outpaces the economy's ability to produce goods and services. Okay. And cost push inflation. Production costs rise. This occurs when the cost of raw materials, oil, or wages increase, forcing companies to raise their prices to protect margins. And built-in monetary, okay, expectations and money supply. So workers expect higher prices and demand higher wages. It also includes rapid expansion of the money supply by central banks. Okay, so we're keeping certain things in context, okay? We know things can get expensive. We know things progress over time, but we have to understand why and how we can protect ourselves from this. Okay. Investing is going to be a strong way. When you're investing within the future, your dollar is going to be a lot more worth your while. Money is a tool to generate more income, whether you're investing in ads, buying stocks, crypto, etc. It's a tool to generate more income, and use it as such, not just to consume. So the problem, why we need a hedge, okay? It erodes savings. Okay, the value of cash saved in a bank decreases in real terms. A $10,000 savings account loses purchasing power every single year that inflation is high. Once again, this is why investing is going to be your good bread and butter in order to counter this stuff. Okay, and discourages investment. High uncertainty over future inflation can make businesses and individuals hesitant to commit to long-term projects and investments. Okay, because they're going to be worried about, well, are things going to just get more expensive? Are things just going to keep increasing over time in a way that I'm not going to be able to handle? Okay, so that's when inflation throws in the mix in. So it's really a question of, okay, what can we do to counter this? And once again, it's going to be invest, inshallah. So redistributes wealth. It disproportionately hurts those on fixed incomes, like retirees, for example. Okay, say someone's living off dividend income, okay, like an ETF. Crypto ETF, or even just profits, right? As things get more expensive, your dollar is worth less. Okay, that big giant trade that you hit, or your dividend income that's coming every month, is then going to be just worth less since the economy is just going in a different direction. Okay, so we have to come up with ways of how we can keep our income afloat and what we can invest in to keep the money cycle always flowing. Okay, so it creates uncertainty, makes long-term financial planning extremely difficult for families trying to save for college or retirement, buy houses, and for corporations planning new factories, for example, as well too. A lot of factors that go into this. Okay, so what is an inflation hedge? Okay, so let's talk about the definition, right? So an inflation hedge is an investment asset that is intended to protect against the decreased purchasing power of a currency that results from inflation. And how it works. So its value should in theory increase or at least remain stable during periods of high inflation, preserving one's real wealth. Okay. And some traditional examples, right? Gold. Okay. It's a physical asset with a long history of a store value where you can create jewelry with it. Okay. Create companies with it. Okay. Whether it's going to be a gold lending thing for something like that. Okay. Whatever you want to do. Okay. Horseshoes, whatever. Real estate. Okay, it's physical property, and the rent it generates tend to rise with inflation. That's why you're going to see your rent get higher and higher and higher sometimes in certain cases. Okay, and tips. Okay, Treasury inflation protected securities are bonds specifically designed to offset inflation in a lot of cases and scenarios. So let's talk about the argument for Bitcoin as a hedge, right? The digital gold thesis. So it's a finite supply amount of Bitcoin. Keep that in mind. So mathematical scarcity is going to be implemented. The Bitcoin protocol strictly limits the total supply to 21 million coins. Unlike fiat currency, which can be unlimited, central banks cannot simply print more Bitcoin to fund spending. As we know, Bitcoin is created by power, POWs, so it requires a very extensive and powerful computer with a good graphics card in order to mine the Bitcoin, which uses a lot of power, okay? And decentralization is going to be into place. No central control. And it operates on a global distributed network outside the control of any single government or financial institution, making it resistant to national monetary policy failures. Okay. And global accessibility. It's a borderless asset, so it can be traded anywhere through all countries at any time instantly. Very, very useful. And it can be accessed and transferred 24/7 across borders, acting as a potential escape from a rapidly devaluing national currency. And the argument against Bitcoin as a hedge, right? The risky asset thesis. Extreme volatility. A hedge is supposed to provide stability, and Bitcoin's price regularly fluctuates by 10% or more in a single day. This is the behavior of a speculative asset, not a stable store of value. And high correlation with stocks too. If you check out the Bitcoin chart, you look at the stock chart, very, very similar in a lot of ways. Okay. In recent years, Bitcoin has often behaved like a high-risk tech stock, a risk-on asset. When inflation fears spooked markets, Bitcoin often fell with the stock market, okay, failing its one job as a hedge. So sometimes it can mirror the stock market or the S&P 500 or NASDAQ a lot of times too. So, well, then the lack of long-term data. So Bitcoin is only about 15 years old, and gold has been a store of value for millennia, and there's no data on how Bitcoin behaves during a prolonged inflationary period, okay? And we've seen certain times like COVID in the past where it took significant dumps, but what changes a lot of things is the government getting involved. Now that the SEC and the government is able to have control and own Bitcoin in a manner where they can benefit as well too, I can see things going in a lot more positive direction, if God wills. So some head-to-head comparison, right? Let's talk about Bitcoin versus gold in the first place. So scarcity, right? Bitcoin, it's finite, okay? It's not infinite, it's finite, okay? It's finite. So that means that it's capped. There's going to be 21 million Bitcoin available. And gold, right? Gold is going to be physically scarce, okay? So some new discoveries come in as we explore more land within the earth and stuff like that too. But for the most part, gold is going to be scarce. And Bitcoin, right? Bitcoin's 15 years old. Gold, we've known of gold for like 5,000 plus years, okay? And the volatility of Bitcoin can be extremely high, which can be a very positive thing if you buy certain dips as well too. So not all negative. And the volatility of gold can be relatively low, but gold year after year seems to be going up in a very consistent uptrend. And storage, as far as holding gold, right? You can hold gold as well too. You can buy certain ETFs, buy certain shares, or buy the gold futures as well too. But you can, for the most part, buy physical bars, buy jewelry, buy Rolexes, any type of watches, chains, etc. as well too, can be melted for more gold. Okay. And Bitcoin's going to be held digitally, can be held on a USB stick or a cold wallet as well too, in case you don't want to hold any of your crypto on the internet. And portability is very, very high. You can put your crypto anywhere. You can spend your crypto on a card too. You don't even have to send it over to your bank account. You could just get a card, depending on your crypto broker, send your crypto and spend your crypto like that. And portability for gold, it's going to be pretty low. Okay, it's pretty heavy for a lot of the times, carrying all those gold bars, and you got to know where to sell it too. So Bitcoin's going to be online. You can use your online money anytime, anywhere, and really help you out. Inshallah, I know there's been times where my bank, for example, has been doing maintenance at the middle of the night, and I've really needed it, and I had to come in clutch and use some crypto. So thank God that was an option for me. Okay, so the primary use case for Bitcoin is going to be for speculation. Speculation within the trading environment means that you're betting on a certain direction. Okay, and for transferring, okay, for spending your money too. And for gold, right? You buying gold bars for store value, for jewelry, or if you're just in the industry in general. Okay. So here's a real world case study here. The 2021 to 2023 inflation surge, right? What happened? So from 2021 to 2022, inflation in the US and Europe surged to 40-year highs, driven by supply chain issues and stimulus. Okay. And what did Bitcoin do? After peaking in the late 2021, Bitcoin's price crashed by over 70% during 2022, precisely when inflation was at its worst. Now, granted, it's not the best example to look at this due to the fact that at this time, there was a lot of laws and regulations and stuff that hasn't been completely passed yet. So we got to keep that into manner and case too. Okay, so not everything was as proper as it should have been right at the time of all of this stuff was occurring. Okay, so keep that in mind. Okay, don't forget about that. So now the government has a lot more control over things. So things have changed. Okay, so conclusion. What is Bitcoin, right? A nuanced view of it. So it's not a reliable short-term hedge, for example, right now. So the data clearly shows that it's too volatile and too correlated with risk assets, like tech stocks, for example, and mirrors the NASDAQ to reliably protect purchasing power month to month. So it can't really fight against the stock market, but it is going to be a good source of value to have due to the fact that it's a finite resource. Stocks, for the most part, are going to be and an available resource in an abundance. Is pretty much who has like the most of it. But Bitcoin, there is a limited amount. And Bitcoin, and maybe a long-term store of value, right? The digital scarcity argument remains compelling. And once again, it gives you the ability to send money instantly across the world. That's a huge plus. You cannot do that with normal fiat currency. If you try to send a wire transfer to somebody in another country, it's going to be pretty difficult. But if you send it very crypto, it's instant, just like that. Very, very simple, very clean, very, very useful within the future. So over a 5 to 10 year horizon, it has outperformed fiat currency. And this is a growth and scarcity bet, not a classic inflation hedge. Okay, so keep that in mind. So some key takeaways from this class, right? Inflation. It's a persistent rise in price that erodes purchasing power, driven by demand, cost, and a monetary supply. And a hedge. It's meant to provide stability and protect value during inflationary times. Traditional examples include gold and real estate. And Bitcoin's pro argument is based on its finite supply of 21 million and decentralization, meaning that it's not controlled by a government body or entity. Okay, it's free for everyone to use, person to person, peer to peer transactions, making it a digital gold. And Bitcoin's con argument, right, is that it's extremely volatile in certain times and has high correlation with tech stocks, making it a speculative asset. And the verdict. Bitcoin has not yet proven to be a reliable inflation hedge, since once again it does mirror the economy, but we got to give it time as more laws and stuff like that get regulated and passed, especially in the short term. So it's better understood as a high risk, high growth asset class based on the concept of digital scarcity. Okay. So leave questions in the comments below. Stay prayed up to God, keep grinding, and head over to Stackmode.net for all trading mentorship. Peace. So if you've ever seen your portfolio down and noticed gas, groceries, etc. getting more expensive, what's the cause of everything? It's going to be inflation. It's the silent thief. And most people think that inflation just means prices go up, but it really means that your money is worth less and it's going down. The 7% inflation each year turns $100 that you own into just $93 of real buying power. even if your account balance haven't moved an inch. And when inflation spikes, the market reacts like a toddler with no nap. Growth stocks drop, companies can't hike prices fast enough, and profit margins get squeezed. And suddenly those charts are nothing but red candles heading in a downwards direction. But here's the part that nobody talks about. Inflation doesn't destroy every portfolio equally. It's about what you're invested in. Some assets actually thrive in the chaos. Commodities, real estate, energy plays, and even those boring dividend giants that simply pass rising costs straight to consumers. I'm going to go ahead and break down exactly what inflation is, and let's understand it, class, inshallah. So, the term inflation, you guys might have heard of it in school, around, you might have heard your parents talking about it, seen it on the news, etc. We're going to want to break down exactly how it causes other prices to go up, whether it be it on goods, etc., and how it affects stocks and stuff like that as well too, and how it can affect your portfolio. So, what is inflation in the first place? So, too much money and too few goods. So, in life, things work off of two things: supply versus demand. So that's how things become valuable. So if there's a lot more demand than supply, then that means that something is going to be valuable because people want whatever it is, which is why it's in demand, but there's not a lot of supply of it. Why? Because people are buying up all of it. Okay, so supply and demand are going to be the two factors that come into play when we're looking at inflation, or even just understanding how humans trade or an economies work in general. So too much money, but too few goods. Okay, so inflation is the rate at which purchasing power drops. It means that your dollar, so your US dollar, buys less today than it did yesterday. Okay, so whatever your fiat currency is, whether you're using the euro, US dollar, etc., inflation is the rate at which the purchasing power drops, meaning that your $100 might not buy you the same amount of goods as it did 10 years ago. Okay, so the demand pool. So everyone has cash and wants to buy the same limited items. Okay, so that's why prices go in an upward direction and cost pushes. So let's say materials, right, such as oil and wood, they get expensive. So companies raise prices in order to survive. And the result that comes out of play is that, let's say you'll need $1.05 today to buy what cost $1 last year. And then year after year after year, it keeps going up. So it might start off as $1.05 today, but then 5 years from now, that same item could be $2. Okay. So if you're buying an item for $2, what you did for $1 just a couple of years ago, okay, you're now paying double the price. Okay. So unless you doubled your income, then you have to be ready to, one, subside your income for certain scenarios too. So if goods are getting more expensive, but your income hasn't increased, you either got to A, increase your income, or learn how to rebudget your current income. Okay, that's just how inflation works. So for example, just to break it down, in 1950s, let's say a burger, right? Let's say it was 10 cents. Okay, and then today, 2025, 2024-ish, okay, let's say something's $8. That's happening because more dollars have been printed. The more dollars that get printed and created, the less valuable it becomes. Okay, the reason why diamonds, gold, or even take Bitcoin example, are going to be valuable resources is because they are limited. But take the dollar, all they have to do is go up to the printer and keep on clicking print, and dollars will continue to spawn. So yes, we need dollars in order for the economy to flourish and for us to barter at a successful rate. But if humans continue to lead by their flesh and think that printing more dollars will solve everything, then humans will continue to pay certain consequences, such as dealing with more mental stress for having higher real estate prices, higher grocery prices, higher gas prices, etc. So how do we measure inflation in the first place? We got to take a look at the economic news event results. So let's go and let's jump into it. So let's talk about CPI. CPI is going to stand for Consumer Price Index. So for example, let's take a hypothetical basket of goods: eggs, gas, rent, and clothes, right? The government is then going to check the price of the basket of assets that people need in order to see if it got heavier. Okay, so that's what the CPI report is going to measure. A lot of the times after the CPI report occurs, you'll see a substantial move within every single market, whether it be at the crypto markets or the stock market. Okay, and then we're going to have PPI. Okay, PPI is also going to be very important. PPI is going to stand for Producer Price Index, and it's inflation for factories. So for example, if it cost Apple more to make an iPhone, okay, then that means the PPI would be up, okay, and they will eventually charge you more okay, which means that the CPI, Consumer Price Index, would be up, okay? So if it costs Apple more to make an iPhone, the producer price index would be up. Why? Because Apple is the producer. Now, if they're charging us, the consumers, more, then the consumer price index, the CPI, would go in an upwards direction. Okay. So core inflation at the baked center of everything. So CPI minus food and energy, right? Consumer price index. So why? Because food and gas prices swing wildly. Okay. And the Fed prefers core to see the real trend. Okay. So looking at the core inflation of everything is really going to be a much better statistic to look at when it comes to how the economy is actually doing within the full broad picture. But looking at every single news event, such as the rate changes, etc., are really going to help you, give you a good measure of how the economy is standing up and a direction of which the market could potentially head to. All right, let's talk about the melting ice cube with everything. So cash is a liability. Okay, so cash is a liability. Okay, this is Stackmode Chris talking to you guys right now on some personal stuff. Okay, ignore the presentation for just a second. You guys should not be spending your cash. Okay, you need to be spending your cash to pay off credit. That way you're going to be able to get more credit and you're going to be able to spend that. Okay, you need to be investing all of your cash. Okay, you should not be spending your cash. Okay, you have to understand that it's a trap. Even when it comes to certain things like taxes, even if when you start touching M's, 6 figures, 5 figures, etc. Okay, if you just save your money and just sit on it and don't invest your money into something that's going to be bringing you into more income, okay, you're going to be getting destroyed on taxes. Why? Because you're just holding more still cash. You're not benefiting the economy and you'll get punished for that. Okay, so please, cash is a liability. The only reason you should use cash is to clear your credit and to build wealth. Don't hoard cash. Don't hoard cash in your walls. Don't hoard cash in your bank account. Okay, your checking account should be pretty much empty. Okay, because why aren't you invested in the assets? Okay, you should have your life together. You should have your credit card. Okay, you should be able to survive off of that. Okay, when it's time to pay off your credit card, take your assets. Okay, when you have your profit, take some off the top. Okay, and you're going to be able to pay off your credit card and keep that cycle and flow going, so your money is infinitely going to be flowing in a river. Okay, the moment you pause your money, okay, the moment struggle starts to seep in. So I'm telling you, keep your money flowing on a river at all times. So a lot of people think hoarding cash is the play. Okay, and I know I'm Stackmode Chris, but I'm telling you guys, if you're going to stack up into investments. Put your cash into investments. Don't just sit on your cash. Don't be having your money on just to put the money phone up to your ear and post on the gram. Oh, that's corny. Okay, put all your cash into straight assets. I don't care if you do real estate, Bitcoin, stocks, doesn't matter. Some of you dividend ETFs. Okay, so many different avenues, whatever you're comfortable with. But I'm telling you, if you want to help your family, even if you die right now, you still want to be making sure some money is being generated. But you can't do that if you just have 100,000 pause in your bank. Okay, but if you have 100,000 in an asset, your family could eat forever off of that. You have 100,000 parked in a dividend, your family could eat forever off that monthly income. But if you have 100,000 parked within a Chase account, Chase is just going to take that money and go trade with it themselves. Okay, so understand that cash is going to be a liability under every single scenario. Cash should be used to pay off credit and invest into assets. Don't get trapped. Okay, so let's say, for example, right, and this is why God says interest is haram in the first place. It's pretty much useless. Okay, so try to invest your money into things that are going to give you a positive equity for curve, because things like a 2% APY, APY stands for annual percentage yield. Okay, so trying to put your money into a account that gives you 2% per year, 3% per year, 4% per year, it's pretty much going to be all of the rest of your time. Especially when inflation comes into play, you have to learn how to increase your income. Especially if you're going to plant your income, at least plan it into something that's going to give you a much higher percentage yield at the end of the year. Okay, so any type of small percentage APY account, personally, I'm going to tell you, it's just not worth it, truthfully. Okay, so for example, let's say you had a saving account giving you 4% APY, right? And inflation is hitting at -6% each year. Okay, the real return is going to give you -2%. You're poor. Okay, you're poor in every scenario. So I'm telling you, keeping your cash inside of your bank account is a trap. I'm telling you in every single scenario. If you don't believe me, you can go look at your own economic data. But the fact that things only get more expensive means that you need to up your income. Okay, you need to up your income, and in order to do that, your cash needs to always be moving in the river. If you want to have your cash inside of the desert field, that can be you. But if you want to have an easy time in life, I really recommend you guys put your cash inside the river. You must invest in assets that grow faster than inflation to break even and to even see any type of profit for yourself, your kids, or your family. So get in your bag and use your cash, throw it into assets, don't keep it still. So let's talk about the Fed's brake pedal. So fighting fire with ice. So when inflation gets hot, the Federal Reserve raises interest rates, right? Which means borrowing gets more expensive, mortgages go up, credit cards start going up, okay? And spending starts slowing down. People start buying fewer houses and cars, which means that demand drops, okay? Prices start cooling down. And in the long run, if people aren't buying products, then these products that are created by companies that are listed as IPOs on the stock market would not be benefited from that. Okay, the more products that are being bought for a company means that higher earnings reports are going to go ahead and be reported for those companies. Better earnings reports, a lot of the chances it is for that company to keep breaking into new all-time highs repeatedly, causing it to go in an upwards direction. But if people aren't buying any items from these companies and people aren't being consumers, then the stock market could head within a downturn due to the fact that the money is not flowing in the ecosystem as rapidly as it should be. Okay, so as soon as consumerism slows down, then the stock market within the short term becomes affected by that. So let's talk about impact on tech versus value, right? So growth stocks, let's talk about tech. So a bad effect, right? So these companies promise money 10 years from now. So when inflation is high, money in the future is considered kind of worthless almost compared to money now. Okay, so investors sell tech. Okay, but then you're gonna have like value stocks. Okay, companies that sell certain boring things make cash now, so they perform better when rates rise because they have pricing power. Okay, so it really depends too. When certain economic data reports come out, certain stocks are going to get a lot more affected than others. Okay, take like a Build-A-Bear, for example. Okay, that's a very consistent stock that goes up year after year after year after year. Okay, and it's not really based off of the future value. Okay, it's just people going to the mall and building cute bears, couples, kids, etc. Okay, but tech stocks, they are focused and based off of intrinsic value due to the fact of what they do for the future and how they innovate the future. Okay, so not saying either one's going to be better than the other to invest in, but when it comes to certain periods of inflation, if no one has enough money to buy certain expensive pieces of technology, etc., then a lot of companies will suffer. But then companies who just sell certain things like food might progress during periods of inflation. So it really depends on what time period you're in, which is what's going to determine what batch of stocks are going to be performing the heaviest. So you might ask me, Chris, how do we avoid inflation? Okay, what do we do? So commodities, real estate, and things like Bitcoin are going to be a really, really good way in order to park your money due to the fact that these things are going to be worthwhile and useful a lot of the times. People are always going to need a house. Okay. The reason why people invest into Bitcoin is because it gives you borderless transactions. And especially now, as times start progressing a lot more, especially US Americans are more open to traveling to other countries. So instead of having to take their US dollar and put it through transfers, just being able to spend that Bitcoin all around the world gives us a lot better suitability as humans. And then we're going to have commodities. You know, you're going to have energy, gold, silver, copper, etc. Physical things that people are going to be able to buy. So let's break down what these all mean. So commodities, right? So commodities. So if the price of stuff is going up, then owning the companies that produce the stuff is going to be a direct hedge. Okay. So any type of gold mining companies, etc., especially, okay, because gold is going to be a asset that especially goes up when economy is in inflation. Okay, due to the fact that it's something that's going to always be useful and it's a limited resource. Okay, and let's talk about banks. So banks can charge higher interest rates on loans when the Fed raises rates, which potentially increases their profit margin. So be aware of that. Okay, and real estate. So rents tends to rise with inflation, and fixed rate debt gets inflated away. So your mortgage payment stays the same, but your income usually rises. Okay, so keep all of that in mind too. So pricing power is going to be the secret weapon for everything, honestly. So can they raise prices? So the ultimate stock market defense is holding companies that can pass costs to customers. So people buy iPhones even if they cost $50 more, right? Due to the fact that it has a high pricing power. Okay, or take a commodity product. Okay, if brand A raises the price of white t-shirts, then you would buy brand B, okay, giving it no pricing power. Okay, but when you're investing into certain companies that have exclusivity, okay, certain companies that only do what they do and puts a smile on many humans' faces, then even if inflation were to occur, a lot of people would just see that as an opportunity to buy as the market going downwards. Okay, so especially certain tech stocks too that still have a lot of future value and have a lot of expectations to change a lot of things in a lot of ways. You know, if they're going in a downwards direction, people are going to look at that more of an opportunity rather than, oh, the stock market is failing, etc. So the bottom line for everything, just wake up, pray to God, be a disciplined person. I want you guys to look in the mirror, feel confident, feel proud of yourself for what you got put up. Okay, feel proud of yourself knowing that you can handle your responsibilities, knowing that you can help your family if things come into play. Okay, don't let your cash melt and don't let it freeze in your bank account either. Okay, own productive assets. I don't care if it's real estate, crypto, shares, dividends, whatever. Find your bread and butter. And if you're struggling to see what you want to invest in, head over to stackmode.net. Stay prayed up to God, keep grinding, and I'll catch you guys in the next one. Peace. So let's go and let's talk about central bank digital currencies, also known as CBDCs. Now, don't confuse this with cryptocurrency because cryptocurrency is decentralized and doesn't have a ruler, and CBDCs are money ruled by the government. And think of this as a digital version of cash in your wallet, but with one massive difference: it's programmable. So that means that in theory, the issuer could track every single transaction you make, limit how much that you could save, or even decide what you're allowed to buy. And supporters claim that it is the upgrade our financial system needs to be faster and safer, but critics are calling it the end of the financial privacy embedded in us as humans forever. So we're looking at the future of convenience, or are we looking at the ultimate tool for our total control? Let's jump into it, inshallah. So what is a CBDC in the first place? CBDC stands for Central Bank Digital Currency. So imagine if the cash in your pocket turned into a computer code, but it was still worth exactly the same amount. That is the basic idea of a CBDC. And it's digital money issued directly by the country's central bank. Okay, it's not physical paper and it doesn't come in coins. It exists only on computers or digital wallets. And unlike some cryptocurrencies that change value wildly, a CBDC is meant to be as safe as a dollar bill. Okay, so think of it like virtual cryptocurrency just created and ran by the government instead of it being on the peer-to-peer decentralized network. Okay, so the government's pretty much creating a currency in order to combat cryptocurrency coming out and its whole decentralized features. Okay, so we'll talk about the benefits. Let's jump into what it is and let's continue. Physical cash versus the CBDC. So we already use credit cards and apps like Cash App, PayPal, Venmo. So how is this going to be any different than things like that? So the commercial bank money that works today. So when you swipe a card, your bank promises to pay the store, okay? And it's an IOU between the banks, okay? And the CBDC, it's a direct liability of the central bank, and it's like handing someone digital cash directly without a middleman bank needing to promise the payment, okay? And as far as the speed, so regular bank transfers can take days, especially on the weekends. And also, when it comes to wire transfers, things like direct deposit when you're getting paid, things like that work on a time-based schedule, whether it be your direct deposit hit at 6 a.m. Some people have direct deposits hit at 6 p.m. Okay. Some people don't have direct deposits that hit on weekends and have to wait for the following business day, such as a Monday or a Friday, etc. Okay. But with CBDCs, payments and bank transfers are going to be instant. Okay, so they're creating a base and a way for people to instantly send money without having to use outside apps. Okay, so sending money today is like sending an email that goes through 3 different servers before actually arriving. And it has to all get approved too. Okay, if you decide to send money via wire transfer, it could definitely bounce. Okay, and sending a CBDC is like handing whoever you need to instant money, okay, or instant $20 bill, but doing it over the internet instantly.
instead of sending the $20 bill via the mail, waiting for the bank to sign off on it, and then sending the $20 bill to the person you want it to go to. That's how traditional banks work. So CBDCs really save a lot of time, make things a lot quicker. Okay. And hopefully, inshallah, that'll bring a lot more control back into people's hands versus how we want to spend our money and when we need our money. So if CBDCs are out, what's the point of crypto, Chris? So if they're the same thing, and when they're not, and they both use digital technology, the real difference that comes in between them, okay? One is decentralized and one is not, okay? So they both use digital technology, okay? Sometimes the blockchain, but they're both different in the point of who controls it. Okay, so cryptocurrency, Bitcoin, Solana, your XRPs, Ethereum, all decentralized. And the term decentralized means that it's not controlled by a centralized network. Okay, when you decide to send Bitcoin to somebody, okay, it directly gets sent to their Bitcoin wallet. Okay, no ifs, ands, or buts. Okay, peer-to-peer transaction system, also known as the decentralized system. Okay, then you're going to have the CBDC side, okay, which is going to be controlled just like traditional banks by that centralized bank fiat currency system. Okay, but the price will be stable. Okay, so $1 will equals $1. It's not going to be fluctuating as much. And as far as privacy concerns between the two, crypto is often anonymous. Okay, you have to go into the blockchain in order to check certain transactions out, etc. But CBDCs allow the government to see the transactions in order to stop crime, any type of money laundering, or any type of fraudulent activities happening. Okay, so think of Bitcoin kind of like a digital gold that you own yourself. And CBDCs are going to be like digital dollars managed by the Federal Reserve. So one is for freedom and investment and speculative purposes, and the other is going to be for stability and spending. Okay, so one's purpose, okay, it's going to be for speculative, freedom, and investment reasons. And the other purpose is going to be for stability, spending, and sending your money how you want within your centralized bank, okay, when you want, without having to use any type of external apps that you may potentially have to get approved for, especially when you already have your bank. Let's head over to the next slide. So let's talk about the two types of CBDCs. Not all CBDCs are for regular people. Okay, there's going to be two main types. One, you're going to have the retail CBDC. Okay, so this is going to be just for the day-to-day person. It's used for buying coffee, clothes, paying bills, and it really just acts like cash in an app. Okay, and then you're going to have number two. Other side of it, you're going to have your wholesale CBDC. Okay, this is going to be for banks, and it helps huge banks send millions of dollars to each other instantly and safely, replacing the old slow systems. Okay, so retail is like the debit card in your wallet, and wholesale is like the armored truck that moves money between bank vaults. Okay, so really understanding the two different types of services and reasons why is going to help you make some future investment properties, especially when we start seeing banks implement CBDCs more and more due to the fact that they're trying to create some type of competitive edge against the whole cryptocurrency decentralized space. Okay, so why create a CBDC? Okay, governments aren't just building these for fun. Okay, one, it's for competition to create a space for them to still be profitable in the financial world, especially as cryptocurrency grows year after year after year after year, and people are starting to wake up to what's actually happening and how the currency works. Okay, and the efficiency of everything. So payments become instant and cheaper. So no more 3% credit card fees for shop owners, etc. And financial inclusion is going to come into play. So people who don't have bank accounts can still have a digital wallet on their phone to receive money safely. So that means you can still be able to do jobs and get paid exactly how you want. And in case you get declined by any app such as Cash App, Zelle, or anything like that, you're still going to be able to survive and pay your bills how you need to. And programmable money is what it is. So the government could send stimulus checks that expire if not spent, or can only be spent on food using CBDCs. Instead of having to get checks or use certain cards to spend money, CBDCs could be used to fund government programs to help out citizens. Okay, so during an emergency, the government could pretty much airdrop money directly to everyone's phone without having to mail paper checks and give everyone essentially
virtual card by using CBDCs. Okay, so we can start seeing things transfer away from traditional bank financial fiat currency system that we've been seeing for the past couple of decades into a whole new blockchain involved world. Okay, let's head over to the next slide. So let's talk about the risk and the concerns. So why are some people worried in the first place? So with great power comes great responsibility. Okay. So giving the government total control over digital money has risk. And it's going to be a privacy loss factor that comes into play. So cash is going to be private. Okay, if you buy a candy bar with a $5 bill, nobody knows where it came from even. With a CBDC, the issuer can technically trace every penny that you spend, which takes away people's privacy, which adds control back into people's lives. So if money is programmable, they could stop you from buying things. Okay, so that means that they could deny transactions, freeze certain things, just as a normal bank account can. But banks and credit unions have a little bit more separate control from just the straight up government centralized system directly. Okay, so cybersecurity reasons as well too. If the central system is hacked, the whole money system could freeze, or even if it goes down. So let's say a CBDC risk system is running on like a system like AWS. Okay, if AWS were to go ahead and shut down, that means people weren't going to be able to access their funds. Okay, so do you want convenience or privacy? Okay, both things are going to go ahead and have concerns, and a lot of factors are going to come into play. So deciding what you're using your money for and how you want to invest is going to change year after year after year. So make sure you guys are staying on top of things. And as far as compliance for even your own stores, even if you want to take CBDC currency, and we'll see how the things change over the next couple of years. So are CBDCs real yet? Answer is going to be yes. Okay, it's not just a theory. Many countries are already using and testing them. Okay, for the Bahamas example, using the sand dollar. So the Bahamas is the first country to launch a full CBDC. So people use it to pay across different islands using mobile phones. And then we got China. Okay, China using the digital yuan. And millions of people in China are already testing the ECNY. Okay, electronic CNY. Okay, it's just digital fiat currency for China to buy subway tickets, groceries, etc. And then we got US. We got the Project Hamilton. Okay, the Federal Reserve and MIT are researching how our digital dollar would work, but haven't launched one just yet. But the United States is working on things. Okay, so over 100 countries representing 95% of the world's GDP are currently exploring a CBDC. Okay, and this is going to be research done as of 2023, and we can start seeing a lot of things change, especially when it comes to government-funded projects, such as like food stamps, unemployment, or anything like that. Instead of people getting the money placed on certain cards or traditional bank account systems, a CBDC wallet could be used in order to have people spend money on that throughout the entire network. So monies came a long way. It came from seashells to gold coins, seasoning, to paper bills, and now we got plastic cards, and now we can just send money digitally with numbers on the screen with our phone. And CBDCs seem to be the next logical step in a digital world realistically. So as you grow up, you gotta understand how money works, you gotta be able to adapt, and you gotta be ready to change how your asset classes are being moved and how your money is growing, especially as things get more expensive over time. Your money has to be working for you. Okay, keep that logical perspective. If the world is going to get more expensive over time, that means that your money can never stop working, especially when we have to do things like use the bathroom, sleep, etc. You have to be getting money while you're doing that stuff. Okay, if you want to be competitive in this world, you got to be getting money at all times. In your sleep, while you're awake, while you're getting money, you should be getting money, and it should be that serious, inshallah. Okay, so CBDCs offer speed and safety, but we must come to terms with the fact that you're going to be losing respect of privacy, but you are going to be getting a lot of convenience as well too. Okay, no more long paperwork, waiting for cards and stuff like that. And a lot of that stuff can be frustrating. Okay, just instant funds that come on a wallet, and we'll really see how it plays out for the future. So stay prayed up to God, keep grinding, and head over to stackmode.net for all trading education. Catch you guys in the next one. Peace.
What's going on, class? Today we're going to be talking about the number one investing mistake that all beginners make. Let's jump into it. It's not about what you buy, it's about when you sell. And stop thinking that everything is quick and instantaneous. You're not going to get rich overnight. You're going to have to hold these positions for a long time in order to actually build your portfolio. So be ready to be in the game for decades and years. And if you think that market's a casino, or you think you're about to come in, get rich quick and get out, you're not gonna make it. I'm just gonna keep it simple like that. But if you're someone who's ready to wake up, pray, be disciplined, be consistent, and ready to get to the next level and improve each and every single day, then the sky's gonna be for you. Let's go. So 1, the emotional market timing. The belief that you can consistently buy at the lowest point and sell at the highest point. Not true, okay? Sometimes you're not always gonna catch the lowest of the lows. You're not gonna always be able to sell at the all-time highs. People obsessed with catching the ultimate tops and bottoms normally don't typically make money, okay? They'll go through a panic cycle. So buying high, for example, investing after a big market run up, say Bitcoin, for example, people like to consistently buy all-time highs. Once they start seeing Bitcoin being posted all over the internet and stuff like that, it's at all-time highs, then people want to go ahead and invest in. And then they're going to go ahead and get pulled back on due to the fact that instead of investing at a certain low and catching the sweep up, they just decided to buy all-time highs due to hype. So FOMO. FOMO is going to be the biggest mistake that certain people make when it comes to investing. Okay, being emotional and FOMO. FOMO stands for fear of missing out. Okay, so thinking that, oh, I'm not going to get money in this trade if I don't hop in right now. Like, relax. Most things go down just to come back up. Okay, understand that when market decides to go down, all it is people selling. People have gotten in from way from the beginning of the stocks opening or tokens opening. So people, of course, are going to take profit eventually as it goes up. Okay, and don't sell though. Okay, out of fear. Selling everything during a market crash or just a dip because the news tells you the sky is falling. Okay, you should have your stop losses in place, which is going to be an automatic order that's going to close your trade at specific areas in case your trade goes to an area you don't want it to. But otherwise, you can't just sell based off of just certain dips and stuff like that. Have a long-term vision, have a long-term plan. And a lot of you end up negative in P&L too, profit and loss at the end of the year due to the fact that you guys close your trades too early. If you don't give your trade room to breathe and really do its thing, you're going to consistently just keep selling for a loss over and over again, causing you to be unprofitable. And if you guys have noticed that, oh man, after market dipped down, a couple of days or weeks later, you'll notice that prices even past where it dipped from where it was high at before. Okay, so you have to realize that just by holding a little bit longer and being emotionally resilient through drawdowns, you could actually make a lot of money. And lock-in losses and missing inevitable recovery. Okay, so you're locking in losses every time you just decide to sell early. Every time you sell early outside of your plan or sell early thinking, oh man, I don't want to lose money, or you just see a little bit of drawdown, you sell early, you're locking in losses. You're not locking in gains at all. You're locking in losses. And that's not what we want to be doing. Okay. And make sure we're not chasing the hype. Okay. So when it comes to stock picking or crypto token picking, believe it, you can find the next Amazon or crypto based on a tip from a friend or social media may not be the most ideal answer. Make sure you guys are doing deep financial fundamental analysis. Make sure whatever you're investing in is profitable. Okay, this way other people are going to go ahead and invest into it as well too. Make sure it's having a future and make sure it's really making a way for people to have an easier time within life. Okay, because a lot of the times those companies and those tokens, what they're going to do is go ahead and put money in people's pockets since they're advancing the future. And putting 90% of your money into one risky asset can be really, really bad too. Make sure you guys diversify a little bit. I recommend you guys do between like 1 to 3 long-term plays. Okay, so even if you're a day trader, I recommend you guys still trade between 1 to 3 long-term trades. And the reality of it all, active traders consistently underperform the broad market index over the long term. So the devastating costs, missing the best days. So when market returns from 1980 to the 2020s, for example, the average return of the S&P 500, which is just the index of the top 500 United States companies, okay, just put into one big conglomerate called the S&P 500. You can decide to invest in that. And the average annual return of the S&P 500 is 10.7%. Okay, let's say investor A, for example, they didn't close, they held due drawdowns, they knew that market was going to fluctuate up and down, but eventually they know that the whole goal of the market, cryptocurrency or stock market, is for the price to go in an upwards direction. Because why? For the stock market, when people release an IPO, you have to understand that people are releasing the stock market in order for them to gain more funding for their company. Okay, so that's why we're buying shares to be participants of that. So they want their stock to go in an upwards direction. Same thing with crypto tokens. There's people putting in tons of work behind these projects and they want their crypto token to go up because I'm sure they have large reserve as well too. So investor B, let's say investor B missed the best 10 days, okay, and their annual return plummets to 4.9%. An investor C missed the best 30 days and their annual return drops to 1.5%. The best days usually follow the worst days. And if you're out the market, you miss the recovery. Okay, so the best days usually follow the worst days. So what that usually means is after market dips, okay, you want to go ahead and try and catch the sweep at the low and catch the sweep back up. Okay, even if you don't catch the most bottom entry, if you start seeing market make a nice sweep upwards, especially towards an area of resistance, say all-time highs, because market's goal is always going to be trying to break all-time highs. Whether it be stocks or crypto, market is always going to be trying to break all-time highs. So always know that. Put that into your logic. So the fact that you know it's always going to try to break all-time highs, any low, okay, that happens, especially after that, and market starts going in upwards direction, that'll be a great time to buy. And that's the best days. Okay, when you catch the best days and you're able to catch nice sweeps consistently, you're going to be able to make a large percentage gain back. Okay, and taxes as well too can come into play. Frequent selling means you're paying short-term capital gains tax, which is taxed at your higher ordinary income rate. Okay, so that's also why there's going to be something called long-term tax gains. So I recommend you guys have 2 portfolios. I recommend you guys have 1 account for day trading. Okay, and make sure you guys are doing your short-term capital gains tax calculations on there. And then I recommend you guys have 1 long-term portfolio. Okay, and then your long-term portfolio can go ahead and be used for holding your shares, okay, your ETF plays, exchange traded funds, or even your crypto plays, etc., for just some years. Okay. And trading fees. While many brokers are commission-free, hidden fees like fund expense ratios and bid-ask spread friction still erode small, frequent trades. So the cure: embrace automated indexing. So 1, dollar cost averaging is really going to help you out. Do your calculations, pay your rent, okay, get some groceries, pay your extra bills. After that, see what you have left over. Okay, what do you have left over? After that, I want you guys to take that dollar amount, right, and divide that by like 50%. Okay, whatever you have left over after rent, groceries, and bills, take that 50%, because the other 50% stuff might come up. You might need gas for your car, emergencies, I don't know, Uber, something like that. So you don't want to just invest everything. So take 50% of whatever you have left over, okay, or 60%, however much percent you guys are comfortable with, maybe 70, okay, and take over that percent of leftover, and then you can go ahead and invest that into the market. This way you guys take care of all your priorities. You're not going to be trading out of desperation. Okay, you have some money left over in case you want to get some food, you need an Uber, you need a bus ticket, you need some gas for your car, something happens. Okay, you guys have some money left over, and then the remainder of that you can go ahead and safely invest. So you can go ahead and buy the market as well too. You can use your funds to buy low cost stocks, or you can buy index ETFs, exchange traded funds that track broad market indexes like the S&P 500 or the total market, VTI. And diversification, it can remove single stock risk if you're wrong, especially when you're a new trader. ETFs can be a really good way, but single stocks are also going to be a fantastic way to make some profit too, to do your research and make sure you guys know what you're investing in. So patience, the compounding engine. Your primary job is to give your money time to work without interruption. So during year 1 to 10, your growth is going to be pretty slow. Okay, this is going to be when you're running up your money. Okay, you're taking it from like $100 to your first million. Okay, I say within the first 1 to 10 years, then 10 to 20 years, you should be able to take it from $1 million to 10 million, and then 20 years plus 10 million plus. Okay, but you guys can also shatter these time frame way quicker than what I'm saying here. But your growth might be slow at first. Your returns are mostly going to be from the money you personally contributed, and the discipline is going to be just compounding over time. Once year to 10 to 20 hits, okay, or even year 5, even year 3, growth is going to accelerate and returns start being driven by money and making more money, compounding. And this is when your long-term plays are really just going to be paying you guys. Even just 50K invested into certain ETFs will go ahead and pay you guys back. And years 20, it's your exponential phase. The interest earned vastly outweighs your new contributions. And time is going to be your largest contributor when it comes to investing in the market over the time like this. And the goal is not maximum return, but the maximum time in the market. Keep your account alive. The more you guys keep your account alive, and the more you guys focus on the trades that are key to keep your account alive, instead of focusing on the trades that are just going to make you profit all the time, the better you guys will be at keeping your account. And the better that you are at keeping your account, the more consistently you can make some profits, inshallah. Because as long as your account's alive, you can make some profits. So the winning mindset. Boring trading is beautiful trading. There's no such thing as boring trading, in my opinion. Did you stick to your logistical plan? Okay, I know when I stick to my break and reset strategy, I'm happy. Okay, I'm love withdrawing. Okay, I'm excited. I'm ready to come into the next trade, and I'm really just coming into the mindset of, okay, I'm ready to dominate. And automate everything. Set up automatic deposits if you can too, so you guys don't even have to think, or put yourself on an automatic schedule. Be like, you know what, every 2 weeks I'm gonna invest this. Every week I'm gonna invest this. Every percentage of my income I'm gonna invest this. And set up automatic deposits in investments and make saving the path of the least resistance. Okay. And diversify. Buy the market using low cost index funds. You can go ahead and own stocks as well too, and just do what you would like to do to go ahead and invest. Okay, make sure you guys are doing your research though, and think decades into the market. Even my day traders, think about reinvesting that profit into long-term plays. This way your money's gonna always be making you guys money, because there's gonna be a time where our brains aren't gonna work the way we won't need them to all the time. Our bodies aren't gonna work the way we need them to all the time. So let's grind now, let's stay down now. Let's invest into the markets, and our money will be making us money for the rest of our life, inshallah. And you can ignore daily market movements. Your money is planted for the long term, and don't dig up the seeds. And the best investment strategy is the one you can stick to. All right, stay prayed up to God. Keep grinding. I love you guys so much. You can head over to stackmode.net for all trading education. Catch you guys in the next one. Peace. Class, let's talk about crypto arbitrage trading, the pursuit of risk-free profit in digital markets. Welcome to the lecture. Welcome to Stackmode, and let's jump into it. So the essence of arbitrage. Arbitrage is fundamentally the practice of simultaneously buying and selling an asset in different markets to profit from a temporary difference in price. It's the closest thing to a risk-free profit and opportunity in finance. And in the cryptocurrency space, this occurs because the global market is highly fragmented, with hundreds of independent exchanges that are not perfectly synchronized their prices in real time. This creates transient imbalances within the cryptocurrency community. So arbitrage is not about predicting the future prices, right? That's going to be speculation. It's about capitalizing on the current now price discrepancies for the same asset at the exact same time. So why do discrepancies exist in cryptocurrency in the first place? So latency and speed. Network delays mean that a price change on one major exchange may take a few milliseconds to reflect on a smaller, slower exchange. And this tiny window is the opportunity that people use in order to capitalize on some profits. So let's talk about some regulatory and geographic factors. Differences in regulatory frameworks or capital controls in various countries can cause persistent price differences. The community premium is a classic example. And liquidity differences. Exchanges with low trading volume might have larger bid-ask spreads, leading to minor price offsets compared to high volume exchanges. And we'll talk about transfer fees and withdrawal delays. The cost and time associated with moving capital between exchanges also contribute to price gaps that need to be larger to be profitable. So the foundation, let's talk about simple exchange arbitrage. So the two exchange model. And this is the most straightforward form, involving just two exchanges and one asset. For example, Bitcoin, also known as BTC, BTC USD. The goal is to exploit a direct price difference. So step one, right? So this is how you do it. For example, you would buy low and simultaneously place a market order to buy one Bitcoin on exchange A, where the price would be $50,000, for example. And then step two, you would sell at high. At the exact same moment, you would place a market order to sell one Bitcoin on exchange B, where the price is $50,050. And result, a gross profit of $50, okay, and less trading fees and withdrawal costs. Okay, so the capital allocation challenge. For this strategy to work instantaneously, an arbitrage must have the capital prepositions on both exchanges. This is known as the capital risk or funding issue. So the required capital setup. You must have the fiat currency, for example, USD, okay, dollars, stable coins, etc., ready on exchange A to buy, and the asset, for example, let's say you're buying Bitcoin, ready on exchange B to sell. If you have to transfer the asset after buying, the price gap will likely close, and the opportunity will most likely vanish. And due to razor-thin margins, the speed required, this strategy is almost exclusively executed by automated trading bots that operate in milliseconds. So the advanced strategy, right? Triangular arbitrage. So the three-active cycle. Triangular arbitrage occurs on a single exchange and exploits inconsistent pricing between three different currency pairs, creating a closed-loop trade with a net profit. The core idea is that the implicit exchange rate calculated from two pairs does not match the exchange rate of the third pair. and the path. Example, using USD, Bitcoin, and Ethereum, and trade one to start it. Okay, so you would start by converting your crypto currency. Let's say, for example, let's say your starting currency would be USD to Bitcoin. Okay, so turn your fiat currency into cryptocurrency. Okay, so via the BTC USD pair. Okay, you could also turn your cryptocurrency into cash as well too, and do the same thing by whatever asset you want. Let's say you wanted to do Ethereum too. Okay, and the midpoint, you would convert the final asset, all right, or the first asset, that would be Bitcoin, to the second asset, for example, Ethereum, okay, via the ETH BTC pair. Okay, so you can use a cryptocurrency to swap it to different cryptocurrency pairs as well, or use your cash to do cryptocurrency, and that's by the pair that you want. And you convert the second asset, such as Ethereum, back to your starting currency, for your USD, via the Ethereum USD pair. So the margin requirement and the speed of this. For the trade to be profitable, the final USD amount must be greater than the initial USD amount after all three trades and associated fees are deducted. And why this is faster? Since all three transactions happen on the exchange, the trade can be processed much faster than moving assets between exchanges. And this makes it a primary focus for institutional high-frequency trading. Okay, which can be a good thing and a bad thing because that can bring about as well. And this strategy is highly dependent on sufficient liquidity for all three legs of the trade to ensure that the bot can execute its large volume orders without slippage, which is the change in price due to the order execution itself. So the frontier, right? DeFi arbitrage and flash loans. So let's talk about DeFi pools and dexes. Decentralized finance, which is DeFi arbitrage, involves capitalizing on price differences between different automated market makers, also known as AMMs, like Uniswap and SushiSwap, or between a DEX and a traditional central exchange, okay, also known as a CEX. And let's talk about the liquidity pool inefficiencies. Prices on DEXs are determined by the ratio of tokens in liquidity pool. And when a large trade happens on one DEX, the ratio shifts, creating a temporary price difference relative to other platforms. And there's going to be a gas war, right? So gas in the cryptocurrency world equals fees. So when you see the word gas, think of fees. So a gas war. A significant risk here is the cost of gas, right? The network transaction fees. And arbitrage. Bots must bid high gas fees to ensure the transaction is included in the next block faster than their competitors, okay? And nice writing here. And the game changer, right? Flash loans. So flash loans are a novel decentralized finance concept that allow a user to borrow any amount of uncollateralized assets, provided liquidity is available, so long as the funds are borrowed and repaid within the same blockchain transaction. So let's talk about some zero capital arbitrage. Flash loans enable an arbitrator to perform a large-scale arbitrage without needing any initial capital. The bot executes the buy low, sell high sequence, and then repays the loan plus a small fee, all in one automatic transaction, okay? And if the transaction fails for any reason, for example, it's part moved, the loan is automatically reverted, eliminating execution risk. So the automated lifecycle of an arbitrage trade. So opportunity scanning, right? We can go watch it. So the bot, right? Having a bot, especially as AI progresses and things like that, the bot continuously monitors real-time price feeds across dozens of exchanges, calculating the net profit after all fees for every possible pair or triangle. And it seeks a spread that's going to be wider than the combined cost of trading and transferring the funds. 2, trade evaluation and execution, the trigger. Once a qualifying spread is identified, the bot initiates the simultaneous execution. And for interchange arbitrage, this means sending API calls to both exchanges at the same moment. And the execution must be extremely fast to beat other bots. And let's talk about the settlement and rebalancing, right? The closer. So after the trade fails, the arbitrage now has an imbalance of assets. For example, more Bitcoin on exchange A or less on exchange B. And the final step is often transferring the net profit back to the seller account and rebalancing the capital for the next opportunity, which incurs more fees. So the necessity of automation for arbitrage, the bot stack. Manual arbitrage is essentially impossible in modern markets. An entire process relies on sophisticated low latency software, written primarily in languages like Python or C++, and the API integration. Bots communicate directly with exchange APIs, application programming interfaces, right? That's what API stands for, to retrieve real-time order book data and submit orders. This bypasses the slow web interface entirely. And collocation. Professional arbitrage often host their bots physically close to the exchange servers, known as collocation, and to shave precious milliseconds off their network latency. And high-frequency data. The bot must process tens of thousands of market data updates per second to stay. And algorithmic sophistication, the net profit calculation. A good bot doesn't just look at the price gap and must factor in variable market maker fees, taker fees, slippage estimates, and potential withdrawal transfer fees to calculate the true expected net profit before initiating trade to make sure that's worth it. And the competitive landscape is going to be fierce as more capital flows into arbitrage and the profit margins are driven closer and closer to zero. And this creates an arms race of technology and speed and execution efficiency. So, one, the execution risk, right? The closure. So this is the biggest threat. The arbitrage opportunity often disappears before the second leg of the trade is filled. If you buy low on exchange A, but the price on exchange B drops before your sell order executes, you are now holding the asset at a loss. This intended simultaneous nature of the trade hasn't failed. So two, slippage in the costs, right? Arbitrage profits are often less than 0.5%. If an exchange increases the trading fees or if a large order causes slippage, just filling at a worse than expected price, the small profit can instantly turn into a loss. And arbitrageurs must strictly track their trading tiers and fee schedules to make sure that the trade is going to be worth it before they put on some size. So, withdrawal and funding risk, right? The weight. For inter-exchange arbitrage, the capital needed to rebalance the accounts, right? So moving the final asset back to the original exchange can be tied for minutes or hours due to blockchain confirmation times or exchange enforced withdrawal limits. This is known as going to be opportunity cost. So, walking through a hypothetical Bitcoin trade, right? Let's say on exchange A, you bought low. Yeah, let's say the Bitcoin USD price, 60,000, you have 100K available, $100,000 available, USD, fiat currency. Now on exchange B, you would sell high. Okay, on exchange B, the Bitcoin USD price is 60,050. Okay, and you have one Bitcoin available. And for the fees and the spread, for the trading fee on the each side, right? So trading fee, 0.1%, and the gross spread would be $50, right? So the buy cost on A, be buying one Bitcoin for $6,000. Okay, take the trading fee times 0.001. Okay, so 60. Sell one Bitcoin for 60,050. Okay, and then same thing with the other trading fee. That'd be 60.05. Okay, 60.05 plus 60 is 120.05. Gross profit. Okay, and that's just going to be the total fees paid. Okay, so that's the calculations you do to get the fees, and then your gross profit would be $50. Okay, the gross profit minus the fees, then boom, you see the arbitrage fail due to fees, making the trade not worth it. So sometimes fees can destroy your profit. So keep it in mind about that. Even if you're a day trader, spamming trade and stuff like that, especially if you're losing, can increase your losses. And certain fees depend on certain brokers or exchanges. So check them out, depending on whatever you trade on. It's not going to be the same everywhere. And arbitrage is only profitable when the gross spread significantly outweighs the total cost, right? The fees and the slippage. The threshold must be met first. Okay. So the evolving landscape and the challenges ahead. So the market efficiency. The long-term impact of successful arbitrage is the increase of market efficiency. Arbitrageurs in the pursuit of profit automatically correct the price imbalances, forcing the market to converge on a single fair price. Okay. So reduce volatility. By buying low and selling high, arbitrage stabilizes prices and reduces unnecessary volatility caused by large temporary discrepancies. And fair pricing is involved. And ensures that retail traders, which means just non-bank traders, just individual traders pretty much, are less likely to buy or sell at an artificially poor price. And the competition and innovation. From HVT to MEV, the focus has shifted from simple inter-exchange arbitrage to complex, low latency strategies like miners plus maximal extractable value, right? MEV arbitrage on the blockchain networks. Blockchain is going to be the cryptocurrency network where people can go ahead and trade. Okay, it's going to go and check all the transactions and manage everything via smart contracts. Okay, so unlike a bank system where money goes from person to the bank where they confirm it, and then the person, cryptocurrency, happens to work on a person-to-person system, okay, making it one of the most dominant systems in order to send money or receive money. And as global crypto markets mature and become more interconnected, traditional arbitrage opportunities are shrinking, and success now requires cutting-edge technology, faster network access, and highly sophisticated risk management algorithms. And the race for speed continues to define who profits and who loses in the zero-sum game of crypto arbitrage. So, summary of arbitrage trading, right? Arbitrage is the simultaneous trading of an asset to exploit temporary price differences for risk-free profit. It's not speculation, but rather a corrective mechanism for market inefficiencies. If you have enough capital, then inshallah it'll be profitable. And types and methods. Okay, so we covered inter-exchange markets, right? That's the two markets, triangular, three pairs, okay, and one market. And DeFi, which stands for decentralized finance, using flash loans. And they're all highly dependent on extreme speed and technological automations. And the reality of risk. While theoretically it's risk-free, execution risk, high transaction fees, and slippage can easily eliminate the tiny profit margin, turning a potential gain into a guaranteed loss. And automation would be mandatory for success most of the time, inshallah. Okay, so I pray to God, keep grinding. If you want to learn how to trade cryptocurrency, head over to stackmode.net. Peace.
You might think that inflation is a normal part of life, but the reality is that your purchasing power is silently being stolen from you every single day by the very institutions claiming to protect it. Central banks have the power to print infinite amounts of currency at the push of a button, which dilutes your savings and forces you to work harder just to stay in the same place. They control the supply, so they control the value, and Bitcoin completely flips this power dynamic on its head. It's the only asset in human history with strictly finite supply that cannot be altered by any government or chairman. There is no backdoor and there is no print button because the code is absolute. And while fiat currency relies on trust in politicians, Bitcoin relies on mathematical verification, and it's created by actual power and resources. This is not just about digital currency or making a quick trade. This is about the separation of money and state and ownership. In this video, I'm going to show you exactly how Bitcoin renders the central banking model obsolete and why it's the ultimate hedge against the system designed to devalue your life's work. Let's dive into it. Let's go and let's jump into how central banks hold a monopoly on the money supply. So as you know, things have to be systematically processed when it comes to central banks' systematic formations, such as wire transfers or direct deposit, for instance. Certain things have to hit on certain days and certain time frames due to the fact that approvals have to be made by the centralized banks. Now, when we're trading cryptocurrency, you're working in the decentralized world. Everything is way different. Okay, everything is based off the peer-to-peer transaction system. Everything works off of smart, autonomous contracts. So whenever transactions are sent over, pretty much computers do all the processing. When you send a wire transfer over to somebody or even to yourself to another bank, the bank has the ability to approve or decline that. Cryptocurrency puts the freedom back in the people's hands. And let's go and let's jump into how all this works and why central banks really don't like this. So let's talk about the loss of monopoly. So central banks manage the economy by printing money, which is quantitative easing or pretty much restricting it. And Bitcoin supply is fixed at 21 million. So it having that fixed statistic baked into it, one, not only makes it more scarce, but it's going to have a more baseline stability cooked into it, and inflation is going to be a lot more manageable. When it comes to fiat currency, you can pretty much print infinite dollars nonstop. That's you might see things from 10 years ago might cost completely differently from today, since more money has been printed over the years have gone over. Okay, and the competitor. So for the first time, citizens now have a viable opt-out option. So if a central bank debases its currency due to inflation, people can flee to things like Bitcoin. And this forces central banks to be more disciplined, limiting their power. So you might have seen things recently as of 2025 when this video is coming out. Banks are now starting to incorporate certain things like Ethereum, XRP, and Bitcoin systems within their system, since they know that people are now looking towards cryptocurrency to manage their money or even hold their savings. So instead of getting 2% or 3% APY stands for annual percentage yield, People rather go put their money into a cryptocurrency and let their money grow faster at a rapid rate. And not only that, it's going to be a lot more manageable too. If you go to the bank, if you have 10 bands, you go pull up on the bank, a lot of the times you're not going to be able to pull that out right away. You might have to come back tomorrow, the next day, because the bank has your money pretty much invested. Okay, so if our money's parked in the bank, it's going to be their money too. It's being used. That's why certain things like Zelle have withdrawn deposit amounts, because they don't want people just pretty much managing their currency how they want. Cryptocurrency takes that all the way. If you want to send $1 million today and tomorrow, you can do that. With the normal traditional central bank based off of fiat currency, they're not going to let you do that, since that puts too much freedom in people's hands, and a lot of business moves can be made a lot quicker. So instead of the banks having the power, now people have the ability to build certain things like banks, their own hedge fund systems, and their own funds, etc. So now people have the ability to have some more individualization for their family even as well too, versus having to run to the banks every single time. So back in the day, people would have to keep all their cash in the banks for the most part. Okay, things aren't like that today. Now you have the ability to even keep your cryptocurrency on something small like a USB drive. Okay, so keeping it extremely decentralized, and the IRS can't get to your USB drive unless they raid your house and find it or things like that. Okay, so no more having random money put out of your account, or even if you get sued, for example, they can go into your bank accounts and clear you out. If you have your money parked in cryptocurrency, that's money that they can't touch, and it's pretty much digital cash that nobody really knows that exists. So let's talk about the threat of censorship resistance. The modern banking system is used as a tool for geopolitical control and surveillance. Big on surveillance. They want to see every dollar that's coming in and out. A lot of things have been changing recently too, since 2020 plus. As far as cash, for example, you can't really use cash to get certain things. Like a lot of realtors and realtor companies won't accept cash for certain down payments, since you can't really prove that you're a real legitimate person and where that money's actually coming from. Okay, so central banks want to make sure everything is controlled, and pretty much don't want you to have freedom for certain ways that benefit them every single time. Certain ways it does protect society, but for the most part, things aren't always fair and realistic, because it is the world. So if somebody's working hard at their lawn mowing business and they've been stacking up cash, okay, their money shouldn't be obsolete. So now you have things like cryptocurrency where you're going to be able to put that, send that over to your bank account, and then you could file your taxes and do things a little bit more legitimately there, versus just having random cash come out of thin air and then you deposit it and they're like, well, where's this coming from? Okay, so your cryptocurrency can be baked in and a little more hidden, and it'll help you out in a lot of ways too. And Bitcoin is really a neutral, permissionless network, and it helps you bypass sanctions. Systems like SWIFT allow the US to cut off nations or individuals from global finance. And Bitcoin operates on the peer-to-peer network, just like we talked about in the previous slide. Meaning if you want to send $1,000 to somebody in Africa, you can instantly do that within the next couple of minutes if you wanted to. Okay, if you want to do that via PayPal or the traditional bank system, it's going to be a lot more difficult. They're going to put some type of hold on it, have to verify your transaction, and it's going to be just a lot more difficult overall, making financial blockages significantly harder to enforce. And financial privacy is going to be a big factor as well too. So Bitcoin is going to be pseudo-anonymous. Central banks and governments prefer total visibility due to the fact that KYC laws are in place, know your customer, and AML, to track taxation for the most part. So pretty much just the government wants their piece of the pie when it comes to any type of currency. So a decentralized ledger obscures the identity layer that they rely on. So certain things like the SEC were fighting with Bitcoin legislators, etc., and that led to certain dips. But now the US government and other governments have started holding the currency themselves, and certain laws have been getting passed. So central banks are trying to gain control, but for the most part, Bitcoin at the core forefront of it is still peer-to-peer and a currency based off of freedom. So I jump into the neutralization of interest rates. Interest rates are going to be the steering wheel of the economy, and Bitcoin creates a parallel system that doesn't respond to that steering wheel. And the liquidity trap. When the Fed lowers the rates to stimulate the economy, they want people to spend pretty much. So if people instead borrow cheap fiat to buy Bitcoin, which is a store of value, since especially it has a limited cap, giving it scarcity, which is immediately going to give it value, the stimulus leaks out of the real economy and into crypto assets, because people are starting to wake up as well. And broker and transition mechanisms are going to come into place. If a significant portion of the economy uses Bitcoin for settlement, central bank decisions, which involves raising or lowering rates, affect fewer people, rendering the central bank increasingly irrelevant. So it's like trying to slow down a car by pressing the brakes, but the car has decoupled from the wheels. Okay. So Bitcoin's coming in to solve a lot of problems, especially now since people are starting to be more open to international travel too, and living in certain other countries, especially US citizens. And you're gonna, instead of have to go through certain transfers for your US currency, you can easily just keep everything in cryptocurrency and spend that all over the world simply, instead of having to go through that headache of a transfer system. And let's talk about CBDCs, the counter move, and what are they doing about it? So they're copying tech, but keeping the control, and enter the central bank digital currencies, and it's programmable money. So unlike Bitcoin, CBDCs are centralized, and governments could theoretically program money to expire, which forces spending, and restrict what you can buy with carbon limits or freeze accounts instantly. And definitely total surveillance is going to come into place too. So a CBDC ledger would give the state a real-time view of every single transaction in the economy, eliminating the concept of cash-like privacy entirely. And they market CBDCs as safe, convenient Bitcoin, but the reality is that it's the exact opposite of Bitcoin ethos of decentralization. So keeping the freedom in the people's hands is really the main point of crypto. Yes, there's money involved, but honestly, you can make way better profit doing other things, such as like trading futures, for example. Even if you trade crypto futures, that's gonna be way more profitable than holding and keeping spot. But as far as you holding your Bitcoin, your cryptocurrency, you're really doing it for your ownership and your assets. Okay, having ownership, especially in something that helps the future, is what's going to help you prepare your forward and keep your money in that constant cycle. So instead of you being on the hamster wheel, put your money on the hamster wheel. Have everything flow. Okay, so after you get that big bag from futures, let's say for example, you know to go ahead and throw it into Bitcoin, which consistently makes profit year after year after year after year. So instead of you having to hustle and bustle forever, you could maybe sit down and chill because you have enough money from hustling, bustling, stacked in your investments, and then your wheel will be spinning forever. Okay, so if you decide to use your fiat currency and throw it into something that's gonna help your money flow into the hamster wheel, inshallah, you'll have a lot easier time. So they try and stop everything, just like they try and stop certain herbs as well too. They can't stop the Bitcoin network itself since it's distributed globally, and they target the entry and exit points and targeting on ramps. So regulators pressure banks to not do business with crypto exchanges, even though they're starting to do it anyways, because they know people have to sign up for their banks, otherwise they're going to crumble. So if you can't transfer fiat to an exchange, it becomes very difficult to buy Bitcoin. And let's talk about some regulation by enforcement. So instead of creating clear laws, agencies like the SEC sue crypto projects to drain their resources and create uncertainty, driving innovation offshore. But thank God, it's been a lot of righteousness going on. Certain people have been getting freed from jail, such as like the Binance creator and Bybit and stuff like that has been starting to get back on the United States soil. So a couple of years ago, around 2022, 2021, they started locking people up for enforcing certain cryptos or creating certain crypto brokers such as Binance and stuff like that. Thank God certain people have been freed, and just really things have been changing, and the crypto future is starting to look bright, especially since the US government now owns hundreds of millions of dollars worth it. That's really, really a solid and good factor, letting us know that, okay, the US doesn't want to fall behind since other countries also own hundreds of millions of dollars worth it too. Okay, so instead of being stubborn, the US is now actually turning on their brain, and that's leading crypto to future all-time highs, since the US dollar is the global currency of the world. But we never know. Within a couple of decades, could be Bitcoin. So a lot of things are changing, exciting time in the world, and central banks are pretty much on a game theory vibe. They can't end Bitcoin. The network is way too resilient and distributed, so they're pretty much trying to conform because they know people are starting to wake up. The righteousness is starting to oversee the darkness in the world for sure. People are starting to care about their health, want freedom for their money, and people might have family in other countries too. You can easily help out your family in other countries with cryptocurrency. Once again, not as easy to do that if you're sending straight fiat in any country you're in. And they can't ignore it. Okay, it's sucking liquidity out of the fiat system. People are no longer keeping their money stacked inside of savings accounts, getting that 2%, 3% APY that most banks take advantage of in order to make profit. People are now just taking that money and putting it right into cryptocurrency. Even the same thing with credit too. A lot of people are starting to wake up when it comes to credit. Instead of balling out, just buying things, people are now taking that, either they're investing it, all of it, into some kind of business and buying cryptocurrency, buying any type of shares that they can too with the cash that you can extract from the credit card if you can't extract the whole thing. So the likely outcome of everything, integration, and that's been slowly happening. A lot of banks are starting to finally realize, and as we start seeing more younger people get into CEO level positions, I can see things change as well too, inshallah, especially as Trump come into office. The crypto support has definitely been in significant rise. So banks will eventually have to custody Bitcoin and treat it as a reserve asset, just like gold, because they know people aren't going to be going for anything else. Okay, people are now more open to leaving the US more than ever. So now the US is very desperate to make the right decisions to keep people here and keep America going forward. So this fundamentally changes how the global monetary system operates in the long run. And a really small percentage of the world only owns Bitcoin. So don't think that you're too late. You're really, really early. And there's a limited amount. Okay, you don't want Bitcoin to be mined up and be like, oh man, I wish I bought Bitcoin in 2025. You don't want to be doing that. Okay, I don't care if you got $5 in your account right now. You don't need to be buying nothing. Go buy some Bitcoin. Okay, live off the credit card. Spend all your cash on assets and watch how your life change. Wake up, pray to God, take care of your family, stay down, and get in stack mode. Let me catch you on the next one.
Let's talk about DeFi. We'll talk about how decentralized finance changes absolutely everything. No more bank systems, no more getting your transactions declined. It's just a peer-to-peer transaction system where if you send your money, it's going to go ahead and get directly sent to the other person using the blockchain system. We're going to go ahead and talk about what DeFi is, what cryptocurrency covers, and how it works. Let's go and let's get to it. So what is decentralized finance, also known as DeFi? DeFi refers to the financial systems built on the blockchain technology, primarily Ethereum, also known as ETH or ETH. And that operates without intermediaries like banks or brokers, which means that when you send transactions from one person to the next, there's going to be no middleman involved like the banks in order to decline your transactions. So everything is autonomous, which means everything is automatically done on the blockchain system using smart contracts. Okay. So everything is blockchain based, which runs on the decentralized networks, which means no banks are involved or brokers, and it ensures transparency and immutability. And smart contracts, the automatic process used in order to direct cryptocurrency from one person to the other. They're self-executing contracts coded to handle transactions automatically. And they're permissionless. Anyone with internet access can participate with no KYC required. Okay, cryptocurrency can be traded all over the world globally. So if you're trying to run a business and you're trying to get paid in any country, you can transfer currency from one person to the next. And it's open source. The code is publicly audible, fostering trust. And unlike traditional finance, DeFi eliminates middlemen, reducing costs and increasing accessibility. And for example, a farmer in the developing country can borrow funds without a bank account involved. Why DeFi matters? Let's talk about the bigger picture. DeFi is reshaping finance by democratizing access, enhancing efficiency, and fostering innovation. It's $100 billion plus industry as of 2025, and it's continuously growing, especially as laws get passed, governors and hedge funds start participating in Bitcoin, as well as the companies as well too. Financial inclusion. 1.4 billion unbanked people globally can access services. And speed and cost. Transactions settle in minutes with fees often below $1 versus high bank costs in order to wire transfer, like $25 for example, or something like that for a wire transfer fee. It also gives you full transparency on the DeFi network. All transactions are on-chain, okay, verifiable, and you can go ahead and see if something's been confirmed, which means the transaction has most likely hit the other person's wallet, or it's on its way, or it's going to say unconfirmed, which means it's still on its way, but it's just still in the void. Okay. And innovation. New financial products like yield farming emerge rapidly, where it replaces APY, also known as average or annual percentage yield. Okay. And that's where you pretty much invest your money and you're expecting it to make money year after year by just holding a percentage of your income in there. So certain bank accounts have like a 0.5% API, for example. Okay, so let's just say, for example, I don't know if this is 100% accurate math, but say you have $100 in a 0.5% APY account for 1 year. Next year, you'll have $120. Okay, so you profited $20. Okay, so cryptocurrencies and DeFi involves new financial products like yield farming. Yield farming, so instead of 0.5% APY, they have percentages that go from like 5% to over 100%. So let's say you could potentially invest your money from $100. Then next year it's $100,000 or something like that. Okay, or $10,000. Okay, so any type of example, but there's going to be volatility included into it too. Your money can definitely crash down, and sometimes it can crash to zero. So more risk involved, but there's higher ceiling cap in order to make profit quicker. So for example, Uniswap. It's a decentralized exchange that allows users to swap tokens without a central authority. And in 2024, it processed over $2 trillion in trading volume. Okay. And trading volume is pretty much the amount of money and the amount of people that are flowing within the market. So core components of DeFi. DeFi is built on several key pillars that enable its functionality. Understanding these is crucial for grasping its potential. Let's talk about the blockchains. Blockchains is where Ethereum dominates, but Solana, Binance, Smart Chain, and others support DeFi. And non-custodial wallets like MetaMask allow users to control their funds extremely quickly as well too. So you're going to be able to transfer your cryptocurrency from one place to another and operate your NFTs, etc. Okay, anything on the DeFi network. Smart contracts automate lending, trading, and more. Okay, so instead of having banks confirm your transactions, smart contracts operate and do everything scientifically. And stablecoins, assets like USDC are pegged to fiat, reducing the volatility. Okay, because a lot of the times, $1 is still going to equal $1. Even if inflation comes, it's still going to pretty much work the same. And decentralized exchange, DEXs, platforms like Curve enable peer-to-peer trading. One person, once again, gets one amount of money sent to the other person without any middleman involved. And these components work together to create a trustless ecosystem. And for instance, a user can deposit USDC into Aave and earn interest via smart contracts and withdraw via MetaMask, all without a bank. And key DeFi applications. DeFi offers a range of financial services, each transforming each forward to traders. So let's transform the most impactful ones. So lending and borrowing. Platforms like Compound allow users to lend crypto to earn interest or borrow against collateral. For example, you can earn 5 to 10% APY on stablecoins. So which means, for example, if you have $100 in a stablecoin with a 10% APY, okay, next year you might make $1,000, okay, something like that, for example. And trading. DEXs like SushiSwap allow token swaps without intermediaries, where you can just go ahead and swap your cryptocurrency from one to another quickly, instantly. You get what you want, whatever products you want to trade, how much bread you want to send. And yield farming. Stake assets to earn rewards, and users provide liquidity to pools and earn tokens. And Uniswap's Uni rewards. And staking. Lock tokens to secure networks like Ethereum 2.0, earning 4.7% annually. Okay. And insurance. Nexus Mutual offers decentralized coverage for smart contract failures. For example, MakerDAO lets users lock ETH to mint DAI. It's a stablecoin, and users control the system via governance tokens, embodying DeFi's ethos. And a lot of times, the people who get a lot of the power is going to be large investors. So it can turn centralized sometimes, depending on who's the biggest investor, but things like that can change. Let's talk about the risk and challenges in DeFi. So while promising, DeFi has significant risks that users must understand to participate safely. There's sometimes some smart contract bugs. Old vulnerabilities can lead to hacks. An example, the 2020 Yam Finance bug drained 750,000, and liquidity providers lose value if token prices diverge, and affects yield farmers on Uniswap. And governments may impose rules, impacting DeFi's permissionless nature, and there can be high gas fees involved. Ethereum transactions can cost $10 to $100 during congestion. And scams, rug pulls, and fake projects can be common too. Sometimes social media influencers can go ahead and try and create a meme coin, and they're going to go ahead and be a large holder of it, say like 60%, and they buy in at the bottom. Okay, by the time they start promoting it, the chart goes up. Since they're at the bottom, they hold a lot of the liquidity. By the time they sell, it's for a profit. Once it starts going up, okay, market's gonna go ahead and crash since they hold a large percentage of it. Okay, so be careful for rug pulls, anything like that. It's how people just make quick money, and it's not a good way to make money. And getting started with DeFi. So are you ready to dive in? Here's a step-by-step guide to participate in this DeFi safely and effectively. So we'll help set up a wallet. You can go ahead and install your MetaMask or Trust Wallet, Phantom, whatever, secure your seed phrase. That's going to be your like 12-word phrase in order to get back into your account in case you ever lose any password or anything like that. Keep it hidden. Don't give anyone that phrase. Okay. Lock it up and encrypt the password. Do what you need to do. Okay. Make sure you keep it safe. So you can connect to DeFi apps as well. You can visit Aave, Uniswap, or Compound via their D apps. You can go and buy Ethereum as well too on exchanges like Coinbase. And research projects, you can check audits on RugDoc or Community Trust Scores. And you can also start small. So start with $100 to learn mechanics before scaling and stuff like that, for example. And for example, to lend on Aave, connect your MetaMask, deposit USDC, and earn interest instantly, all without a bank. In the future of DeFi, DeFi is evolving rapidly with potential to disrupt traditional finance further, since people can send money all across the world easily without getting any holds or anything like that. So what's going to be next? Let me know what you think in the comments below. So some layer 2 scaling, solutions like Optimism reduce fees and boost adoption. Okay. Layer 2 scaling is going to be a big thing that brings a lot of solutions and fixes to a lot of issues like high fees. And there can be cross-chain DeFi bridges like Polkadot, which enable multi-chain ecosystems. And banks explore DeFi for tokenized assets. A lot of banks are starting to get hip. Standard fiat banks, traditional currency banks, they're starting to get some information with crypto. Okay. So compliant DeFi may emerge to satisfy the regulations. And AI integration can also progress how things are too. And it's projected that by 2030, DeFi can manage 1 trillion in assets per industry forecast, reshaping global finance. So for example, Aave's flash loans. Flash loans allow borrowing without collateral and have repaid in one transaction. And it's used for arbitrage, and they've enabled 10 billion plus in volume. Okay. And Yearns optimizes yield farming automatically, moving funds to high yield pools, saving users time and maximizing returns. And DeFi enables innovative financial strategies impossible in traditional systems. So how does DeFi stack against banks and brokers? What's the point of even using it in the first place? Access. One, access and speed are going to be the big two. Because one, you can send your bread instantly as soon as you want to anybody. It's global. And traditional finance also excludes the unbanked. And DeFi transactions settle in minutes versus days for banks. At certain times, you can go ahead and just wait a couple minutes or hours. Inshallah, you'll get your cryptocurrency. And DeFi fees are lower, though gas fees can spike up, making your profit or whatever you send or receive a little bit higher or lower depending on what you're doing. And trust. DeFi relies on code. Traditional finance relies on institution, which we've seen in the past can crash. Okay. Autonomous code, also known as smart contracts, control everything within the cryptocurrency space and the decentralized network. So, yeah. So for example, sending $1,000 internationally via banks takes 3 to 5 days with a $50 fee on some banks. And DeFi does it in minutes for $2. Okay, so it doesn't even matter. So ethical and social implications. DeFi's permissionless nature raises questions about responsibility and impact. So inclusion. It empowers undeserved communities but risks exploitation without education. And decentralization. It reduces reliance on corruptible institutions, but it may enable illicit activity. And Ethereum's proof of stake, POS, reduces energy versus proof of work, which is what Bitcoin uses in order to be created. So it exchanges power in order to create the Bitcoin. Okay, but proof of staking is using autonomous contracts in order to create the cryptocurrency like Ethereum, for example. And DeFi's potential to the bank is huge, but scams highlight the need for user education. So make sure you know what you're doing. Make sure you're not getting scammed out of your seed phrase, wallet code, or anything like that. Once again, do your education before you do any investing or sending a bread. So what excites you about DeFi? What concerns do you have about it? Are you investing in cryptocurrency? And if you want to learn how to trade cryptocurrency, head over to Stackmode.net. Catch you in the next one. Stay prayed up to God. Keep grinding. Peace. Hey class, this is going to be the full masterclass on how you can turn your money into more money by just investing virtually. Let's go and let's jump straight into it. So, building the financial foundation. So before committing any capital to the market, okay, make sure you guys are humble, okay? Humble yourselves. Before you invest even $1 into the market, understand that the market is not a place where you can have ego, okay? If you don't accept your loss into the market, if you don't accept the fact when you're just not correct, you can destroy all of your capital that you've been working hard for. Okay, I don't care how much capital you're investing into, 4 figures, 5 figures, 6 figures, doesn't matter. Okay, the more capital you're investing into is not going to make you a better trader. Okay, so also try and have a steady income. Okay, so don't think you're just going to come into the market and just turn nothing into something and professionally just trade forever. It can happen for some people, but it's really stressful, really anxiety driven. So try and have a steady income. Okay, work on your business. Okay, and then come into the market and invest. Okay, so stay prayed up to God. Make sure you guys are worshiping God and be humble. Okay, have some humility before you come into the market and have a steady income. Now let's jump straight into it. So before committing any capital to the market, a successful investor must ensure their personal financial structure is stable. And this initial phase dictates your risk tolerance and emotional resilience. Okay, there's going to be times where the market's going to be trying to break you down. Okay, it's going to be trying to beat you up. It's going to make you think that you're not meant for this. Okay, especially on certain things like options, which we're going to talk about in this, for example. But you guys got this. Okay, invest your money, take your time, and buy at the right times. Okay, if you want to learn how to buy at the right times, head over to stackmode.net and I'll teach you how to read the charts. I also have tons of free videos on my channel. So establish a solid budget and have a roadmap. So detail your income and your expenses. Okay, know how much you make and know how much you are going to lose in bills, and then go ahead and have a leftover amount of that, whatever that is. Okay, because you want to have some spending money just in case, because you know life happens. Put some of that away, and then whatever's left of that you could go ahead and invest. Okay, and only invest money that you genuinely do not need for daily life or near long-term goals. So pay your bills, get your groceries. Okay, take care of whoever needs to be taken care of, wife, kids, whatever, do your thing. Okay, and then you can go ahead and invest. And this way you can invest stress-free. Okay, if you lose money, you're not going to be tripping. That's not money that you completely need entirely. You're going to be fine. Yeah, and try and have a safety net too. This is going to be paramount. Try and have 3 to 6 months or 6 to 12 months for higher job instability, as certain recessions and stuff like that come into play, as the economy just becomes unstable in certain time periods. And you can have a bunch of living expenses saved up in a high yield savings account, or you can have it put in the stock market. Okay, stock market. I don't really recommend a high yield savings account though, because it's interest. Interest is wrong, so I don't really recommend a high yield savings account. But you guys can put it in a stock, put it in an ETF, and that's going to go ahead and make you guys some money. Okay, and this prevents you from being forced to sell investments during a market downturn just to pay your rent. So, and eliminate high interest debt. Okay, high interest credit card or personal loan debt often carries an effective return of 20% or more. Mathematically paying off this debt is usually the best guaranteed return and you can achieve before investing. Attack and eliminate consumer debt first. Okay, so try and eliminate your debt before you guys invest too. It's also just going to give you guys a bunch of mental health back. Okay, so if you have a credit card balance of $5,000 at 22% APR, then you must generate a new 22% return, okay, just to break even. And paying off the debt is a guaranteed 22%, okay, which significantly de-risk your financial future. So just pay off the debt so then you guys don't gain any interest, which is going to lead you to have to make more income in the future, just eating into your investing profit. So pay off your debt. It's logical. And core investor principles and account types. Successful investing is less about timing the market and it's more about time in the market. and adopting disciplined habits. So timeless principles. Be patient, okay? Don't think you're going to be getting rich overnight. And in certain cases where you do make a lot of currency overnight, okay, that doesn't mean you just blow it, okay? Don't go blow it. You need to go ahead and put yourself on a withdrawal schedule, okay? Before I start telling you guys how to make money, this is what to do with the money. Once you make the money, okay, let's say you make $500, take 50% of that and put it away. So 50% is 500, it's going to be 250, okay? Once you have that, this is going to be the amount that you can go ahead and put into your bank account, or you can go ahead and reinvest that into certain things like dividend ETFs we're going to talk about, okay? Or you can use it to pay off debt or pay your bills, etc. And diversification. Never put all of your capital into a single stock, sector, or asset class. And do not keep all of your eggs in one basket, okay? So try and have a diversified portfolio, okay? We're going to talk about the different types of diversification, but don't just put all your eggs in one basket. And DCA, dollar cost averaging. Invest a fixed amount of money at regular intervals, okay? So for example, $500 every month, okay? And this smooths out the entry price and removes emotional buying from just buying huge leaps at one time or another, okay? You're going to set yourself on a consistent schedule, take care of your bills, and keep stacking up, okay? This is going to be in stack mode. It's going to require sacrifice. If you want to get to where you want to be, it's going to require sacrifice. Stay down. Don't buy anything you don't need to be buying. Pay your bills, get some groceries, and that's it. No extras, okay? And your brokerage account, okay? This is what is going to be used for really just playing options, okay? Playing options, futures, or Forex, any type of short-term trading, okay? I would recommend a taxable account, and it offers maximum flexibility. You can have an infinite amount of money invested into it, and after tax and profits are taxed as capital gains when you sell, okay? There's also going to be some benefits though for long-term benefits if you hold for over a year. And retirement accounts, okay? They're tax advantage. So 401ks or Roth IRAs, they're incredible tools for retirement savings, and the tax benefits, either upfront tax reduction or tax-free growth, are critical to maximize long-term returns. And as far as Roth IRA, contributions are after tax, but all growth and withdrawals in retirement are 100% tax-free. So that's going to be the difference between that. And you can go ahead and use, once again, brokerage taxable accounts in order to invest into certain amounts. Okay, so you can go ahead and use that into just invest into your day trade or swing traders. But if you want a retirement account, then you can put that into your IRA. But you think about the IRA though, is that you can only invest a certain amount. It's going to be capped for a lot of the time. So I think it's around like $7,000 and $8,000 in 2025 this year. So yeah, it really depends. But taxable accounts, you can deposit an unlimited amount, make unlimited income. So depends up to you. So strategy 1, investing in shares in good companies. So the essence of value investing and buying a piece of a profitable business at a fair price and holding it for a long term. This is arguably the most stable path for beginners after index funds. Okay, so shares give you a piece of the pie. Okay, so say company is the pie, say I open Stackmode, okay, on the stock market, and you want to own a piece of the pie, okay, you're going to be able to have jurisdiction and a vote in who runs Stackmode company, okay, and as Stackmode company increases on the stock market, you make money too, okay. So that's going to be the point of people investing into shares. As the share price increases within an upward direction, people make money. Okay, so let's go and let's talk about the economic moat concept. So what is a moat? It's a sustainable competitive advantage that protects a company's long-term profit and market share from competing firms. And the wider the moat, the safer the investment. Okay. And the value of service increases as more people use it. Okay, so the value of a service increases as more people use it. So the more companies putting a smile on people's faces, more people are going to use it. More people using a company's service or buying products equals more money. More money, a lot of the time, equals a higher value share price on the stock market. Because since it's generating so much money, it's going to be a valuable company. And valuable companies are normally highly priced on the stock market. And this makes it extremely incredible hard for competitors to challenge, especially once they have a high stock price compared to the other ones. And intangible assets, brands, patents, and regulatory licenses. And think of pharmaceutical patents or universally recognized global brand names, and these cannot easily be replicated. So, analyzing growth versus value. Companies are often categorized by their investment profile, and beginners should be aware of the trade-offs involved in each style. So, growth investing, right? The focus. So, rapid revenue and earnings expansion. And these companies often reinvest all profits back into the business to fuel future growth, okay, making it a money powerhouse. And valuation. They typically have high price to earnings ratios, which means that the company is making good profit year after year and being able to most likely pay their employees good money. So, and they typically have high price to earnings ratios because investors are paying a premium for expected future cash flows, but they carry higher risk. And let's talk about value investing. Value investing is buying mature, established companies that appear to be trading below their intrinsic value, often found in older, slower growing sectors. And they lower price to earning ratios and often pay dividends, okay? And the expectation is that the stock market will eventually recognize the company's true value, leading to stock appreciation, okay? Just like the dividend, for example, SCHD, okay? For Schwab, for example. And you can go ahead and start with broad market ETFs, you could do SCHD, okay? And as you learn the market, okay, it's gonna be a good way to just grow your profit over time and chill, okay? But come on with a full plan and know what you're gonna do before you just start investing. So, to build passive income with dividend ETFs, okay? A dividend is a portion of a company's earnings that get paid out to its shareholders. So after the company decides to go live on the stock market, okay, or the New York Stock Exchange, okay, it decides to go ahead and pay money to whoever owns the shares, okay? And due to the fact that it's supporting the people who supported them, okay? So it's pretty much putting the money back in the cycle. And dividend-focused exchange-traded funds offer a powerful, diversified way to generate income. So what are dividend ETFs in the first place? So dividend ETFs provide diversification and stability. An ETF holds a basket of multiple stocks, let's say for example 50 to 100 plus. The dividend ETF specifically targets companies with a history of paying and increased dividends, reducing the risk of relying on a single company. And dividends are typically paid quarterly. The ETF collects the dividends from all underlying stocks and distributes them to the ETF shareholders. And as far as dividend reinvestment plans, this is the key to compounding. So having a plan with it automatically uses the cash dividend to buy more shares of the ETF, and this increases your share count, leading to larger dividends next time, creating a powerful compounding effect. So you could look for ETFs focused on dividend aristocrats and companies that have increased for consecutive years, right? Focus on high yield, stable sectors like utilities or consumer staples that pay out dividends, and make sure you don't see too many splits. Okay, split is when they're going to be paying out less dividends. Okay, so we're going to be wanting to look for an increase of dividend payouts, not a split to where they're going to be paying less dividends. That means that they can't afford to keep up with the amount that they're paying. So you could buy Bitcoin as well too. So Bitcoin, until it expires, until it's all fully mined up, it's pretty much just going to be virtual diamonds and virtual gold. Okay. It does have a limited resource. It's going to go away at some point in time. And Bitcoin is introduced to the world to the decentralized digital scarcity. So a decentralized world is a world where no middlemen are involved, like the banks we were talking about. It's peer-to-peer transactions, and everything's done via autonomous contracts called the smart contracts. Okay, and the whole Web3 decentralized space has been broken down on my channel multiple times. So if you want to learn more about that, you can check it out. So buying Bitcoin is also going to be a really, really good solid way to make some currency due to the fact that one has some value behind it. It's virtual diamond and gold. And two, it really helps society. People are able to trade money within a quick way all across the world, okay, due to the fact that Bitcoin exists and they get something out of it. So It's while a potential long-term asset, it carries significantly higher volatility. Sometimes it can go downwards in the downwards direction, okay, causing you to lose your money, but no risk, and different risk factors compared to equities. So the HODL mentality. Okay, HODL stands up for hold on for dear life. This reflects the need for extreme patience. Okay, so you cannot sell early. If you put yourself in a trade, okay, and if you marked it out and the trade's working out, don't just sell early taking your profit. Okay, let it ride out. Try and hold the trade for some years, okay, and see how much progress it's gonna make. Okay, especially something on Bitcoin, like it's not something ideally that you want to be scalped. And given the volatility, most the time I would say try and keep your account with like the remaining amount of money that you have. So even after you bought your stocks and stuff like that, your crypto should be your final portfolio that you invest in. And unlike stocks and a brokerage, you're responsible for the security of your crypto assets. Okay, so use good brokers and use brokers that are going to be safe and keep your money secure. And you could directly buy cryptocurrency with your card, okay, like Coinbase, Kraken, or whatever. Okay, and then you can go ahead and send it to another wallet if you would like. So stock options, okay, it's going to be a great place to make some income, but it's also going to be a great place to lose some income. Okay, so you have to really be technically advanced. Make sure you're studying. So stock options are advanced. They're leveraged financial derivatives, and as a beginner, make sure you guys are mastering and studying the charts before you even touch options. Okay, if you're struggling with options, head over to stackmode.net. I'll teach you guys how to trade it. Okay, options is not something that you want to be playing around with without the information first. Take your time. So the contract. Okay, an option is a contract giving the buyer the right but not the obligation to buy or sell an asset at a specific price, also known as the strike price, on or a specific date. Okay, so if you think price is going to go in the upwards direction, then you would buy what's called a calls contract. If you think price is going to go in the downwards direction, okay, then you go ahead and buy a puts contract. Okay, so if price went from $32 a share, and you think it's going to go to $40 a share, and it did, and you have the right contract, you would make a lot of money. Okay, if you think price is going to go down to $20 a share, and price is at $25 a share and it goes down, and you're in a $20 a share contract, or $21 a share, $22 a share, anything, anything under that, and take profit's going to be 20. Okay, so anything under 25 would go ahead and be an ideal contract, and that would go ahead and work. And it gives you the right to pretty much get paid based off directional bias. And options allow you to control $100 worth of shares for a small fraction of the cost, and this magnifies profits, but critically it magnifies losses just as quickly. And the intrinsic value of the option decays over time. Okay, meaning the contract is constantly losing value as it approaches expiration. So, eighth wonder. So compounding is going to be the process of generating earnings on both your initial investment and on the accumulated earnings from previous periods. And it's the engine of long-term wealth creation. Put your money in a loop. Okay, when you get some money from your business, invest it. And then when you make money from that, invest that. Okay, put your money in a loop. Your money should be like a tornado, a big whirlwind. Okay, and that's going to cause exponential growth, inshallah. And the returns generated in the last years of an investment journey are vastly larger than the returns in the early years. Even if the dollar amount invested remains the same, the accumulated interest is doing the heavy lifting. And time is the key multiplier. Time is going to go on anyways, as long as you're on Earth. So just let your money make some money. A person who invests $5,000 per year per 10 years, okay, so let's say they have 50K, starting at the age of 25, will have significantly more money at 65 than a person who invests $5,000 a year for 30 years, okay? For a total investment, it's going to go ahead and be $150,000, okay? So, invest, okay? Get into stack mode, take your time, put money away, and just keep grinding, okay? You guys got it, okay? And don't let your emotions get to you, okay? This is why God's gonna be really important. Staying humble, okay? Because sometimes you can have a lot of fear. especially as a beginner trader, and don't panic. Don't sell when it's not time to sell, okay? And don't buy when it's not time to buy, okay? That's being greedy and being fearful. Once again, being emotional can destroy it all within your trading assets. And buying into an asset just because everyone else is making money, okay, during a speculative bubble, for example, this usually results in buying at the peak at all-time highs. Make sure you please know how to read the charts. It's a left to right charts, and it's called trading for a reason. When you're losing, somebody's winning. When you're winning, somebody's losing. Stick to your fundamental analysis and plan allocation. Okay. And as far as the IPS, the investment policy statement, write down your goals. Okay. Write down what you want to achieve. Write down how you're going to achieve it. Okay. And write down how you're going to break it down. I reckon even if you guys have 2 accounts. Okay. 1 account for your long term, and then another account if you want to go ahead and day trade, swing trade, whatever. Okay. Up to you. Okay. They have 2 different types of tax benefits. Your long-term account, I recommend you guys holding a trade for over a year. Okay, so you get the long-term tax benefits, and then if you're gonna have a day trade account, just use that and then pay your short-term tax. Okay, so get ready. Okay, fund your emergencies, pay your bills, clear your debt, and then you're gonna be ready to trade. Okay, and then you can go ahead and do a Roth IRA and a brokerage account if you want. Okay, and go ahead and set up your initial long-term investments and start saving money through there. And stay the course. Okay, check your portfolio quarterly, not daily. Ignore the market noise and volatility, and let compounding work as magic over decades, over time. And the biggest risk is the risk of not investing at all. So start today. Okay, stay praying to God. Keep grinding. I'll catch you guys in the next one. Peace.
The real danger in the options trading space isn't the market, it's the people jumping into it with zero understanding. And options can either be one of the smartest tools in your trading toolkit or one of the fastest ways to blow up an account. And the difference comes down to one thing: knowing what game you're actually playing. Most people think that options are some get rich quick button. They might see a clip on TikTok, hear someone brag about a 300% gain, or see something on Twitter, and suddenly they're buying weekly calls or puts like it's a lottery ticket. And that's exactly why they lose. Options aren't risky by nature, but they're risky when you don't respect how they work. Let's go and let's talk about and see if options are too risky. And let's talk about the difference between a gambler and a proper trader. Inshallah. Alright, let's go and let's talk about the truth. So is options trading truly too risky? This is the prevailing myth in finance, is that options is just strictly gambling. So with options, it's a little bit different. So let's go and let's break it down. So on options, you make money based off of time. So there's going to be 2 directions you can either buy based off of. You're either going to buy calls, which is when you're waiting for price to go in an upwards direction, or you can go ahead and purchase some puts, which is when you're going to be waiting for price to go in a downwards direction. Okay. Now on options, you get paid based off of predictions. So let's say for current example, a share price is at $50, right? So let's say you opened a stock and it's at $50 right now. If you think it's going to go up to, let's say, $55, okay, then you would go ahead and purchase a calls contract since you think price is going to go in an upwards direction. Let's say the share price is $50 and you think price is going to go down to $40. In that instance, you would go ahead and play a puts contract since you think price is going to be going in a downwards direction. Okay, so speculation is what they're mainly going to be used for. When speculation means that you're getting paid based off of directional bias. Okay, also hedging too. So since options contracts aren't pure ownership, you're getting paid based off time, and if your time prediction is right within a certain time period, then you'll get paid depending based off of that. So on options, you want to, a lot of the times too, have some time on your contracts. Once again, that's going to be one of the most important things that separates it from gambling versus actual trading. Okay, so your time matters a lot. There's going to be things called Greeks. You're going to have your delta, gamma, theta, and those determine how your profit moves. Okay, the more time that you have on your options contract, the more it's going to kind of pseudo play as a actual real investment. Okay, but if you have your options contract expiring tomorrow, the chances of a certain number hitting could be very, very skeptical. But if you have your options contract expiring in a couple of years, the chances of it hitting could be very, very likely. So it can be gambling if you make it, but it can also be a really, really good way to keep your money, let your money flow within the market and dominate the instrument by just taking advantage of the time on your contracts. So let's talk about if there are insurance policies on your portfolio, and let's go ahead and explore the mechanics of risk versus reward on options. Also, one thing on options too, options you can make infinite profit. Okay, so your profit that you can make is infinite, but your risk is going to be set. So if you pay $200 for an options contract, the max you could lose is going to be $200. Okay, but the max you could win is going to be infinite. Okay, so that's the big advantage of options too. So let's go. So just like we talked about in the last slide, what is an option in the first place? An option is a contract, not an asset itself. It derives its value from an underlying asset, stock, ETF, or index. So a call option, right? It gives you the right, but not the obligation, to buy shares at a specific price by a specific date. Okay, so if you think price is going to go in an upwards direction, then you're going to go ahead and purchase a call options contract. Okay, calls, think of picking up the phone. What do you do when you pick up the phone? Okay, you call. Okay, and then we're going to have the puts to the right. Think of putting the phone down. Okay, so call, pick the phone up, puts, put the phone down. Okay, so puts give you the right, but not the obligation, to sell shares at a specific price by a specific date. So calls is if you're betting on the price going in an upwards direction, and puts is going to be if you think price is going to go within a downwards direction. Okay, the United States stock market, though, is made to go up year after year after year after year. There's also laws in place such as the short sale restriction law, which kind of prevents and helps things from crashing down to zero very quickly. So a lot of the times on options, you might be better off playing calls, since it's going to go ahead and be on the actual investor side as well too. And the double-edged sword, let's go and talk about leverage. So options provide leverage, and one standard contract controls 100 shares of stock, and this is where the risk and reward are amplified. So scenario, right? Let's say stock XYZ is at $100. So the stock investor, let's say they buy 100 shares, right? So if the stock price is at $100, in order to buy 100 shares, that would cost $10,000. Okay. And an options trader, let's say they buy one call contract, okay, with the $5 premium. So let's talk about the decimal numbers on options too. So if you ever see an options contract, let's say 2.50, you always want to multiply every options contract by 100 to get the real dollar value. Okay, so 2.50 times 100 is going to go ahead and be 250. If an options contract is 14.20, okay, we're going to multiply that by 100. That's going to equal 1420. Okay, just make it super easy. Okay, whatever you guys see, you multiply that by 100. So let's say the stock price is, or let's say the options contract is 5.70. Okay, then multiply that by 100. It's going to go ahead and be 570. And that's how you're going to go ahead and get the share price for that. Okay, so if the stock goes to $110 and you have a calls contract, then that would be a 200% return. Okay, but if you have it on shares, then that would be a 10% return. Okay, let's just say that for example. So if the stock stays at $100, the stock investor loses nothing, and the options trader would lose 100% of their $500 because the contract expires worthless. Okay, so if your contract doesn't move the amount of ticks that you think it's going to move within that time period, then the options contract could very easily expire worthless, and you would see it at a negative 100%. But when you're buying things like shares, you're actually having the actual investment, and you have the ownership power within your account forever until you decide to close. And why is it risky in the first place? So options aren't inherently risky. So gambling behavior is risky, and most retail traders fail due to two specific factors, right? Let's talk about time decay. Theta. So options have an expiration date. Every day that passes, the contract loses value if the stock doesn't move, and stock owners can wait forever. Option owners are also fighting the clock. So a good way to counter this, though, if you do want to play some options or you see some good plays, try and play what's called leaps if possible. Okay, leaps are going to be contracts that you're holding for like 1 to 2 years out. Okay, try to stay away from like zero DTEs and things like that, and use your options as a seed to plant for the future. Okay, if you're buying contracts like 1 to 2 years out, and let's say the share price is at $50, right? Once again, so if share price is at $50 and your take profit, you think it's going to go up to $60, okay, the best contract to buy would be a $51 call. Okay, and you might ask me, Chris, why would we not buy the $60 call if that's our take profit? Because on options, once again, you get paid based off of prediction, and there's going to be bonus points on option. So if the share price is at 50 and you buy a $51 call, but your take profit's at 60, that's going to be a lot of bonus points versus just buying the take profit 60 contract, because then your contract wouldn't really start juicing and making good money until it gets hit. So if you buy a number before your take profit, you're going to get a bunch of extra bonus points and it's going to hit really, really hard. Now, let's talk about buying out the money, right? Try not to do that. Try not to buy cheap contracts. Also, don't forget that it's called trading. When you're winning, somebody else is losing. When you're losing, somebody else is winning. So beginners buy cheap, unrealistic contracts hoping for a lottery win, and these have a low probability of profit. And consistent losses of small amounts add up to account blowups for sure. So don't just buy any random contract thinking it's going to hit. Try and buy 1 to 2 years out, and whatever the current price is, try and buy one above if you're going to purchase a call. Okay, so if the share price is at $50, try and buy a $51 call contract. Okay, if the share price is at $50, you think price is going to go down, try and buy a $49 put contract. Okay, play it like that, buy 1 to 2 years out. The chances of you losing is going to be really, really low. And using options for safety. So professional traders use options to reduce risk, not just to speculate. So the cover call income. So let's say you own 100 shares, right? You sell a call option against them and you collect the cash premium instantly. This lowers your break-even price on the stock, and this is safer than just owning the stock. Okay, so whenever you have enough shares of a certain stock, you're going to be able to actually sell the options contracts. Okay, and then you're going to have protective puts as insurance. Let's say you own 100 shares and you're worried about a crash, then you would buy a put option. If the stock crashes to 0, which most of the time, if it's a half decent investment, it won't, then you have the right to sell it at the strike price, and you've capped your maximum loss, protecting you on really both sides and just giving you a lot more leverage on your account to manage and maneuver your money exactly how you just want. So covered calls and selling options is something you can also look into. I'm going to be dropping a video on that very, very soon as well, inshallah. But before that, let's talk about it. So let's talk about selling versus buying the premium. So the house usually wins in options, and the house is going to be the options contract seller. So the options contract seller is pretty much wanting you to do some insane decision. Okay, they want you to make the most dumb decision of all time, and then they're going to get paid off of it. So that's not what you want. You don't want to get taken advantage of, so you need to outplay them. Okay, so the statistical edge. So approximately 70 to 80% of options expire worthless. Therefore, buyers have unlimited profit potential, but a low probability of success. But if you want to see a lot more successful wins within your options trading portfolio, I recommend you guys focus on contracts 1 to 2 years out. And once again, wherever the current strike price is, buy one above or below that number in order to have that consistent value. Okay, that way you're pretty much gonna trick it into almost a shares type of play. Okay, but you're getting the options profit. Okay, focus on time and stay near the current price. And sellers have capped profit potential, but have a high probability of success. Okay, due to the fact that they know people are going to make some uneducated, silly decisions and destroy their account. So don't let it happen to you, inshallah. So conclusion. So risky trading usually involves buying short-term options, right? Like 0 DTEs, weeklies, etc. And conservative trading involves selling options or using spreads or buying contracts within 1 to 2 years out to define your risk in every single scenario. Really just protect your money, okay? You're not on this earth working hard for no reason. Don't go burn your money down to the ground making dumb decisions, okay? You got it. So if you're not focused on your take profit, options can definitely be a problem. If you get reversed on certain areas, the Greeks are going to really hit you extremely hard. And it's things that's happened to me. There's been times where I've been up at almost $1,000 in a day, come back later on due to the fact that I was playing 0 DTEs, come back to negatives, okay? So it's not things like that I want you guys to go through. It's extremely toll taxing on your mental when you guys are trading, and it can bring a lot of anxiety on your next trade, and I don't want you guys to go through that. So understand that they're going to be too risky if they're going to be treated like lottery tickets. So if you're buying weekly out the money calls, 0 DTE without risk management, expect those results. But they're not too risky if they're used for hedging, income generation, or if you're buying leaps, which are going to be contracts that are 1 to 2 years out. Okay, so the danger really lies in the trader, not the trade. Okay, so control your flesh, be disciplined, don't make dumb decisions, stay prayed up to God, keep grinding, protect and provide for your family, and catch you on the next one.
So why do crypto tokens burn in the first place? And what happens when tokens disappear? Let's jump into it, class. So the technical mechanism, how tokens are permanently removed. A token burn is not a literal incineration like fire, but it's a cryptographic action that permanently removes a specified quantity of tokens from a circulating supply. This process is irreversible and transparently verifiable on the blockchain ledger. So you can see if it was actually completed and if the token was actually burned and removed. And the black hole address, the burn address. Tokens are sent to a specifically designated verifiable address for which no private keys exist. This is often a publicly known and accessible address, like 0 times 000.000 DEAD. It's an irreversible transaction. Once the transaction is confirmed and the address has been, or token has been deleted, all right, once the transaction is confirmed, the tokens are then locked forever because no one can access the private key associated with the burn address. The tokens can never be spent, moved, or recovered. And transparent and verification. The entire process is recorded on the public ledger, and anyone can verify the burn by checking the transaction ID and confirming the tokens were sent to the known burn address. This trustless verification is fundamental to the burn's legitimacy. So, some economic drivers. Let's talk about deflation and scarcity. The primary motivation behind most token burns is to introduce deflationary pressure by reducing the total or circulating supply. The burn aims to increase the scarcity of the remaining tokens, theoretically increasing their value based on basic supply and demand principles. And we'll talk about reducing circulating supply. Burns directly decrease the quantity of tokens available for trading on exchanges and held by users, which can lead to upward price pressure if the demand remains constant or increases in a certain direction. And countering inflation. Many proof of stake or yield generating protocols, and proof of stake is going to be the opposite system of proof of work, where you're exchanging power to create cryptocurrencies. Proof of staking, like Ethereum, uses smart contracts and a whole different system in order to create the cryptocurrency. And they have naturally inflationary token insurance schedule. Okay, so that's for minting new tokens. So many proof of stake or yield generating protocols has a naturally inflationary token issuance schedule, minting new tokens. And regular burns can offset this inflation, aiming for a net zero or even negative deflationary supply growth. So let's talk about some psychological impacts of it. Hype, for example. The announcements of a large token burn often generates positive market sentiments and media coverage, serving as a powerful marketing tool to signal commitment to long-term value. So if a token has a fixed maximum supply of 1 billion and 100 million are burned, the new effective maximum supply will be 900 million. And for every holder, their proportional ownership of the network has slightly increased relative to the total supply. So diverse implementation models. Examples of token burns. Token burns are implemented in various ways, often defined within the core smart contract code or through a governance mechanism. And understanding the type of burn is crucial to assessing its long-term impact on the network tokenomics. So the fee burns. A portion of the transaction fees, also known as gas. So if you ever heard the term gas, that's going to talk about transaction fees or platform fees, are automatically routed to a burn address. So for example, Ethereum EIP 1559, and that model burns a base fee on every transaction, making the network deflationary during high demand periods. So buyback and burn. The project uses profits, example, from an exchange or platform revenue, okay, to buy its own token from the open market and immediately burn them. This creates both buying pressure and permanent scarcity. For example, that's how BNB does. So, scheduled and manual burns. Pre-announced or governance voted burns, often related to the initial token supply. For example, burning unallocated team or treasury tokens. These are usually large one-time events. For example, initial coin offerings, the opposite of IPOs, initial public offerings. For cryptocurrency, ICOs, they have post-sale burns. And the impact and critical analysis. Let's talk about benefits and concerns. While token burns are widely adopted, they are not a guaranteed solution for increasing token value and come with important caveats that investors and users must understand. And a key benefit, they have an incentive alignment. By making tokens scarcer, it encourages long-term holding and participation. And security. In some proof of burn mechanisms, burning tokens is necessary to validate blocks, contributing to network security. And certain perceived value. It solidifies the idea of the token as valuable, diminishing assets rather than an infinite resource. And criticisms and concerns. Let's talk about price manipulation. Large sudden burns can be used to engineer short-term pumps, potentially leading to instability. And sustainability. If a protocol burns too much too fast, it may not have enough tokens left for future development, funding, or ecosystem grants. And governance risk. Manual burns controlled by a centralized entity introduce risk, contradicting the decentralized ethos. So the whole point of it is to be decentralized, but if they're able to burn tokens, okay, which can be controlled by someone with a lot of money, okay, that can kind of make it centralized, but not everything's perfect in the world. Only God is perfect. So, but tries to make it as fair as possible within the decentralized finance space. We do the best we can. So, token burning. It's a sophisticated economic tool that has become a staple in modern decentralized finance and crypto tokenomics. So it's irreversible. Okay. So irreversible, that means that once it's done, it cannot be done back again. Okay. So talk to me, guys. So if it's decentralized, right, and the whole point of the cryptocurrency space is to be sending transaction from one person to another. But if a large company with a large amount of money can come in, like a whale, for example, that's what a whale is. Okay, a whale is going to be someone who has a large amount of currency. If they can come in and spend a lot of money, right, and control a transaction or burn a token, right, to increase the scarcity. So let's say they burn a token, right, and then they're holding it, right, and scarcity equals demand. Okay. So if you guys ever heard of the term supply and demand, supply means when there's too much of something. Okay, when there's too much of something, there's supply, it's available. But when it's in demand, people are trying to buy that today. And the goal of token burning is to reduce the supply, introducing scarcity, putting demand into it, but it's also going to be used to burn things like certain fees, which can help manage inflation a lot. All right, so just think about it. All right, is it something that's going to be beneficial to you long-term wise? And think, the success of a burn really depends on sustained demand and the overall health of the underlying project. So it's not always going to be a positive thing. It's not always going to be a negative thing. It can really help people, with certain fees and stuff like that, but it can also introduce scarcity in certain coins, causing it to just go up way quicker than it may, right? And if anyone's in a short position of that, that could hurt them. So it could really just see what happens in the future with it. All right, token burning, it's something that's there. It's going to keep happening. And whether it's good or not, let me know in the comments. Catch you guys in the next one. Stay prayed to God. Keep grinding. Catch you guys in the next one. Peace. If you guys are struggling to invest or save some money, this is going to be how you can get into stack mode. Get ready.
Class, what's going on? We're going to be talking about stacking up cryptocurrency, stacking up that Bitcoin, that Ethereum, XRP, etc. All right. We're going to talk about some things, how we invest, what DCAing is, and how we're just going to get into stack mode. Okay. Successful investing is not about timing the market, but it's about time in the market. An unwavering mental discipline. The discipline is going to be the foundation of stack mode. So, have some strong commitment to your goals. If you're going to tell yourself, I'm going to put away X amount this month, do that. Stay down. I don't care if you don't got to go out with your friends. If you don't want to eat the food you don't want to eat, do what you need to do. All right. When you're in stack mode, you got to reject emotional trading, emotional decisions, and things that you don't want to do. Okay. You want to go cop that cake. Okay. It costs $5. That could be $5. That could be stacked into some cryptocurrency. You got to rewire your mindset completely. Okay. You got to be prepared to rewire your mindset completely. All right. So buy assets regardless of the market volatility. Okay. This mimics a consistent practice. Okay. I'm telling you guys. All right. Just invest. Okay. Sometimes people might be thinking like, oh, what if it's an all-time highs? What if it's this or that? Certain things you don't trade like other things. Okay. Now, if you're trading something like Forex, futures, or options, right, be extremely strategic with where you're buying. And when market makes a nice dump, okay, you start seeing some support getting formed, buy the dip. Okay, buy the dip. Okay, if everyone's thinking, oh, we're in the worst bear market of all time, if you just start seeing a nice curl on your higher time frame structure, take that. Go ahead and take that. Get in, start stacking up some cash, and watch your money grow. Watch it turn into more money over time. Okay, but it's not going to happen if we don't start trying, if we don't put in things now. Some of you guys might have $20 chin in your checking account right now, right? Put $15 in there. Okay, keep $5 in there. Stay down. Stay down. Do what you need to do. Okay, keep your checking account empty. Keep yourself broke. All your money should be planted in some type of investments. Keep yourself broke. I'm telling you, it's going to change you guys' mindset entirely. Okay, and the biggest threat to a portfolio is really going to be greed. Okay. So one thing that is going to be extremely important though is one, knowing when to close, knowing when the trade is just really finished, okay? Knowing when you just need to exit for some profit, take some money off the board, etc. Okay. And fear, okay? Fear can be absolutely destructive, okay? And we're not going to have that, okay? That can cause certain things like anxiety, okay, which can mentally make you do horrific decisions, such as closing your trade early, okay, destroying your whole risk reward, destroying your whole goal of the trade in the first place. Okay, so we're not going to do things like that. Okay, we're going to change our mentality. We're going to come stronger. We're going to be better. Okay, we're going to ask God for strength, and we're going to go forward. Okay, even if you do make a mistake out of greed, even if you held the trade a little too long, and then you wake up the next day, your profit's a little lower because you got reversed on. It is what it is. Learn from that mistake. Journal it, and don't let it happen again. Okay, you're good. And make sure you guys are trading things that are halal. Okay, you guys want to be trading good things, clean things. Okay, because when you start trading things that the worldly community just doesn't support of, you can start seeing a large decline in assets. You've seen it with certain stocks like Target, for example, and things like that, where points have dramatically dropped due to the fact that the world just didn't agree with certain decisions that were made. Okay, so be aware of that. And have some delayed gratification. Okay, make it fun. Stay down. Okay, stay down. Go on like a 6-month run. All right. The core principle of investing is buying assets instead of buying random items. Okay, that's what you're going to be doing. Make sure you guys are buying items and things that are going to be making you more money in the future instead of just buying random miscellaneous items. I'm telling you, your money's going to get spent either way. Okay, so don't just keep it stacked up inside of a bank account. Do something with it. Plan it in something to where it's difficult to pull out, to where you actually have to press buttons to withdraw. I'm telling you, if you have it sitting in your account, you might do something that's not going to make your money turn into more money. Okay, so every potential consumer purchase is viewed through the lens of opportunity cost. Be like, dang, that could have been some crypto. That could have been some Bitcoin. That could have been some Solana. Dang, that $20 on McDonald's again. Dang, that could have been some Bitcoin. Okay, you do that 3 times a week. You go out on the weekends. Okay, you go out. Okay, you get McDonald's Friday night. You do it again Saturday night. That's $40. Okay, 2 weeks, 3 weeks of that, it's $120. Okay,
that you guys could have put away that could then grow, turn into easily $200, okay, within a couple of months, okay, or a couple of weeks even, okay, and then that grows, and then you put in some other cryptocurrency, then that grows, okay. Just the fact that your money is making you more money instead of you going home buying one big batch of groceries for significantly less, okay, because how do you think these food places are making money in the first place? All right, they're buying large bulks and selling it to us for an upsell. That's how just business works. So instead of getting flipped on, okay, because you're in stack mode, you're not getting robbed, you're not getting flipped on, okay, inshallah, you're not getting finessed, you're not getting tricked out your spot, okay, you got to have your head on, have it straight. Make sure you guys know exactly what you're investing into as well before you put $1 into it. Don't just hop into something because your boy or somebody said it was fire or somebody said it was a great investment. Yeah, hop into this. No, do your research, understand the fundamentals behind it. Fundamentals means the investment, okay, the true purpose of the future. Is it helping people, okay? Is it improving lives, okay? Think about what it's doing, okay? And if so, then you can go ahead and make your potential decisions based off of that. Then you want to go ahead and check the charts, etc. But make your decisions before you invest. Do your research. So a long-term portfolio, it must be resilient also, okay? So a long-term portfolio must be resilient. And we allocate capital based on conviction, decentralization score, and time horizon. Okay? And this minimizes the impact of any single asset's failure. So the foundation, right? This is going to be the floor, okay? So when you guys are investing, think of everything like a house, okay? On the base of the house, you got your pillars, okay? To make sure that the house doesn't blow away in case a big storm comes, tornadoes, etc. Okay? So think about that. You're going to have your foundation. Make sure you guys have your foundation in something that's not too volatile, okay? The foundation of your portfolio shouldn't be fluctuating too much. And if it is fluctuating, it should be positive, within a positive equity over the course after year after year after year after year. Okay, you don't want your money to be fluctuating extremely heavily into something where you have a large majority of your investments. Okay, especially if you're using this investment as a savings. Say, for example, if you're using Bitcoin as savings, okay, something I personally do. Okay, if you're going to use Bitcoin as savings, you can see year after year after year, it's been something that's been stable. Okay, the U.S. government owns it, many other governments own it. Okay, and you can see other companies have been buying hundreds of millions of dollars worth of it as well too. Okay, showing us that it's very safe, and it seems that the world's organizations that control the economy seem to be investing into it. Okay, even that, things like the S&P 500, ETFs, which stands for exchange traded funds, those stuff like that can be invested into. Okay, so your foundation, large majority of your portfolio should be into something safe. Okay, then you're gonna have your infrastructure. Okay, your infrastructure is really gonna be 15 to 30% of your account. Okay, it's gonna be some key platforms in there. Okay, some other cryptos that you might believe in. Okay, key platforms, smart contract layers, and scaling solutions that are essential for the future. Okay, so the reason why, for example, you might want to use Bitcoin as your foundation, Bitcoin is a limited resource. Okay, so eventually it is going to go away. It's going to go ahead and go extinct. So you could go ahead and use it as the floor due to the fact that it's something that's almost guaranteed to go up, due to the fact that just off of humans' ideology alone, we want to have the most of something, especially if it's going to be rare. Okay, so that alone creates value, leading it to go in an upwards direction year after year after year. Thank God. So, and they also allow us to trade currency from one person to another. So even if you wanted to send money to your family or do something like that, okay, if you have some family in Thailand, okay, and you're in America, instead of having to go through the tedious wire transfers, getting your payment declined, etc., PayPal, blocking or putting your money on hold, etc., what you could do is just send it easily through cryptocurrency. Everyone's going to be happy. Okay, so if you have family in a whole another country, you can easily send money to them using cryptocurrency. Okay, so it has value. Okay, it has value, and there's also going to be tons of things like Bitcoin ATMs as well too. Like for example, at my local gas station, there's Bitcoin ATM. Okay, you can go ahead, and I'm sure maybe near you as well too. Okay, if you guys check, see if there's a Bitcoin ATM near you. If you guys have some cash, okay, say if you guys get paid through tips or something like that, go take that to the Bitcoin ATM and go buy some crypto. Okay. I don't care if you guys have cash, you do whatever you need to do. Okay, take every dime, but you need to have that investment mindset. Okay, don't think about the amount, think about the action. Okay, I don't care if it's $5, go put it in the market. Okay, You need to have the mindset. Some of you guys are attached to the money. Some of you guys want to see big figures, but your discipline is not in place. Okay. And this is something I personally talk to God on a lot, praying for strength. Okay. Because if you want to see these numbers, you have to be the person that's able to see these numbers. Okay. If you want to make 7 figures a month, a year, etc., right? You have to be somebody who acts like it, somebody who moves like it. Are you waking up? Okay. Do you pray every day? Do you pray for assistance? Okay. To stay healthy so you can continue grinding, working, and innovating on your ideas that you've been blessed with in the first place. Okay. Are you spreading love? Okay. Okay. Are you spreading good energy on the earth? Okay. There's going to be a lot of things that go into this. So you got to change your mindset on money too. Some of you guys are still disrespectful to money, and you might not even have any money. Okay. Some people think that $5 is not a lot of money. $5 can go a long way. $1 can go a long way. Okay. It's about your mindset. Okay. Stacking everything. Okay. Make sure you guys are getting the cheapest things that you can. If it's not something that you could have to be overly excessive on. Okay. If it's something like food, okay, get yourself some high quality food. Okay. But if it's something like an expensive t-shirt versus the normal t-shirt, and you can't truly overly afford the expensive t-shirt right now, why are you trying to pop it? Relax. You're in stack mode. You got to be okay with that. Okay. God got you. Okay. If you got some family that loves you, you're blessed. You're good. Okay. Stay down. Stay down. Don't worry about what people are thinking. You got to be in your own lane. Okay. If you're going to be in stack mode, you got to be tunnel vision. Y'all wake up, pray, and grind. You can't be thinking, oh, what's this person finna think? What's this person finna think? Oh, they see me in this fit 30 times. Like, man, you got to get all that stuff out your head. You got to run up your bag right now. Some of you guys are running your bag. You're too much in people's world. Okay. You're way too much in people's world. You're worried about, oh, who's in this relationship right now? Who's doing this? Who's doing that? Okay. We got to worry about us. We got to worry about us. There's plenty of times where I realized I had to take a step back and worry about Chris. Okay. And I had to get in stack mode. Okay. And it's important to do that. It's healthy to do that. Okay. Focus on yourself. Even if you guys got to go ghost, do what you need to do. Okay. Focus on God and just build yourself. Come stronger. Okay. Change your whole mentality. You're not going to be able to invest the way that you want to if you're at the same mentality. You can't say you want to be a millionaire and you're not ready to sacrifice. When the sacrifice comes, you're like, man, I'm not doing this. I'm about to just get the fast food, whatever. You can't say, yeah, I'm about to get groceries. You know what? I'm swapping the groceries. And then you drive by the fast food place, you go cop some. Okay, spending way more money than you need to. Once again, keep yourself in the loop. So when you are ready to break out the hamster wheel, let yourself know. Okay, let yourself know, because God knows when you're ready to break yourself out the hamster wheel. Okay, but you gotta write your good story. Okay, don't wake up and don't be on nothing. Wake up and go be hungry for it. Okay. After you wake up, you make your fajr, you pray, go get to it. Be hungry. Whatever you had in your head the next day or the previous day, get to it the next day. And then the next day, keep yourself hungry, keep it forward. Yeah, you can't be doing all these researches on these cryptocurrencies, being like, oh, this is going to be the greatest investment of all time. And then you have no capital put in because you're not grinding. Okay. So a lot of the big portion of trading too is really having the capital outside of trading. Okay, what are you doing outside of these markets to even have money to make these cryptocurrencies turn into any sort of profit or help any sort of people within your family or anybody within the world? Okay, if you say you want to do X, Y, and Z, okay, it's time to make some sacrifices. Okay, and I really do believe in you guys, but if we want to make it happen, we got to sacrifice. I believe in you. If you have even the thought in your head, I believe in you. But you got to sacrifice, okay? Once you show yourself that you're not ready for sacrifice, you're going to fail yourself. And then you might start not believing in yourself, okay? And that can really tear you down, okay? Don't lose track. You guys are good. I'm telling you, you're good. Stay decent. When you're dead tired, when you think you can't do it anymore, keep going. Keep going forward. Do one more rep in the gym, one more phone call if you're a salesperson, one more video, okay? You got to set yourself apart.
Okay, that's pretty much all this is. If you guys are chasing wealth, you have to set yourself apart then. That's all it is. All money shows you is who's setting themselves apart, who's waking up every day, who's praying, who's grinding. That's all it shows. Okay, we got to understand that this is all numbers on the screen at the end of the day. Okay, all money is numbers on the screen. It's numbers on the screen and it's paper that can be ripped. But it's things that can keep roof over your head. You can help people and feed yourself and people around you. Okay, so it can do really important things. Okay, so I need you guys to understand, like, okay, cool. So this is why being close to God is really important, because I'm telling you, if you guys just made $1,000, right? Pay your bills, okay? Get your groceries. Please don't eat out. Okay, don't eat out. Get your groceries. Okay, pay who you need to pay. Clear your debt. Credit cards. Make sure you guys clear that debt off the table. Okay, clear that debt off the table. There's a reason why God talks about debt as well too. Okay, clear that debt off the table. You guys don't want that haunting you. You don't want interest to be building up. Okay, interest could definitely come bite you like a shark. Okay, leading you to have less money to invest in the long run. Okay, so money that could have been invested, you would be paying to whatever debt that you'd be laid on. Okay, instead. So please, inshallah, work harder. Okay, I don't care if you guys are tired. That's beautiful. Beauty in the struggles. There's times in life where you're going to be significantly more tired than others. There's times in life where you're going to be working significantly harder than others. Okay, and then there's going to be times in life where you might be chilling, you might be taking a step back. Okay, and that's life. That's just what it is. Okay, whether you guys might get sick, event happens. Okay, you might just need to take some time to get your mental recourse and build yourself back stronger. Okay, it happens. We're all human beings. Okay, sometimes we go through phases, things like that. All right, but if you're going to be in stack mode, you got to understand the main goal of the mission. Even if you are going through said phases, you can't let your emotions dictate and control and over centralize your decisions. All right, if you're going to tell yourself, all right, I'm putting away $30 this week, I'm not eating donuts, and I'm not going to work out. Okay, if you say you're going to do all those things, right? And then you get up, it's late alarm, you boot up 3 donuts, it's goofy, okay? And every time I would fail myself in the morning, I would just have a strong, furious hatred for myself because I failed myself. I failed myself. The higher level of Chris, right, who expected more from me, okay, failed. So then I told myself, you know what? Every morning I get up, I'm going to strive as hard as I can to be disciplined. I don't care how badly I don't want to work out. I'm there. Okay, I'm going to have the weighted jump rope in my hand. Okay. And this is the type of mental infrastructure that I built within myself because I was tired of being disappointed in myself. Okay, some of you guys are also chasing financial goals because you're tired of being disappointed in yourself. And I feel you. Sometimes we got to upgrade our life. Okay, we don't want to be living lower than we expect. Okay. And I understand that we're all here once on this earth. Let's live nice. Okay. Let's live nice. But if we want to live nice, we got to understand the sacrifice and the other side of that. Okay. And I just want to be extremely real with you guys. So it's like people might come on here and show you guys the beautiful side, especially of trading and investing, etc. Might come on here, show you cars and things. You know, there's a couple times I come on, I'll show you guys some things, right? Might show you some cars. I might show you on a vacation or something, right? But I do want to just keep it extremely real with you, okay? There's times where it's 18-hour days. I'm extremely just frustrated, okay? Just tired, okay? Appointment after appointment after appointment, call after call after call, okay? Once again, keeping yourself broke, okay? Being like, oh man, you know how many times I've wanted to pull money out of my investment account to go buy something, but no, you don't do it. You stay down. You got to have your future goals set, especially if you guys have families. It's time to take things extremely serious. Okay, that's a blessing you guys have been blessed with. Okay, if you guys have been blessed with a family, people who love you, it's time to go hard for them. Okay, show them a new side of life. Show them something turn. Okay, but in order to show them something turn, you got to turn up. Okay, so stay down. Stay down with it. I don't care whatever you're doing. I don't care if you're making pots and pans. Stay down with it. Keep making pots and pans. Make the best pots and pans in the world. Stay down with it. But some of y'all give up. Okay, you're never going to get to any type of bands if you give up. Okay, this is why praying to God every day is a good way to build discipline. Okay, start your structure, wake up, pray every single day. Okay, be grateful.
And also being in a gratitude mindset, it's going to be hard to be mad. Okay, when you wake up, you're grateful for your life. You're grateful for what you're going through, whether it's good or bad, struggle. Okay, whether you're chilling on a beach house and you made it, okay, or you're living in the trap. Okay, either way, be grateful for what you're going through. You're alive. You can innovate your ideas, and you can come different. You can pop out. Okay, you can show yourself that, you know what, I'm better than whatever version I thought I was. Okay, I'm better than whatever mental level I'm at right now. I can be way stronger right now. I can be way more disciplined. I can be way hungrier for it, like a lion. Okay, so go hunt. Go hunt. Okay, go hunt. Whatever you guys want to do, that business you say you want to start, go hunt. Go hunt. Okay, we're in way different times now. Okay, back in the day, we're really meant to wake up and go hunt lions and go hunt animals and stuff like that, and defend and take care of our land and things like that. That's really what we're meant to do as human beings. So to be as passive as to not want to start your business or not go for your goals, it's really crazy. Okay, it's crazy. You gotta have way more testosterone than that. I don't care if you're a woman or a man, you gotta just have way more thumos than that. God did not make us here to be sitting around wasting our lives. Don't do that. Okay, if you play video games, hop off of that. Why are you building your character there instead of your real life? Okay, if you play video games, don't book a call. Don't book a call. I don't talk to nobody who plays video games. Okay, don't do that. Okay, you're wasting your time. You're already showing me and yourself that you're not serious. I don't want your money. Okay, if you play video games, if you're undisciplined and you're not serious about getting disciplined, don't book a call and don't send me a single dollar on Stripe. I don't need it. I'm perfectly fine. Okay. But if you're serious about improving your life, okay, going in a further direction, okay, working on getting closer to God and really cleaning up your mistakes, okay, I understand. I'm willing to work with you. Okay, but I'm telling you, if you guys are just trying to trade just to make some money, you're not really trying to improve as a person, I'm telling you, you're going to lead to a downward spiral. Even if you run up some decent money, have a good luck like keeping it. It's not going to be fun when you have no discipline, no structure, and no base level morality built for your money. Okay, you're going to be treating it like it's nothing. Okay, you might make some over leveraged trades, and you might have some expectations that might over exceed reality. Okay, and that could definitely lead you to despair within trading. Okay, so take your time, work on your decision making before you put a dollar into the market. I'm telling you, before you start investing, you have to change your entire mindset. I was extremely humbled when I started investing. I realized my ego problems. I realized how impatient I was, okay? To the point here, I'm going to show you guys, I even have patience tattooed on me here, okay? I realized how impatient I was. There was times on futures where I just couldn't wait for setups, okay? Couldn't wait for setups. As soon as I would blow the prop firm account, I would immediately go take some money and go buy another one. Go buy another one, go buy another one, go buy another one. Spend like $3,000 in prop firm accounts just being a failure. Okay, and I don't want you guys to go through hard times like that. That time was very depressing for me. Okay, made me feel like a failure, made me feel like trading wasn't for me. Okay, until I caught my edge. And then from there, started teaching my friends. And then friends told me to teach you guys. Okay, and thank God everything worked out systematically, ended up becoming profitable. Okay, understanding the market on the long-term side and the day trading side. And through all that failure, I started to understand the market on a global perspective, whether it be futures, options, Forex, cryptocurrency, or stocks and shares. Okay. So failure, understand that if you see your portfolio in the red, failure is really going to build you. Okay. You got to fail. The fact that you're hunting, you're not going to catch everything. Okay. Lions don't catch everything. There's plenty of times where the animals start realizing, like, especially when they're in packs, they can fight back. Okay, even if you're a mighty lion, you're not going to catch everything. You're not going to catch every zebra, and that's all right. Okay, what's life if you're winning everything? That's not, come on. That's not realistic, and let's have some grit. Okay, let's put some grind in it. Let's hustle. So understand that, okay, if your portfolio's in the red, you can't panic. Okay, have a mindset of, okay, not everything in life is going to be a win. Sometimes it'll be a loss, but that information will turn into a win later, inshallah. Okay, so just keep praying on it. Pray for strength. Okay, don't have anxiety. Don't be shaking in your boots when you see your portfolio on the red. Okay, keep investing. Keep stacking cash into it. Okay, keep stacking cash. Okay, I'm telling you guys, it'll play out in the end. Give it a couple of weeks, a couple of months, a couple of years. Sit on your investment. Okay, some of you guys are expecting that profit the next day so fast. Okay, stop scrolling on shorts and doing things like that. Go post some shorts. Go get some money. Okay, post some shorts. But you yourself, okay, if you want to be a strong individual, I really recommend you guys stop doing fast things. Okay, the more you do fast things, the more you do instantaneous things, you'll be an instantaneous person. Okay, and that's literally going to lead you to despair. You're going to make the worst decisions of all time. Okay, and then you're going to be like, dang, why am I broke? Why am I in this situation? And it's because you didn't realize that you just set yourself in despair. Okay, so I realized after a multitude of doing the worst decisions of all time, okay, I was like, okay, I need to think on my decisions. And since then, things have been a lot smoother. Okay, you're going to start realizing, okay, I really sat on this trade. I did thorough research on this investment, on this crypto token, for example, okay? And I made sure that one, it wasn't a rug pull, okay? What a rug pull is pretty much just people who pay advertisers or hack influencers to just gain a large audience to influence people to buy a crypto token that they have a large percentage of, so you can buy, invest into it, and they make money and you don't, okay? That's what a rug pull is. Okay, and then it doesn't have any value, so it's going to go down to the floor and no one's going to keep buying it because there's no demand for it. Okay, versus something that actually has some strong value. Soon as price makes a dip, creates a floor, people are fiending to buy every single dip of something that's actually profitable. Okay, so focus on trading things that are going to have some value within the world. Okay, if it has value within the world, take a shot at it. Okay, stack some cash into it. Stop being scary. Some of y'all are being way too scary. Like, once again, we come from sleeping outside. We come from hunting lions, defending ourselves from bears, etc. And y'all are scared to throw some bread in an investment. You got to relax. Okay, relax. All right, it's time to be reckless, especially if you're young. Okay, throw all your bread into your investment. Okay, throw all your money into your investments. Really believe if God puts in your heart, all right, this is what you should be doing. You should be stacking cash into XYZ. Do that. Okay, do that. Don't go making other decisions, being influenced by other people. Okay, if you feel like, you know what, I should heavily invest into this, do it. Okay, do it. Do it. Do it. Okay, some of those chains in your mind, you got to break free from that. You got to break free from that. Some of you guys are scared to invest, but then you have no problem shopping at a store. And it's like, you didn't think the store didn't invest to attract you to go shop. So it's like, change your mindset. Okay, how are you scared to invest, but you can go shop at the store that invests to attract customers like you? Okay, don't be scared. Okay, God got you. You're good. And once again, keep yourself broke. Okay, once you guys keep yourself broke, after you, once again, pay your bills though. Pay your bills. Make sure you have some food in your crib. Okay, so that way you're good. Once you come back, put some gas in your car if you work outside. Okay, and if you work outside, bring food from home. Stop worrying about what people think. Stop kicking it at work. Some of y'all are kicking it at work. Stop getting food with the homies. Stop. Okay, at work, do something. Upload. Hop on the charts. Do something while you're on break. Okay, but some of y'all are wasting time. Okay, the more time that you waste, the more you'll be in the infinite loop. Okay, so the more that you wake up the next day, you're like, oh, I really don't want to do this. It's okay. Did you wake up? Did you continue to grind when you were frustrated? Okay, did you continue to grind when things weren't working out? Okay, and really ask yourself, what type of position do you want to be in? All right, let's talk about some technology and decentralization. All right, ask yourself, what are you investing into? Okay, before committing any type of capital, any type of money, a Stackmode investor performs deep ethical due diligence to ensure that the investment aligns with righteous principles and sound technology. Okay, is it helping the earth? Okay, or is it destroying God's beautiful earth? Really ask yourself these questions. Okay, because stuff like that might steer people away from investing into it, or certain ethical laws coming into place destroying it. Okay, keep that in mind. So technology and decentralization. So is the code open source? And who controls the protocol updates? And high decentralization and clear governance reduce single points of failure and central authority risk aligning with self-sufficiency. To the team in the community, right? Ask yourself, does the team has a track record of integrity? Okay, this is what I mean by keeping it halal. Okay, does the crypto token you're investing into, do they have a history of scamming? Okay, do they have a history of activity that's just not normal like other tokens? Okay, is it heavily advertised? Heavily advertised tokens, right? Being pushed by hashtags, tweets, things like that. You gotta watch. Okay, you gotta watch. Okay, make sure you guys do your extreme due diligence, and especially new tokens. Watch the way new tokens move. Okay, if a token just comes out and it's advertising that it's going to be the best and strongest and most lucrative token of all time, you gotta watch that. Okay, watch that. Watch that. Do your research. There's also things you can look at on the order flow. You can see a percentage actually of who owns the token. Okay, so if you start seeing lucrative advertising about it, crazy talk, okay, talking about it's the new Bitcoin and things like that, okay, do your research on the order flow, okay, see who has a percentage of it, okay, and if you see like over 60% of the coin is owned by one person, most likely it's a rug pull, okay, so be careful, all right. There's going to be a lot of deceptive people and things out there. Okay? I don't want you guys investing in your money into things and then getting finessed and robbed for absolutely no reason because someone wants to be lazy. Okay, so be safe. Okay, be safe. And ask yourself, is the asset supply transparent? Okay, is it inflationary or deflationary? That's going to help too. Okay, so if the world is going to shambles, are people going to be looking to invest into it? Okay, that's why people invest in things like Bitcoin since it's a limited resource. That's why things like gold go up in value when the world goes in inflation mode. Okay, since the dollar becomes useless, something has to be of value. So let's run to the limited resource that God put on this earth. Okay, so then we're gonna have power as well too. Okay, which is also created by God's resources. Okay, but we're gonna have oil. Okay, or we're gonna have solar, which is used to once again create things like Bitcoin. Okay. And ask yourself, okay, what would I get out of this token if I were to be the only one to have it? Okay, would anyone care? Okay, if you had keyboard coin, would anyone care if you had keyboard coin? But if a really popular coin went away right now and people couldn't buy it, would people be upset? Okay, how would you be treated? Okay, what type of benefits would you gain? We don't know what type of world we're going to go into. So especially limited coins, I really advise taking a look into that and seeing if it'd be a decision that you'd want to check out, okay? Like Bitcoin, for example. So position sizing, okay? Don't trade with what you can't afford to lose, okay? Please pay your bills first. Please, please, please. Let me tell you guys another crazy story, all right? So there's one time I put my whole work check into the account. I lost my whole work check in like 5 minutes. Let me tell you this story. All right. So I got the work check. And what I did was I put it into the account. Okay. This was a few years ago. So I put it into the account and it was some futures. Okay. And at the time, I think it was a J Powell news day. Okay. So market was just landsliding. So what I was doing, right, like a genius, right, guys? So I was trying to long the market. Okay, so while the market was falling, just in an extreme knife, okay, I'm there trying to long the market. And I just lost all my money in like 5 minutes. Okay, playing with too much size, literally crashed it out. Just pretty much crashed out the whole check. And I remember withdrawing maybe like $200 left. Okay, and I was like, okay, what did I do? Okay, really reflecting on the decision that I just made, and that like destroyed me. Okay, so don't trade with money that you cannot afford to lose. Please, for the love of God, pay your bills first. Pay your debt first. Get some food first. Okay, you do not want to put your money into all your investments and then you can't survive. You don't want to be in that position. That's backwards. Okay, I will always keep pushing this. Okay, make sure you guys please pay your bills and get some groceries first. When your bills are paid, you got groceries in the fridge, you're good. Okay, then you can live broke. Then you're good. Okay, then live broke. Until then, please take care of your stuff for the love of God, I'm begging you, take care of your stuff. Please. I don't want you guys to go. It's very stressful if you go through certain things, okay? If you have too much debt, you got to file bankruptcy. No one is giving you a crib. Life gets extremely more stressful if you go broke, okay? God forbid, when certain things happen, life just becomes extremely difficult. Okay, the world treats you a lot different. Okay, if you file for bankruptcy, they're gonna judge you whenever you go try to get a house. Okay, you could be in a completely different financial position. Okay, but even if you try to rent, they're still gonna see that on your record. Okay, so take heed of these things. Okay, so really take care of yourself, take care of your debt. Okay, and just clear that for yourself or your future family. Okay, you don't want that debt to be falling on them too, because they'll really come and try stuff like that as well. Okay, so bringing me into that, please don't leverage trade. Don't leverage trade and just avoid crypto futures. Okay, I don't care if you guys think you're the best trader in the entire world. Please don't trade crypto futures. Okay, just don't do it. Don't do it. Okay, we don't want to be trading with leverage. We want to be trading spot. SPOT. Trade spot, keep stacking your cash, take your time, let your money stack and build over the course of months and years. Okay, why are you trying to rush? Okay, because I'm telling you, once you guys hop on that crypto futures, okay, especially when you don't have any type of discipline or rootedness built up, it can be scary. Okay, you can realize your true self, you can realize how undisciplined you truly are, and it can make you crash out. Okay, once again, making you destroy all of your money extremely quickly, or even worse, owing the broker money. Okay, when you're trading with things like leverage, you're borrowing funds from the broker in order to play a higher position size. Instead of playing a position size that would be normally relative to your account, you're then borrowing it for an X amount multiple. So if you lose, okay, you're going to be responsible for that type of loss. Okay, so always keep things like that in mind. Even if you have a stop loss placed down, if price action is too quick, price can easily run through your stop loss and it might not fill exactly where you might think. Okay, market is not perfect, only God's perfect. Okay, so even the market has some issues. Okay, you could have a smackdown stop loss place and market could run straight through it, making you to lose making you to lose more money than you think, or just liquidate your account. Okay, so yeah, the same thing, but if you liquidate your account, that means your funds are going to go down to zero and you're going to be sick. Okay, and then you're going to owe the broker money. Okay, once again, all things that I'm telling you guys from experience. Okay, and then the broker is going to send you that email quickly. They're going to be right there. They're going to need that. Okay, you got to go ahead and wire transfer that money. Boom, because if you don't do that, they're sending those court papers. Once again, stress that you don't want to be going through. Okay, you want to be living life on chill mode. You don't want to be dealing with court. You don't want to be dealing with bankruptcy when you're trying to get a crib and they're judging you. You don't want to be dealing with things like that. It just makes life extremely difficult and hard for no reasons. Take care of yourself. All right, pray for strength, keep hustling, and putting that money away. Stay in stack mode. Your future self is going to thank you. So, primary goal, right? Convert these digital gains into stable, physical, or income producing assets. All right. Once again, having no debt. Clear all that debt out. Okay. Wipe it all out. You guys don't want any payments haunting you as soon as you wake up, like, oh, the bills are due and stuff like that. You don't want that. You don't want to be living like that. Okay. All right. The bills are going to kind of always be due, but you don't want it to be stressing you out. Okay. You want it to be like, you know what, bills hit, and, be happy. Be like, it's something to grind for, something to hustle for. Be grateful to God that you can even be in a position to take care of yourself and pay what you need to pay. But if you're waking up and stressing like, oh, the bills are here, and saying it's a different position, okay? You don't want to be like that. Life hit different when it's that, okay? I don't want you guys to be feeling like that. Okay, let's live. Let's have fun. Let's take care of ourselves and let's be happy. And targeted partial sales, okay? So try to sell in predetermined small increments, okay? So instead of just selling all 100% of your asset, unless you have a predetermined target and take profit where you want to close a position, that's a different story. But if you're investing something, say you like, I want to hold this until I die, or I want to hold this asset, etc., or you leave the crypto password for your kids or whatever, anything like that. If you just want to have it as a infinite family account or whatever you want to do, right? Try and sell in partials. That way is because you never know what's going to happen. You never know what type of multiples or how high a price jump is going to happen. Okay, so just keep some increments in there, and maybe that small increment will, even if you sell like 80%, maybe that 20% might turn back into 100% over the course of some years, and keep letting it stack, inshallah. Okay. So the most powerful investment principle is consistency. Okay. Wake up, pray every single day. Okay. Try and work out at least like 3 to 5 times a week. Go hard. Okay. And stack away that money. Please take care of your bills first. Get something to eat, some groceries, and then you're good. Stay broke. Okay. Put some gas in your car. Get a full tank if you go to work, and that's it. Okay. Get yourself some Tupperware. Bring your lunch to work if that's what you do. Okay, or if you work from home, you don't need to be ordering no type of DoorDash things right now. We're staying out. Okay, until you have at least 6 figures. And I'm realizing as I stay in stack mode, I'm like, yeah, it's really just about consistency. Okay, so running up things like 6 figures, right? It can be possible, especially within like a year and a couple of months if you're going hard, putting away the cash that you need to, and investing in the right things. Okay, so stay hard, guys. All right, step right up to God, keep grinding. I'm gonna catch you in the next one. Head over to Stackmode on that for all trading education.
You might think that inflation is a normal part of life, but the reality is that your purchasing power is silently being stolen from you every single day by the very institutions claiming to protect it. Central banks have the power to print infinite amounts of currency at the push of a button, which dilutes your savings and forces you to work harder just to stay in the same place. They control the supply, so they control the value, and Bitcoin completely flips this power dynamic on its head. It's the only asset in human history with strictly finite supply that cannot be altered by any government or chairman. There is no backdoor and there is no print button because the code is absolute. And while fiat currency relies on trust in politicians, Bitcoin relies on mathematical verification, and it's created by actual power and resources. This is not just about digital currency or making a quick trade. This is about the separation of money and state and ownership. In this video, I'm going to show you exactly how Bitcoin renders the central banking model obsolete and why it's the ultimate hedge against the system designed to devalue your life's work. Let's dive into it. Let's go and let's jump into how central banks hold a monopoly on the money supply. So as you know, things have to be systematically processed when it comes to central banks' systematic formations, such as wire transfers or direct deposit, for instance. Certain things have to hit on certain days and certain time frames due to the fact that approvals have to be made by the centralized banks. Now, when we're trading cryptocurrency, you're working in the decentralized world. Everything is way different. Okay, everything is based off the peer-to-peer transaction system. Everything works off of smart, autonomous contracts. So whenever transactions are sent over, pretty much computers do all the processing. When you send a wire transfer over to somebody or even to yourself to another bank, the bank has the ability to approve or decline that. Cryptocurrency puts the freedom back in the people's hands. And let's go and let's jump into how all this works and why central banks really don't like this. Let's talk about the loss of monopoly. So central banks manage the economy by printing money, which is quantitative easing or pretty much restricting it. And Bitcoin supply is fixed at 21 million. So it having that fixed statistic baked into it, one, not only makes it more scarce, but it's going to have a more baseline stability cooked into it, and inflation is going to be a lot more manageable. When it comes to fiat currency, you can pretty much print infinite dollars nonstop. That's you might see things from 10 years ago might cost completely differently from today, since more money has been printed over the years have gone over. Okay. And the competitor. So for the first time, citizens now have a viable opt-out option. So if a central bank debases its currency due to inflation, people can flee to things like Bitcoin, and this forces central banks to be more disciplined, limiting their power. So you might have seen things recently, as of 2025, when this video is coming out, banks are now starting to incorporate certain things like Ethereum, XRP, and Bitcoin systems within their system, since they know that people are now looking towards cryptocurrency to manage their money or even hold their savings. So instead of getting 2% or 3% APY stands for annual percentage yield, people rather go put their money into a cryptocurrency and let their money grow faster at a rapid rate. And not only that, it's going to be a lot more manageable too. If you go to the bank, if you have 10 bands, you go pull up on the bank, a lot of the times you're not going to be able to pull that out right away. You might have to come back tomorrow, the next day, because the bank has your money pretty much invested. Okay, so if our money's parked in the bank, it's going to be their money too. It's being used. That's why certain things like Zelle have withdrawn deposit amounts, because they don't want people just pretty much managing their currency how they want. Cryptocurrency takes that all the way. If you want to send $1 million today and tomorrow, you can do that. With the normal traditional central bank based off of fiat currency, they're not going to let you do that, since that puts too much freedom in people's hands, and a lot of business moves can be made a lot quicker. So instead of the banks having the power, now people have the ability to build certain things like banks, their own hedge fund systems, and their own funds, etc. So now people have the ability to have some more individualization for their family even as well too, versus having to run to the banks every single time. So back in the day, people would have to keep all their cash in the banks for the most part. Okay, things aren't like that today. Now you have the ability to even keep your cryptocurrency on something small like a USB drive. Okay, so keeping it extremely decentralized, and the IRS can't get to your USB drive unless they raid your house and find it or things like that. Okay, so no more having random money put out of your account, or even if you get sued, for example, they can go into your bank accounts and clear you out. If you have your money parked in cryptocurrency, that's money that they can't touch, and it's pretty much digital cash that nobody really knows that exists. So let's talk about the threat of censorship resistance. The modern banking system is used as a tool for geopolitical control and surveillance. Big on surveillance. They want to see every dollar that's coming in and out. A lot of things have been changing recently too, since 2020 plus. As far as cash, for example, you can't really use cash to get certain things. Like a lot of realtors and realtor companies won't accept cash for certain down payments, since you can't really prove that you're a real legitimate person and where that money's actually coming from. Okay, so central banks want to make sure everything is controlled, and pretty much don't want you to have freedom for certain ways that benefit them every single time. Certain ways it does protect society, but for the most part, things aren't always fair and realistic, because it is the world. So if somebody's working hard at their lawn mowing business and they've been stacking up cash, okay, their money shouldn't be obsolete. So now you have things like cryptocurrency where you're going to be able to send that over to your bank account, and then you could file your taxes and do things a little bit more legitimately there, versus just having random cash come out of thin air and then you deposit it and they're like, well, where's this coming from? Okay, so your cryptocurrency can be baked in and a little more hidden, and it'll help you out in a lot of ways too. And Bitcoin is really a neutral, permissionless network, and it helps you bypass sanctions. Systems like SWIFT allow the US to cut off nations or individuals from global finance. And Bitcoin operates on the peer-to-peer network, just like we talked about in the previous slide. Meaning if you want to send $1,000 to somebody in Africa, you can instantly do that within the next couple of minutes if you wanted to. Okay, if you want to do that via PayPal or the traditional bank system, it's going to be a lot more difficult. They're going to put some type of hold on it, have to verify your transaction, and it's going to be just a lot more difficult overall, making financial blockages significantly harder to enforce. And financial privacy is going to be a big factor as well too. So Bitcoin is going to be pseudo-anonymous. Central banks and governments prefer total visibility due to the fact that KYC laws are in place, know your customer, and AML, to track taxation for the most part. So pretty much just the government wants their piece of the pie when it comes to any type of currency. So a decentralized ledger obscures the identity layer that they rely on. So certain things like the SEC were fighting with Bitcoin legislators, etc., and that led to certain dips. But now the US government and other governments have started holding the currency themselves, and certain laws have been getting passed. So central banks are trying to gain control, but for the most part, Bitcoin at the core forefront of it is still peer-to-peer and a currency based off of freedom. So we'll jump into the neutralization of interest rates. Interest rates are going to be the steering wheel of the economy, and Bitcoin creates a parallel system that doesn't respond to that steering wheel. And the liquidity trap. When the Fed lowers the rates to stimulate the economy, they want people to spend pretty much. So if people instead borrow cheap fiat to buy Bitcoin, which is a store of value, since especially it has a limited cap, giving it scarcity, which is immediately going to give it value, the stimulus leaks out of the real economy and into crypto assets, because people are starting to wake up as well. And broker and transition mechanisms are going to come into place. If a significant portion of the economy uses Bitcoin for settlement, central bank decisions, which involves raising or lowering rates, affect fewer people, rendering the central bank increasingly irrelevant. So it's like trying to slow down a car by pressing the brakes, but the car has decoupled from the wheels. Okay. So Bitcoin's coming in to solve a lot of problems, especially now since people are starting to be more open to international travel too, and living in certain other countries, especially US citizens. And you're gonna, instead of have to go through certain transfers for your US currency, you can easily just keep everything in cryptocurrency and spend that all over the world simply, instead of having to go through that headache of a transfer system. And let's talk about CBDCs, the counter move, and what are they doing about it? So they're copying tech, but keeping the control, and enter the central bank digital currencies, and it's programmable money. So unlike Bitcoin, CBDCs are centralized, and governments could theoretically program money to expire, which forces spending, and restrict what you can buy with carbon limits or freeze accounts instantly. And definitely total surveillance is going to come into place too. So a CBDC ledger would give the state a real-time view of every single transaction in the economy, eliminating the concept of cash-like privacy entirely. And they market CBDCs as safe, convenient Bitcoin, but the reality is that it's the exact opposite of Bitcoin ethos of decentralization. So keeping the freedom in the people's hands is really the main point of crypto. Yes, there's money involved, but honestly, you can make way better profit doing other things, such as like trading futures, for example. Even if you trade crypto futures, that's gonna be way more profitable than holding and keeping spot. But as far as you holding your Bitcoin, your cryptocurrency, you're really doing it for your ownership and your assets. Okay, having ownership, especially in something that helps the future, is what's going to help you prepare your forward and keep your money in that constant cycle. So instead of you being on the hamster wheel, put your money on the hamster wheel. Have everything flow. Okay, so after you get that big bag from futures, let's say for example, you know to go ahead and throw it into Bitcoin, which consistently makes profit year after year after year after year. So instead of you having to hustle and bustle forever, you could maybe sit down and chill because you have enough money from hustling, bustling, stacked in your investments, and then your wheel will be spinning forever. Okay, so if you decide to use your fiat currency and throw it into something that's gonna help your money flow into the hamster wheel, inshallah, you'll have a lot easier time. So they try and stop everything, just like they try and stop certain herbs as well too. They can't stop the Bitcoin network itself since it's distributed globally, and they target the entry and exit points and targeting on ramps. So regulators pressure banks to not do business with crypto exchanges, even though they're starting to do it anyways, because they know people have to sign up for their banks, otherwise they're going to crumble. So if you can't transfer fiat to an exchange, it becomes very difficult to buy Bitcoin. And let's talk about some regulation by enforcement. So instead of creating clear laws, agencies like the SEC sue crypto projects to drain their resources and create uncertainty, driving innovation offshore. But thank God, it's been a lot of righteousness going on. Certain people have been getting freed from jail, such as like the Binance creator and Bybit and stuff like that has been starting to get back on the United States soil. So a couple of years ago, around 2022, 2021, they started locking people up for enforcing certain cryptos or creating certain crypto brokers such as Binance and stuff like that. Thank God certain people have been freed, and just really things have been changing, and the crypto future is starting to look bright, especially since the US government now owns hundreds of millions of dollars worth it. That's really a solid and good factor, letting us know that, okay, the US doesn't want to fall behind since other countries also own hundreds of millions of dollars worth it too. Okay, so instead of being stubborn, the US is now actually turning on their brain, and that's leading crypto to future all-time highs, since the US dollar is the global currency of the world. But we never know, within a couple of decades could be Bitcoin. So a lot of things are changing, exciting time in the world, and central banks are pretty much on a game theory buy. They can't end Bitcoin. The network is way too resilient and distributed, so they're pretty much trying to conform because they know people are starting to wake up. The righteousness is starting to oversee the darkness in the world for sure. People are starting to care about their health, want freedom for their money, and people might have family in other countries too. And you can easily help out your family in other countries with cryptocurrency. Once again, not as easy to do that if you're sending straight fiat in any country you're in. And they can't ignore it. Okay, it's sucking liquidity out of the fiat system. People are no longer keeping their money stacked inside of savings accounts, getting that 2%, 3% APY that most banks take advantage of in order to make profit. People are now just taking that money and putting it right into cryptocurrency. Even the same thing with credit too. A lot of people are starting to wake up when it comes to credit. Instead of balling out, just buying things, people are now taking that, either they're investing in all of it into some kind of business and buying cryptocurrency, buying any type of shares that they can too with the cash that you can extract from the credit card if you can't extract the whole thing. So the likely outcome of everything, integration, and that's been slowly happening. A lot of banks are starting to finally realize, and as we start seeing more younger people get into CEO level positions, I can see things change as well too, inshallah, especially as Trump come into office. The crypto support has definitely been in significant rise. So banks will eventually have to custody Bitcoin and treat it as a reserve asset, just like gold, because they know people aren't going to be going for anything else. Okay, people are now more open to leaving the U.S. more than ever. So now the U.S. is very desperate to make the right decisions to keep people here and keep America going forward. So this fundamentally changes how the global monetary system operates in the long run. And a really small percentage of the world only owns Bitcoin. So don't think that you're too late. You're really, really early. And there's a limited amount. Okay, you don't want Bitcoin to be mined up and be like, oh man, I wish I bought Bitcoin in 2025. You don't want to be doing that. Okay, I don't care if you got $5 in your account right now. You don't need to be buying nothing. Go buy some Bitcoin. Okay, live off the credit card, spend all your cash on assets, and watch how your life change. Wake up, pray to God, take care of your family, stay down, and get in stack mode. I'm gonna catch you on the next one.
Thank God. Let's go and let's talk about what this means for the future of trading and how new traders can go ahead and jump into the market a lot easier now. So let's understand what the PDT rule even is. The pattern day trading rule, as defined by the Financial Industry Regulatory Authority, the FINRA, it was a crucial regulation that governed day trading in the United States. Instituted in 2001, it was created to protect inexperienced investors from the substantial risk of frequent leverage trading during the dot-com bubble. So they didn't want people just throwing in all their bread and losing it all for no reason. Okay, when a bunch of new companies were hitting the stock market. Okay, so the pattern day trading rule was pretty much created in order to protect people. So the $25,000 equity requirement. So to be classified as a pattern day trader, okay, PDT, you need to execute 4 or more day trades in a margin account within a 5 business day period. Nowadays, there's 2 types of accounts. You have cash accounts, okay, which lets you trade strictly with your own money. And then there's margin accounts, okay, which lets you trade with some borrowed funds when it comes to the broker. Okay. And once flagged, your account was required to maintain a minimum equity of at least $25,000. And if the balance dropped below this, day trading was then restricted. And what's a day trade in the first place? A day trade was defined as the purchase and sale, or sale and purchase, of the same security within the same trading day. So let's say, for instance, I purchased Stackmode stock for $30 a share, and I sold it for $34 a share within the same day. Let's say I did that all on Monday. Okay, that is a day trade. If I bought Stackmode stock for $60 a share and sold it for $80 a share, okay, and I bought $60 a share on Monday and I sold $80 a share on Friday, okay, then that's not going to be a day trade, because that was days later I sold. I bought on Monday, sold on Friday, not a day trade. But if I buy on Monday, sell on Monday, that's a day trade, okay? So if you buy and sell within the same trading day, that's a day trade. And this rule applies to stocks, options, and ETFs. And the purpose of this rule: the primary goal was investor protection, and the rule ensured that traders engaging in high-risk strategies had sufficient capital to absorb potential losses, thereby protecting both the individual and their brokerage firm from financial instability. So the historic regulatory shift of 2025. So as of September 2025, FINRA's Board of Governors has officially approved amendments to replace the pattern day trading rule. Exciting. This is one of the most significant changes to day trading regulations in over 2 decades. And the move comes as a response to the rapid advancements in trading technology and real-time risk management capabilities of modern brokerage firms. So the fixed threshold is now gone. The rigid $25,000 equity requirement for day traders has been completely eliminated. This removes a major barrier for entry for retail traders. And retail traders, if you ever hear that term, it's just people who just want to get into the market. Okay, not like hedge funds, banks, or anything like that. Just individual investors a lot of the time is what retail means. So individual investors and individual traders with smaller accounts who were previously unable to engage in frequent trading can now do it. So replaced by intraday margin framework. So the old rule is replaced by a more dynamic and flexible intraday margin framework. This new system applies existing maintenance margin rules to a trader's real-time intraday exposure, making it a risk-based approach rather than a capital-based one, and pending SEC approval. While FINRA has approved the change, it must still be filed with and formally approved by the U.S. Securities and Exchange Commission, SEC, before it can fully be implemented. So traders should continue to operate under the existing PDT rule until a final effective date is announced. Okay. So FINRA approved the change, and we're still waiting for it to get approved. Implications for traders, a new era. The removal of the PDT rule represents a seismic shift for retail traders, particularly those with smaller capital bases. It promises a more accessible, albeit more complex trading environment. So lower barriers for new traders. So the most immediate and profound impact is the ability for new traders with accounts under $25,000 to execute frequent day trades without restrictions. This democratizes active day trading and opens the door for a new generation of market participants. More dynamic buying power. Under the new framework, buying power will be directly tied to the risk of positions a trader takes, and highly volatile securities or concentrated positions will consume more margin quickly, while stable assets will allow for more leverage. This requires traders to have a better understanding of margin mechanics before you lose all your money and blow your account. An increased importance of risk management. Since the fixed capital floor is now removed, risk management becomes paramount. If you don't follow your rules, if you're not disciplined, if you don't humble yourself, okay, if you don't wake up, pray to God, study the charts, work out, have a strict routine, journal all your trades, you won't be successful. Okay. You have to be extremely, extremely disciplined when it comes to this game. And it's about keeping up this bread, keeping up getting this money year after year after year. It's not about just making 7 figures in 1 year. It's about doing it again the next year, maybe scaling to 8 figures, 9 figures, and pushing yourself further based off the discipline consistency. Risk management is going to become paramount. Okay. The more power that you have, the more power you're going to have to control. And traders need to be vigilant about their intraday exposure to avoid margin calls or forced liquidations. Forced liquidations is where the market is going to pretty much automatically close your position for you. And if you don't pay the money back that you owe the broker because you're paying with leverage, which means they're giving you capital, then you could be subject to court fees and they could owe you money, or you have to owe them money. Okay. So diving deeper into the intraday margin rule. The intraday margin framework is a sophisticated replacement for the outdated PDT rule. Instead of a blanket restriction, it uses real-time metrics to determine a trader's capacity for risk. And here's how it works. So real-time calculations. Brokerage firms will now calculate and enforce maintenance margin requires throughout the day. This provides a more accurate and responsive measure of a trader's risk level. So position-driven leverage. Your trading leverage will no longer be static. It will fluctuate based on the specific positions you hold, their volatility, and the concentration of your portfolio. So for example, a highly volatile tech stock will consume more margin than a blue chip utility stock. And the impact on different strategies. This can make strategies like scalping or fast-paced equity trading more viable for smaller accounts. However, it also introduces a new layer of complexity, requiring traders to understand the specific margin impact of each security they trade. So here's an example scenario, trading under the new rules. So let's consider a practical example of how the new intraday margin framework might work for a trader with a small account. So let's say, for example, Alex, right? Okay, let's use that name for example. Let's say Alex has a trading account with a balance of $5,000. He wants to execute more than 3 day trades in a week, which was previously impossible under the PDT rule. So in the old rule, Alex would only be restricted to 3 day trades. He could not execute a 4th one, regardless of the quality of the signal or his risk management, okay? Because it's 3 trades in a week. Now with this new rule, Alex can now make a 4th, 5th, or even 10th day trade, and his ability is no longer limited by a number of trades, but by the intraday margin available in his account. And his broker monitors his risk in real time. And if he takes a position that's too large or too volatile for his account size, the broker system will simply prevent the trade. So risk and key considerations for traders. While the new framework offers unprecedented freedom, it's not without its own set of risk. Traders must be prepared to adapt their strategies and mindset. You can be subject to intraday margin calls, where unlike the old rule where you were protected by a fixed floor, you may now face intraday margin calls. If your positions move against you, this requires immediate action and could lead to forced liquidations. And education is going to be paramount. Understanding concepts like maintenance, margin, concentration limits, and intraday exposure is now a non-negotiable part of a day trader's playbook, and a lack of knowledge could lead to significant losses. And firm-specific rules. While FINRA sets the regulatory minimums, individual brokerage firms are free to impose stricter rules, and traders must be aware of their broker's specific policies, as these can vary significantly. And the removal of the 25,000 PDT rule, it's really just a monumental step towards monetizing day trading for brokers so they can make more money. And it's a monumental step towards modernizing day trade regulations, making it more accessible for everybody. Okay, so God is good. It's an opportunity for you to come on the charts and make some money just by being disciplined. Make sure you get informed. Head over to Stackmode for all trading education. And this rule is going to make trading more accessible. Okay, it's going to bring more volume to the market. More people are going to start trading, inshallah. Okay, and it's also going to come with an increased amount of responsibility. With more power comes more responsibility. Okay, love you guys so much. Stay prayed up with God. I'll catch you in the next one. Keep grinding. Peace. I'm gonna go ahead and talk to you guys about how to make money with the stock market. I'm gonna break down all the basics. Let's go and jump into it. So what is a stock in the first place? At its core, a stock, and it's known as an equity. It's a security that represents a fractional ownership in a corporation or company. When you buy a share of the stock, you're buying a small piece of that company and a percentage of it. That makes you a part owner, or what's called a shareholder. And it gives you a claim on a portion of the company's assets and earnings. And companies issue stock for a primary reason, to raise money for growth. Instead of borrowing money from a bank, a company can sell shares of ownership to the public through an initial public offering. This capital allows the company to expand operations, develop new products, or fund research. And we'll talk about two types of companies, public companies versus private companies. A private company is owned by a small group of investors, and it's often its founders. A public company, on the other hand, trades its share on the stock exchange, like the New York Stock Exchange, or the NASDAQ, and anyone, such as me and you, can buy these shares. And there's going to be shareholder rights involved, and as a shareholder, you typically have voting rights on important company matters, such as electing the board of directors, and the more shares you own, the more influence that you have. And when you buy a single share of Apple stock, you become a tiny part of the owner of one of the world's largest companies. And your ownership stake, while small, means you have a claim on a fraction of Apple's profits, for example. And two ways to make money with stocks. So there's two ways. One, capital gains. This is the most often and most common way that people make money. And a capital gain is the profit that you make when you sell a stock for a higher price than you paid for it. And the goal is simple. Buy low and sell high. The difference between the selling price and the purchase price is going to be your profit. So for example, if you purchase 10 shares of a company, say company A, at $50 a share, and a year later, let's say the company's been grinding, they've been dropping new products, they've been helping out people, okay, the future innovation has been coming into play. A year later, the stock's value rose up to $75 per share. If you sell 10 of your shares, you make a capital gain of $25 per share for a total profit of $250. And that's before any taxes or fees. Okay, so that's capital gains, just standard profit that you make by price going in an upwards direction. Okay, so the more companies decide to innovate and stuff like that, then capital gains is going to relate to that. So let's talk about dividends. Dividends are a portion of a company's earnings that it distributes to its shareholders. And not all companies pay dividends, but many mature, profitable companies do. They're typically paid out quarterly in cash, and they represent a passive income stream for investors. And companies that pay dividends often do so to attract and reward long-term investors. So for example, if company B pays a quarterly dividend of 50 cents per share, if you own 100 shares, you would receive $50 every quarter. And this adds to $200 in passive income over a year, in addition to any capital gains you must realize. Okay, so the more shares that you have, the more that you're going to get paid out in dividends. Okay, so you can stack up on certain shares and you'll get paid on dividends depending on certain parameters. Do your research before you invest. So speaking of research, let's talk about the importance of it. So to be a successful investor, you have to do your homework. Making informed decisions is going to be crucial to minimize your risk and maximize your returns. You want some bread, right? It's time to be grinding harder than ever. It's time to be staying down, putting that bread away so we can have more bread to put into our investments. And let's talk about fundamental analysis. This method involves evaluating a company's financial health to determine its intrinsic value. And you look at factors like its revenue and earnings. How much money is the company making in the first place? And is the company growing? And we'll talk about the PE ratio, price to earnings ratio. This compares a company's share price to its earnings per share, helping you understand that if a stock is over or undervalued. And management and market position. Is the company's leadership strong? And does it have a competitive advantage in its industry? For example, A company with consistently growing revenue, high profit margins, and a strong balance sheet is generally considered a good long-term investment. Conversely, a company with declining sales and a lot of debt may be a risky investment. And diversification. This is the strategy of spreading your investments across different assets to reduce risk. And the old saying, don't put all your eggs in one basket, applies perfectly here. Okay. And only God is perfect, but it's a great scenario here. And this is by investing in a variety of different sectors. Let's say AI, cryptocurrency, healthcare, whatever is going to be used to progress the markets forward. Okay. It's going to be a potential factor that you could invest in and make some money in. So let's talk about some investing stuff. So investing in general is a long-term strategy, and investors typically buy stocks with the intention of holding them for years or even decades, and they focus on the fundamental value of a company and its long-term growth potential. And they are less concerned with short-term market fluctuations. Some key characteristics: time horizon. Okay, it's going to take years to decades and months, days sometimes to make some great profit from shares. Okay, but sit on your trades, let them cook. Okay, let your trades hold for a long time and gain APY, also known as annual percentage yield gains per year. Okay, let your money stack up, and the longer that you hold, let's say you hold for a year, then you're going to be subject to a lot of tax benefits. Okay, and have a good mindset. Be patient. Okay, God says be patient and stay focused on the fundamental growth. And you're trying to build wealth over time for retirement or major life events if anything happens. Okay, so have your checking account, have your maybe savings account, your business account, and then have your trading account money. Okay, all separated, and make sure you're doing your taxes. And trading. Trading is a short-term strategy, and it's where traders buy and sell stocks frequently, and it's often within the same day. Okay, and that's called day trading, whenever you're closing a position within the same day and opening it within the same day. And swing trading means holding a trade for over a day. Okay, it could be for a couple of days, a week, months, or years. Okay, and they heavily rely on technical analysis to spot patterns and indicators for quick profits from short-term price movements. And some key characteristics: time horizon. Okay, for day trades, you can hold from minutes to hours. Okay, and that's any trade close and open within the same day. Okay, and swing trading can go from minutes to months. Okay, to minutes to days. Okay, so as soon as you open your contract, as long as you're holding it for over a day, okay, from the minute you open it, as long as it's open for over a day, that'd be considered a swing trade. So the mindset, okay, you can either if you're like a futures trader, for example, and you can't afford the full margin, then you're going to be forced to be a day trader. But if you're a stock trader, okay, for example, okay, or you trade stock options, then you're going to be able to hold for many months, many days, depending on the contract that you buy. Or shares, you can go ahead and just buy and hold for days, years, and months, and use this in order to generate income. And even from day trades, take that profit. Don't go buy LV, don't go buy the Lamborghini just yet. Stay down, reinvest it into profits, reinvest it into shares. Okay, buy some more stocks. That way your money's gonna always be making you money, and then go ball out later on. Okay, stay down first, trust me. You don't want to be going broke or be getting into debt because you didn't invest. So some common investment strategies. Choosing the right strategy is going to be key to success. And here are the two most popular and accessible ones. One, DCA, so dollar cost averaging. And this is a strategy where you invest a fixed amount of money at regular intervals, regardless of the stock's price. For example, investing $100 in a stock every month. This approach averages out your purchase over time, reducing the risk of buying at a market high, and it's simple, disciplined way to invest. So for example, and don't be buying at all-time highs. Do your TA, do your technical analysis research, make sure your chart lines up with what you want to invest in. Okay, don't buy at all-time highs. Wait for a pullback, and if you're struggling with how to identify pullbacks or you don't know what to buy, head over to stackmode.net. So, for example, in January, for example, if you buy one share of a stock for $100, in February, you'll buy another share for $90. In March, you buy a third share for $110. Your average purchase price is now $100. If you had invested $300 all at once in January, your average would be higher. Okay, and value investing. Made famous by the legendary investor Warren Buffett. Okay, value investing involves finding stocks that are trading for less than their intrinsic value. And value investors look for bargains in the market. So look for lows Okay, we're going to be going over certain lows, and let's go ahead and break down the chart with certain things. Okay, so when it comes to breaking down certain lows, you need to understand support and resistance first. So resistance is going to be the area where price is going to be falling in a downwards direction, as that's due to the fact where sellers came in. Okay, so let's take this example for here. So I can see here that there's going to be resistance above current price. Okay, I can see that price open the same year that this video is going to be recorded in. I'm expecting a big sweep here. Okay, due to the fact that I see, okay, the IPO, initial public offering, hit the stock market here. Okay, shares went down. Looks like it created a low here at this area of support, and I can assume that price wants to sweep up to an area of resistance. Okay, so always understand that within the stock market too, price is going to always be trying to chase and break areas of resistances. That's going to be the main goal of the stock market. Okay, so once again, price is going to try and chase and break areas of resistance. It's not going to keep falling at the same areas of resistances forever. Okay, one day, inshallah, the company's going to grind, drop a good product. Okay, investors are going to invest into it. They might collab with some other company, and resistances are going to be broken because there's going to be investors putting money into it, increasing its value, thus increasing its share price. Okay, so a lot of the times in the stock market, I'm looking to play within a bullish scenario. I personally don't really short the stock market too much because I know that it's a left to right chart. Okay, I know that any good stock, for the most part, I can see here from left to right, from year after year, it just goes in an upward direction. Okay, no matter how many pullbacks happen, the goal of the stock market is to go in an upwards direction because companies are working hard, hiring customers, waking up, grinding, okay, and putting their all in order to grow the company, inshallah. Okay, so technicals are going to be really the simple part. So let's get back into the lesson. So value investing. Okay, value investing helps you just keep buying in increments over time, buying at certain pullback levels. And some risks to consider. No investment is going to be without risk, and understanding these risks are going to be crucial for making informed decisions and protecting your capital. And remember, past performance is not a guarantee of future results. Okay, past performance is not a guarantee of future results. You have to be consistent. Okay, you have to keep going hard. Okay, you have to keep your head in the game and don't stop. Keep balling. And market risk. This is the risk that your entire investment portfolio would decrease in value due to a downturn in the overall market. And factors like a recession can affect you, global events, or political instability that can cause a broad market decline. And diversification is the primary tool to mitigate risk. Okay, whether it be a certain sectors, healthcare, AI, broker stocks, etc. And inflation. So this is the risk that your purchasing power of your investment returns will be eroded by inflation. That's when pretty much everything gets more expensive in the company. And if your stock portfolio only grows 2% in a year, but inflation's at 3%, you effectively lost purchasing power. And liquidity risk. This is the risk that you won't be able to sell your investment quickly enough to prevent a loss. And this is generally not an issue with major stocks on major exchanges, but can be a factor for penny stocks or investments in smaller, less known companies, for example. And the role of a brokerage account. To buy and sell stocks, you're going to need a brokerage account. And a brokerage is the financial firm that facilitates transactions between buyers and sellers on a stock exchange. And think of them as the gateway to the stock market. And here's what to look for. Low fees on your brokerage account. Many brokerages offer commission-free trading on stocks and ETFs. And find yourself a user-friendly platform. Okay, there's going to be a lot of brokers available. Figure out which one works for you. Okay, it should be easy to navigate, easy to understand. Shouldn't be any type of hidden fees and stuff like that. And research tools. Okay, a lot of them offer good research tools, stuff where you can look at the chart, okay, set alerts, etc. And make sure that the broker has a good customer support team. Okay, you don't want to be having your bread stuck in loops. Okay, you don't want to be having your money stuck in a financial ruin and be going through financial turmoil for absolutely no reason. Okay, so choose a brokerage account that has some good reviews, has a great customer support team, and make sure that it has some insurance too. So in case the broker ever shuts down, you'll be able to get your money back. So that's what regulated is. And make sure you guys just play a good broker that has some money saved up. Okay. For example, a brokerage account is going to be like your bank, but for the stock market. And then you can deposit cash into your account with your card on some of them. That's also going to be something too. Some brokers don't offer instant card transfers, but some do. Okay. but you can deposit using your bank account, wire transfers, etc. And then you can use that cash to place orders to buy and sell stocks on the market. And investing in the stock market involves risk, and this presentation is going to be for educational purposes only, and it's not considered financial advice, okay? Before you make your decisions, okay, pray to God, okay, take your time, and don't lose yourself. Even if you lose money, it's going to be good. You're going to run it up again as long as you stay persistent, okay? Keep going. No matter how many losses you take, no matter how many times you think you're not going to get to where you want to be, ignore all those thoughts. Stay focused. Ignore everything and just stay focused, okay? I love you guys so much. Stay prayed up to God. Keep grinding, and head over to stackmode.net for all trading education. Peace.
So this is going to be the full guide on how to trade options leaps, how to pretty much make options income so you can make a living off of it and just make some great extra income. I'm going to talk about from A to Z what we need to do, the contracts we need to buy, and the type of setups we got to be taking. Okay, so let's go and let's jump into it. So one, okay, we're on the stock market. Okay, so options give you access to pretty much 100 shares. Okay, so once again, options give you access to about 100 shares. So that means that it's a leveraged product, kind of, okay? And the only thing that we fight against is time, okay? So it pretty much gives you 100 shares per one contract to play with. So 100 shares with time added to it equals one option, okay? So a contract is gonna give you 100 shares and it's gonna have time added to it, okay? So now that we know this, okay, we're gonna go ahead and put everything into perspective. So time is gonna be really important, okay? So let's talk about how we can outplay the time and how we can pretty much progress with options. Let's jump into it. So once again, we're gonna be playing the stock market. Options gives you access to play 100 shares worth of value, okay, bundled up in one, okay? But the only thing you're fighting against is time. So I'm gonna talk to you guys about how to outplay that. But let's understand the logical process of what we're playing first. So we're playing the stock market, okay? The goal of the stock market is to go in an upwards direction. And let's talk about why, okay? Why is it going in an upwards direction in the first place? What's the point of buying options, and why do we think price is gonna go in an upwards direction? One, okay, I can get on my weekly time frame here and zoom out, and I can see this company, for example, okay? It's a profitable company since the shares go up year after year after year after year after year after year, okay? So whenever you see year after year after year after year after year progress and chart going in an upwards direction, that generally means that that's a good buy. That's a profitable company and they're doing their thing, okay? So that's gonna be a company that we would ideally wanna pay attention to. So after I see market trending like this in an upwards line, I can put into conclusion, okay, why is it going in an upwards direction? One, these stocks aren't just stocks on the internet, okay? These stocks are real jobs, okay? Real jobs that you might have even worked at in real life, okay? So these jobs employ people, okay? So these stocks aren't just random stocks trying to go up for no reason. They employ people, okay? Which helps the economy, okay? Companies like Microsoft, Google, definitely Amazon, okay? Creating jobs for people so people can protect and provide for their families. So these stocks, they're doing something big, okay? They have a big, 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 big weight attached to them. They help out the economy. They employ people, okay? And the company investors are competitive, okay? They're in competition. So if this is a bank stock, they want to outperform every other bank stock by having the highest share value to prove to investors that whatever they're investing in, and that if they invest in their company, they're going to have the most profitable stock, pretty much. Okay, so there's going to be incentives behind it too. It's going to be really competitive. So the competitiveness behind it makes investors invest into certain companies. Okay. A bank wants to be the best bank. A broker wants to be the best broker. Tech company wants to be the best tech company. Okay. And the best way to compete or show competition and show value is going to be via the stock market share price. If one share price is higher than another company's, that just means that one company is just more valuable than the other. And that's just flat out what it means. Okay. So companies are trying to compete. Okay. Because the share value being in an upwards direction shows how much it's actually affecting the economy. Okay. So that's going to go ahead and be that. So let's jump into it. Okay. So options in stocks have a reason to go in an upwards direction. And the reason why I'm focusing on an upwards direction is because that's the goal of it. Okay. Once again, more jobs are going to be created. And the whole reason stocks put themselves on the stock market in general is so they can raise money. Okay. They want our money to put into their company so then they can turn our money into more money by investing into business manufacturers, getting better or more employees, etc., doing whatever they need to do with our money invested into it. Then that's why companies that are profitable pay what's called dividends out. Okay. They pay dividends out since the company's making so much money. Anybody who's holding shares, they're like, you know what? Here's some money back. Thank you. Thank you for participating and helping us grow. So dividends, they're pretty much going to be a big thank you. Okay. So dividends are a thank you. If you see a company paying out dividends and not splitting them, not reducing the dividends, so you can see this dividend amount was 0.30 back here in 2023, and now it's about 0.40. Okay, that means that they increase the amount of money that they're paying out to people. If they can increase the amount of money that they're paying out to people, they're not struggling. Okay. But when you're penny pinching, okay, I'm sure we've all had times where we're penny pinching down bad. Okay. When we're doing that, then you don't have no money to pay people. Okay. But when you have surplus to pay people out extras more than normal, then you know you're in a good position. Okay. So that's what's going to determine if a company's in a good position or not. If their dividends are increasing and what their earnings is going to be looking like. Okay. So keep those two things in mind before we invest into anything. Now, let's talk about the actual chart itself, how we find a setup, and some stuff we need to do. So the time frames we got to focus on, okay, is our higher time frames. So you can look at your weekly time frame. Your weekly time frame, that's really going to help you put everything into perspective. Okay, your weekly time frame is going to help you see absolutely everything. Okay, it's going to be your eyes. It's going to help you see everything you need to see. Okay, and you're going to get all of your price action viewed. Then after the weekly, you can scale down to your daily. And then after the daily, go down to your 4 hour. Okay, when you're on the 4 hour time frame, let's go to the bottom right and make sure extended trading hours is going to be on. Okay, because what you're going to notice when you're on the daily and the weekly, and then you go to something like the 4 hour, which has extended trading hours, you're going to notice a little bit of differences in candles. So to see the exact candlestick wicks you need to see, do all of your higher time frame analysis, and then go down to the 4 hour time frame lastly. Okay, so once again, I'm going to go for my weekly, see the whole overall price action view, and then I'm going to go to my daily, and then I'm going to go to my 4 hour time frame. So let's talk about two things here. So this is going to be current price. Wherever I see the dotted line at is going to be where current price is. Right now, current price is at all-time highs. Okay, so if I'm playing a market that I'm expecting it to go up and it's already at max height, I don't want to buy there. Okay, I don't want to buy at max height. Okay, I can't go any higher than that. Okay, I don't know how high price wants to go up. I want to take a trade where I have resistance above current price, so price has something to travel to, or support needs to be above current price, so price has something to travel to. Okay, so what resistance is, it's an area where price decides to fall in a downwards direction. And this is a left to right chart. Okay, so resistance happens because if people bought way down here, of course they have to sell. So whenever and people bought way back here, so of course we're going to have sharp areas of correction. Okay, whenever we see market big sharp points and then falling in a downwards direction, that's going to signify an area of resistance. Okay, even right here.
We're going to see price decide to create this top, and then it fell in a downwards direction. Okay. Downwards direction. Same thing up here. Price creating resistance here, and then price fell in a downwards direction. Okay. Very simple. Okay. And it's just not making it hard, making it very, very, very simple. So whenever you see market making downwards corrections, that's going to signify resistance. And once again, we want to be looking at resistance, etc., and stuff on our higher time frames. That's all we want to be looking at. Our weekly, daily, and 4-hour. Okay. We don't care about 15-minute resistance, none of that. We're looking at our higher time frames. The higher time frames are the levels that the institutions are playing with. Okay. So whether it be at hedge funds, banks, institutions, okay, everyone is looking at the higher time frames. And trading is not like business where you want to be unique. Okay. In trading, you want to be a sheep. Okay. Whatever everyone else is doing, that's what you want to be doing too. That's going to be the right thing. If price is going in upwards direction and blasting, you don't want to be the one selling. Okay. Now, if price made a low and found support, which let's talk about that. If price makes support, which is going to be a low, and then price bounces in an upwards direction, then you can go ahead and purchase there too. So even if price is going down, if you see price make a low and then start bouncing in an upwards direction, you can go ahead and purchase that too. Okay. So support, once again, it's going to be an area where people are going to be buying at. Okay. It's going to signify demand. So buyers are at the areas of support. And then the opposite of that is going to be resistance. Resistance means there's too much supply. And that's going to signify that sellers are stepping in. Okay, so that's the difference between the two. So we have support, price bouncing in an upwards direction, resistance, price bouncing in a downwards direction. They both correlate with each other. Price can only go two ways, up or down. Okay, so they both work together. Okay, so check it. And this is going to be an area of resistance over here as well too. Okay, and then something like this over here would be an area of support. Okay. See price making this low and then bouncing in a upwards direction. I'm looking at this on my weekly time frame first, okay, just so I can go ahead and see absolutely everything. Now, for this trade, for example, Wells Fargo, okay, I wouldn't not take this trade because one, we are at all-time highs, okay, and just like I spoke about right here, okay, I like to either have resistance above current price, because price always wants to meet up with an area of resistance. So this brings me back to the competitive logic. Okay, so bringing back the market logic into the charts. If the company is trying to be the most competitive and show that they're the best, which is one of the ways they can do that is by having one of the highest share prices compared to the competitors, then price has to break resistances then. Price can't stay at all-time highs. They can't keep dumping down. That means it has to break resistances. So price is always going to be chasing all-time highs. No matter how low we dip down, okay, I don't care if price dips down all the way down here. As you can see, price still broke this area of resistance right here and then bounced in an upwards direction, okay? Price is bouncing up, going up, okay? So it's going in an upwards direction, okay? No matter how low price dips, it always wants to break all-time highs. Not saying it always will, depending on some companies, but it wants to. It wants to go back up. Okay, there's people behind these companies. There's people working behind these companies. They don't just want to be working for a failing company that's not paying any out good dividends. That's not logical. Okay, so that's why I'm going to personally ignore things at all-time highs, because if something's at all-time highs, yes, it could burst a little bit higher up, but for the most part, all it can do is fall down. Okay, so what I like to do is wait for good opportunities. So take this Amazon opportunity here, for example. All right, let's say Amazon wants to actually bounce up this area here, right? Okay. So we have this area here on Amazon, okay? So I have this area of support being reacted off of. We got one candle, two candles here, and then I have one candle here.
Okay, let me go to my daily time frame here. Okay, I got a double bottom here at this blue line. Okay, and I can see over here, price made resistance over here too. So I might want to break it and retest off of this area here. And then right here too, the support decided to work. Okay, so let's say price decided to bounce up this blue line, all right, and go in an upwards direction. So if price wants to find a specific low here, okay, and one thing I like to go do is get on my daily time frame. Okay, look at the low zone. Okay, price is either going to bounce two ways, and we only want to be purchasing call options. Okay, we're going to be purchasing call options only due to the fact that it's a stock market. Okay, there's people working behind these companies. They're way more likely to go up than down. There's also laws in place, such as the short share restriction, to prevent things from dumping to zero. These companies employ people and run the entire economy. They're not just stocks on the internet. So call options are going to be all that we're purchasing. And we want to be purchasing any contract between, honestly, 1 month is too short for certain take profits. So you want to be purchasing a contract between, I'll say 3 months to 2 years out. So you want to buy at least 3 months to 2 years out. Okay, so what that means is on the Amazon contract dates, for example, here, if I wanted to trade this is October, as of when I'm recording this, October 2025. So it's going to show me the most recent options contracts here. Okay, what I'm going to do is go all the way over to the right. Okay, and let's say it's 2025. So let's say I want to buy 2027. Okay, I'm going to buy a whole year out. And the reason why I'm buying so far out is because I'm using my higher time frames. I'm using my daily and my weekly. Okay, I know price wants to hunt these areas, inshallah, but we have to give time for our trade to cook. So, and the contract that you're going to buy is really easy. So if current price, like we can see here in the middle for Amazon, is at 215, okay, all you're going to do, the contract that you want to purchase is going to be the one above wherever the current price is. All right, so if your contract is at 215.57 and you buy a year out, whatever the option above the current price number is, okay, the first option above the current price is going to be the best contract to buy. So in this instance, it would be this call 220s, since that's the first option above this 215 here. And I will buy a year out, okay, and then let the whole thing work. And this is also going to be a really good indicator to let me know if a trade is going to be good too. So I can see here all the price action here on the Amazon price chart. Okay. So this is where it was up here at January 2025. Okay, I can see price made this ultimate low here. Okay, and now it's trying to make some progress. Okay, so price is trying to mirror this low over here. Okay, and go in an upwards direction. So we have this support low over here for price bounced, and then we have price trying to mirror it again. Okay, price potentially, especially if I get one more daily close, if I get one more daily candle above the zone. I like to wait for a daily close above the zone too. I never buy whenever price is in the zone. So right now the wick is still in the zone. This candlestick is in the zone. Now if I get another candlestick up here above the zone, I'm buying that. Okay, that's something I want to buy because it shows that the zone is holding. So I never buy the first wick in the zone. I never do that. Okay, I just want to see if the zone wants to work out. And how I'm going to do that is get on my daily time frame, and I'm going to look for a candlestick outside of the zone. I should see a candlestick above the zone. If I see a candlestick above the zone, I'm good. Okay. If I see a candlestick above the zone, I'm going to be good. I'm never going to want to buy in the zone. Why? Because price, if it wants to, could dump further. Okay. But if I see price give me another candlestick, it's going to show me that that area of support was valid like I thought. And instead of me getting burned and just losing, okay, by buying at the zone, trying to buy too fast, I'm going to wait for price to confirm itself. Okay, so waiting for confirmation can be really strong. Okay, waiting for confirmation is something that more people just need to do. Okay, so when you wait for confirmation, you can sense out your setup. Okay, you know what type of setup you want to take. Okay, you're like, okay, hold on, this is working out because of X, Y, and Z. Price is holding this area of support here. Okay, so Keep that all in mind. All right, keep it all in mind. All of it's going to be very, 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 very useful to keep in mind when it comes to taking your trades. Now, just like I spoke about again too, I like to play trades when there's resistances above current price, just like I talked about. Okay, so I have this area of resistance up here above current price. Okay, so I know price is something to travel to. I could see price reverse here once, reverse here twice. Okay, so price wants to come up here and try and break it. Okay, it doesn't want to keep reversing at the same area over and over again. And if it does reverse at this area 60 times, just the fact that it's trying to break this area, we use that as our profit window. Okay, so the whole gap until the area of the resistance is the money that we're trying to make. Okay, that's a whole bunch of money that we can make right there. So once we see the support being confirmed, we take it up to the heaviest area of resistance. Gotcha, my bad. So yeah, we'll take it up to the next heavy area of resistance. Okay. So it's gonna go ahead and be that. All right. And then from there, let's go and let's jump into another setup here. Okay. So that'll be that. The price doesn't want to keep reversing at this area here over and over and over and over and over and over again. Eventually, it's going to want to try and break this area here. Okay. So keeping that in mind at all times, it's going to be really, really, really important and imperative. Okay. So if I go ahead and I pull up another stock, for example, okay, let's say Apple. Okay. Actually, yeah, you know what? Let's say Apple. Okay. Even Apple right here. Okay. I can see Apple created this area of support down here. Okay. This area of support looks like it wants to be held due to the fact that on my daily time frame, I have some candlesticks that decide to push in upwards direction from there. Okay. So I can assume that price wants to at least fill in this gap up here. So I know price wants to fill in the rest of this gap for resistance here. Okay, since we're going upwards direction, it's not going up for no reason. It wants to go to a certain place. Up. Okay, so we have about 10 points left and it's heading to the resistance. And they'll try and reverse here or break it and maybe retest, continue. So once you see a support area confirmed, I look at it, be like, okay, why does price want to bounce at this area here? Once you see why price is bouncing in a certain place, it's going to be a lot easier to go ahead and take the setup from there. Okay. So let me pull up something like a Google, for example. Okay. Same thing with Google here. I could see price decided to meet up with this area of support once. Okay. And then I also have the area of support being reacted off of twice. So I got two areas of support here being reacted off of. And I can see here, day after day after day after day, price is filling in this gap here to the area of resistance up here. Okay, price is trying to fill up the area of resistance up here. So even if I wanted to get in right here, I'd still have about 5 points of price action left until I hit the resistance. Okay, so even if price were to whiplash all the way down, okay, up here still might take profit. Okay, so this is why on options 2, our contract is going to be our stop loss. So if the contract costs $200, we're okay with losing $200. Okay, so your options is your contract that you purchase is going to be your stop loss. So you can start off by playing cheaper stocks too if your portfolio isn't just booted up enough to play certain contracts that are just too short. Okay, so even on a cheaper stock like this, right, I can see price making this ultimate low on this base down here, right? So you have this heavy area of support down here. Price decided to make this area of support start going in upwards direction. Okay, we can clearly see price curling up. Okay, and I know we're curling up to a certain place. We're not just curling up for no reason. We're trying to break these areas of resistance. It's resistance for a reason, okay? Because price is trying to break the last point of fill out. So we could see
we got this area 1 here, and then we have this area right here. So we got 2 areas where price decides to fall in a downwards direction at, okay, 2 places. So we know price wants to at least try and touch this area of resistance. So this is all I would do. Okay, I can see that the support area already got confirmed. And even if I just wanted to buy right here, this would still be a good buy. Okay, I can get on my ruler here, and when I close, it's just going to be important. And how much time I have too. Okay, so this is about 6.56 points left. Okay, so from there, I would be able to click on options in the top left. And I could buy a year out or 2 years out if I wanted to. Okay, and my take profit is going to be 17.43. But to make the most money, I'm just going to go ahead and buy the contract 1 above the current price. So if current price is at 10.85 and I want to buy two years out, for example, then I'm going to go ahead and just buy the contract 1 above, and I'm going to go ahead and buy that. Okay, and then from there, I can go ahead and just hold the trade for just an extremely long time and just sit on it and set alerts and wait for take profit to get hit. Okay, and we're going to just rinse and repeat until we find good trades. So this is going to be a trade that I marked out here too for students. So I could see here, price decided to do something what's called break retest. So after areas of resistances are broken, they can sometimes turn into support. And that's going to be called break and retest. Whenever you see price doing that, it's also a high conviction that price wants to continue in an upwards direction. So I could see price made this extremely heavy area of resistance right here. Fell down, okay, and then price decided to make this ultimate low. Okay, so there's going to be 2 setups you're always going to be playing. You're either going to wait for resistance to be broken and wait for price to come down and turn it into support, just like this. You're going to wait for the resistance to be created and then wait for the resistance to be broken and then wait for price to turn the resistance into support. And then if you start seeing bounded action out the zone, you're going to be good. So you're either going to wait for resistance to turn into support, or you're going to wait for an area right here to be reacted off of. You're just going to wait for an area of support to be bounced off. Okay. Even if price doesn't cleanly mirror the supports like this, okay, one level after the other. Okay, just like right here, one level of support immediately right after the other. Okay. Sometimes you're going to have an instance like this, though, that still works. Sometimes you're going to have an instance of support like this. Price might break down below the support, and then it might come back above it, and then it might bounce again. Okay, so you could just ignore this, but just the fact that it wants to mirror the original bounce and try it again, okay, is a really, really, really strong and good sign. Okay, so that's what you're going to be looking for. Okay, either support bounces or price is bouncing in the same area of support, giving you daily closes outside of the zone. Okay, so I would never trade in this gray box. Okay, because I can see prices wicking here. I would wait for a candlestick to get on the daily above the gray box, and then I'm going to go ahead and take the candlesticks above the gray box. Okay, I want to just use my low as confirmation. Okay, and then even right here, price broke above this area of resistance, turned it into support, and then went up to the next area of resistance all the way up here. And guess what? Resistance got broken again and turned into support. So resistance got broken and turned into support again. Okay. Keeping markets simple, playing trendy. Okay. We're just going to be trading with the trend is all we're doing. Focusing on lows and focusing on where we need to close. Okay. So I'm going to always start off on my weekly time frame. It's just personally what I like to do. Let's say this instance here, I'm going to go ahead and put a zone at this all-time highs. Start off on my weekly. Let me go to my daily. Okay, we could see price trying to make a lower here. Okay, and then I'm looking at my 4 hour. And this is why we go to our 4 hour time frame, because you can see here on the daily time frame, this is the bottom of the wick. But then I go to my 4 hour time frame, the bottom of the wick is going to be down below down here. Ooh, guess what? Extremely, extremely nice. So I have area support over here being reacted off of with this area of support over here. I love it. Price came all the way back down to this area of support
which I assume came from this area of resistance right here. So break and retest will a lot of the time it'll happen once real quick, create the strong area of resistance, and then price has a chance again to come back all the way down, turn it into support and bounce again. And we can see the support areas are mirroring each other. Okay, one area of support, two areas of support. The support areas here are once again mirroring each other. Okay, so if the support areas are mirroring each other, that means that it's a significant place that we want to just be purchasing at. Okay, they're mirroring each other at these places. But price isn't just doing anything, it's playing logically. Okay, so if I see price bouncing at the same place, I would assume that price wants to fill in the rest of this area of resistance up here. Okay, and price will either try and reverse at the resistance, break above it, I don't care. All I know is, even if price wants to reverse at the resistance, it wants to at least touch it. Okay? It wants to at least touch it. So we'll go to my options. And I would go ahead and be able to buy. Let me see, if my take profit was about 2 months ago, or about a month ago, then I could easily buy 3 months to 2 years out. The further out, the better. The further out, the better, just because you want to give your trade the most time. So take profit up here is 50. Okay, take profit was there about a month ago. So if I wanted to, I could do like January 2027. Okay, and then I'll be able to purchase this contract very cheap for $240. I could buy a contract that lasts me about a year. Okay, so I have a whole year to go up 3 points. That's extremely likely. It's extremely likely. So what you're doing is you're outplaying the options formula. Okay, you're taking the perspective of option sellers where they're like, you know what, people are going to purchase this contract because they're going to want to be cheap. They're going to not have enough time on this, and price most likely will not do it in a short amount of time. Okay, so when you buy time on your contracts, you give yourself time. Okay, give your contracts time to breathe and do its thing. It's going to be big. Okay, and you can stack up on what's called leaps too. Okay, you can just buy a bunch of good setups that have like 1 to 2 years out and just sit on them. Sit on them, wait for take profit to get hit, find your take profit on your weekly and your daily, and wait for them to get hit. A lot of the time too, on your price chart, this is not going to be the definitive every time, but a lot of the time on your price chart, if you have resistance above current price, you're in a good area. Okay, resistance above current price is going to be a really good sign. Okay. Once again, resistance above current price on your price chart too is going to be a good sign. You can see the price chart has a place to travel to. Okay. It's about taking our time. Okay. So the weekly here, I would start off, I just go through my pairs. I can see this is at all-time highs. I'm cool off this. Okay. If I wanted to trade this, I would need price to pull back to a certain level. Okay. I could see price here decided to turn this area of resistance into support. Okay, and then it took off. Now, if price decides to come back, hold this area again and bounce, I'm cool. I'll take that. Okay, but buying all the way up here, I'm not gonna do that. That's not something that I want to do. Okay, so let's take this stock for example here. Okay, even right here on this stock. Okay, I could see price trying to make a certain low here. Okay, I always just pay attention. Is price bouncing in an area? If so, I'm gonna check it out. Okay, I can see price made this area of resistance over here. This area of resistance turned into support. And this area of support is now being bounced at again. Okay, and I also have a daily candlestick above the zone. All parameters I like personally. Okay, price bouncing in the same zone. I see some break and retest over there. So if I wanted to, I could easily take my take profit to the area of resistance up here and then all the way up here. Got it. And then you're gonna wait for price to fill in the gap. It might fall down here and then come up, maybe retest, and then back up through here. Okay, so I can see the support here being confirmed. Okay, price really likes the support here. So I'm gonna take my chances here, and you can see the rest of the bars is about 20 points worth of price action. Okay, take profit was hit about a couple months ago. So I would do the same thing on this. I would go options. Okay, I would go like a year out. Okay, I would just make it easy for myself, buy the one right above. I can see on my price chart here, I have resistance above current price.
And this is just simple, okay? And I can see price even on the price chart here kind of wants to confirm. When my price chart reflects my actual chart, that's going to be a really good sign, okay? So you want the price chart to be reflecting kind of the actual chart, okay? So I can see price bouncing in that same low here, and it looks like it wants to trickle up and fill the rest of this area up here. Okay, so we have about $1,900 worth of profit up here to be made in between here. Okay. In options, it can be kind of hard to calculate every single thing. It's not an indicator, it's just a price chart. So every options contract has its own chart. Even here too, take this stock here. Okay, once again, all I do is just eyeball, okay? I just eyeball. I can see price made a low, and I see a green candle after price dumped, I see green candles looking like it wants to trickle up, okay? So you can just eyeball the chart, and this is why we just buy time. There's millionaires or people who don't even look at the chart, okay? People who forgot about the plays they've been in and opened their broker one day and just closed the position and enjoyed their life. Okay? So that just shows that buying and holding is what we're going to be doing. Okay, so even right here, to see price bouncing at that certain low over here. Okay, price decided to make this low right here based off of the resistance right here. So resistance got broken and price decided to turn it into support. And then price decided to bounce at the same area of support again. Okay. And once again, I have a daily candlestick outside of the zone. I have a daily candlestick way above the zone. So I'm good. I'm never going to buy a candlestick in the zone. I like to see if my zone is created though. Okay. Then from there, I can go ahead and see price wants to try and meet up with this area of resistance. Okay. It'll try and either reverse at this area or break above it or both. Okay. So we'll go ahead and go to options. Go a year out, buy the one right above, and guess what? Price chart has resistance above current price. So when your price chart looks like your setup, that's a really good sign. Okay, this is going to be some secret sauce right here. So when your price chart looks like your setup, that's really, 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 really secret sauce. Okay, and then personally, I would just be waiting for market to go ahead and do its thing up there. Okay, I would wait for price to curl up and meet up with the area of resistance up here. Okay, and catch the whole remainder of this price action up here. Okay, so it's about taking our time, making sure we're finding good profitable setups. Okay, even right here, take Hewlett Packard, right? We have this area of resistance here. Okay, price decided to just meet up with this area of resistance. Okay. And price decided to make a low. Okay, made a low off of this support right here and decided to bounce in upwards direction. Now price is meeting up with this area of resistance and we're going to try and break this area of resistance. Now, if this area of resistance gets broken out of, then I know we want to at least try and meet up with this area of resistance up here. Okay, go to my daily time frame. Okay, I can see this area of resistance created up here. So if price decides to run past this area of resistance, maybe turn into support, I know we want to go ahead and try and trickle up here. Okay. Or even if I just deleted everything, marked out this area of resistance up here. Okay, I could see price hit this area of resistance this year. Could see price decided to make this recent low. Okay, and I could just wait for price to fill in this gap up here. And then I could go ahead and go to my option contract, buy a year out, 30, and I could see resistance above current price on the price chart. So if I see price already made a certain low on the price chart, that's going to let me know that that's really good. Price already redipped the zone multiple times, even on the price chart. Okay, so price looks like it just wants to curl in an upwards direction now, inshallah. Okay, their setups look like your price chart, and the whole remainder of this gap here is going to be all just money we can get, all money we can make. We just buy a year out,
and just set my alerts at the take profit all the way up here. And I'm going to let the whole trade just ride out. Okay, I'm going to let the trade just do its thing, collect my profit, and just ride it out. And I'm just going to ride out the trade. Okay, and just make it as easy as possible for us. Okay, same thing with Kroger here. Okay, I can see price confirm this low down here already. Okay, you can see price confirm the low down here. Okay, it likes this area. Now I can see price wants to potentially try and meet up with this area up here. Let me go to my daily. Okay, and I can see this whole area of resistance clearly wants to be filled. Okay, filling this whole gap of the area here. Okay, even if I got on my 4 hour here, even if I closed up here. Okay, Kroger, boom, could go a year out, go one above, and as you can see, resistance above current price on the price chart. Price decided to make a low already on the price chart, and price looks like it wants to fill in the gap to the area of resistance and curl within a upwards manner. Okay, so that's going to be how to trade leaps, how to make income from options, and how to trade. Class, let's learn. Today we're going to be talking about Mono Zero, Zcash, and the evolution of the unlinkable value, and the quest for digital anomaly. And this class is going to explore cryptographic foundations and real-world implications of the leading privacy-focused cryptocurrencies. Let's jump into it. So the transparency trade-off in cryptography. Traditional cryptocurrencies like Bitcoin operate on a transparent public ledger, also known as the blockchain. And while this offers unprecedented security and verification, it fundamentally compromises financial privacy. So let's talk about anonymity versus pseudo-anonymity. Bitcoin transactions are pseudo-anonymous, meaning that they're linked to public wallet addresses. With enough data, these addresses can be de-anonymized and linked back to real-world identities, especially when funds move through centralized exchanges, which have know your customer rules, also known as the KYC laws. So this is how big scammers get caught and things like that too. So when people get off and finesse millions of dollars worth of Bitcoin, etc., and stuff like that, especially if they do any type of withdrawal to any type of bank account or Cash App or anything like that, it can be traced. Okay, so as far as the whole decentralized section and the space to where everything is anonymous, things with enough tracking, and since everything is on the blockchain, which is pretty much going to be the history of every single transaction that happens on the cryptocurrency market, things can definitely be tracked back. So keep that in mind. So sophisticated chain analysis firms can map the flow of the funds, inferring balances, spending habits, and commercial relationships. And this compromises business secrets and personal financial health. So if certain coins can be tainted or flawed due to their history, for example, association of illicit activity, for example, then their value and acceptance can be diminished, which is a key failure of fungibility. And fungibility is where all units of a currency should be perfectly interchangeable. So let's say for analogy purposes, right, let's talk about the glass vault. So imagine a Bitcoin has a glass vault, right, the blockchain, and it's where everyone can see exactly how many coins are in every single box. All right, and let's say the box refers to addresses. And one of the most routine boxes, even if they don't know the owner's name initially. So that's kind of just how it is. Things can still be traced and tracked with enough data, but for the most part, it's not going to be as vulnerable as far as the sensitive information exposed. Like you're not going to see your last 4 digits of your card number and stuff like that. It'll be your Bitcoin address, which can't really do anything for you. If somebody gets it, if they see the address of the transaction that was done, it'll just show how much the transaction was for, the fees in the transaction, etc., and stuff like that. But it can't really trace you back to your own personal wallet, but it will have an address for the transaction. So mandatory privacy by default, the Monero protocol. So Monero launched in 2014, and its design is to completely fungible and private by default, which makes all the transactions appear the same to external observers, and it achieves this trio of mandatory privacy features. So we'll talk about them. Let's start off with the ring signatures. So this hides the sender, and the actual spender is mixed with several non-spenders, and that's the ring, making it computationally infeasible to determine which key is actually signed to the transaction, and the transaction is proven valid, but the source is going to be obfuscated. Okay, so keep that in mind as well too. So ring signatures hide the sender. Now let's jump into stealth addresses. Stealth addresses hide the receiver for every single transaction, and for every transaction, the sender generates a unique one-time destination address on the blockchain for the receiver. And the receiver can scan the blockchain and identify the funds belonging to them without revealing their true public address. And let's jump into ring confidential transactions, right? Referring to ring CT. And this hides the amount. And ring CT uses the Pedersen commitments and zero knowledge proofs to cryptographically verify that the inputs and outputs of a transaction balance, right? Which is going to refer to the fact that no new coins were created without revealing the actual value of a transaction. And Monero's core philosophy is that privacy shouldn't be optional, all right? Should be secure, and people should be having high conviction between sending money from one person to another. They shouldn't feel like they are vulnerable within sending information. And Monero's core philosophy not only thinks that privacy shouldn't be an optional factor, but it should be non-negotiable. And it's a feature that's baked into the protocol, guaranteeing a high level of fungibility for all the XML units. So let's talk about selective disclosure via ZK snarks. So Zcash, it introduced a groundbreaking cryptographic tool called ZK snarks. And that stands for zero knowledge, succinct, non-interactive argument of knowledge to the mainstream. And this allows a user to prove that they know a piece of information, like ownership of funds, without revealing the information itself. So what is a ZK snark in the first place? I know it's a crazy name. So it's a proof system that verifies the validity of a transaction without needing to see the addresses, the amounts, or any other identifying data. And this allows for shielded transactions where the public blockchain only records that a valid transfer occurred, just to make sure that, if someone says, yeah, I sent you your million, and they can actually go check to see if it happened, so you can't get robbed and finesse. You can actually see if the transaction occurred. So don't be foolish. And let's talk about optional privacy. Unlike Monero, Zcash offers both transparent T addresses like Bitcoin and shielded Z addresses. Okay. So it offers both of those type of transactions. And this optionality is often cited for compliance purposes. And compliance is pretty much going to be government laws, things having to be in place so people can send, buy, and sell cryptocurrency. And it's often cited for, once again, compliance and law purposes, which allows users to selectively disclose information if required by a regulator or auditor. So companies, a lot of the times, have to have privacy laws, so all your information can't just be exposed. So viewing keys and memos. Zcash provides mechanisms like viewing keys that allows the Z address owner to reveal the transaction data to an authorized third party. And this controlled transparency is a key differentiator from Monero's absolute privacy. So let's jump to an example here, guys. So using ZK snarks, a company could prove to an auditor that it holds a minimum balance, let's say for over $1 million in a ZEC wallet, without revealing the exact balance or any other transaction history. And they prove to meet the condition, but nothing more. So comparing Monero's mixing versus the Zcash zero knowledge. So Monero's approach, let's talk about the mixing here. Okay, so the mechanism involved in Monero's approach. Okay, it's using rig signatures, and rig signatures obfuscate the sender by creating plausible deniability among a group of signers. Okay, and they're going to be in the ring. And the pros of it, it's simpler to implement, and it relies on time-tested cryptography. So once again, ring signatures obfuscate the sender by creating plausible deniability among a group of signers, okay? Making it a hidden circle. Okay? It's a lot simpler to implement, relies on time-tested cryptography, and it's absolutely mandatory for all users, ensuring network-wide privacy so everyone could be safe who's trading within the circle. So, and some cons of it. Transaction sizes become larger, and that could also lead onto the blockchain network and make people have potentially slower transaction verification times due to the complexity of ring verification. So it would just take a little longer for you to receive your money within your wallet if you were to receive money, or if you send some money to somebody, it would take a little longer for the funds to actually be spendable in their wallet. And that's okay. So Zcash's approach, right? This is going to be a different approach to it. So Zcash, the mechanism of it. So ZK snarks prove the validity of a transaction script without revealing any of the underlying inputs or outputs. So the pro of this, it's a higher level of cryptographic anonymity okay? And it's zero knowledge, okay? So it's pretty much when the transactions are done, can't be tracked as easily, okay? So that's going to be a big pro of it, especially for people who want to use cryptocurrency for just certain other purposes, and smaller transaction sizes compared to Monero. So it's going to mean faster processing, okay? So you're going to get your money faster. Good thing. And let's talk about the cons though. So it requires a complex initial setup known as the trusted setup. And though newer versions aim to minimize this, privacy is going to be optional, leading to less adoption of shielded transactions, okay? So Zcash's original trusted setup was controversial, and the initial parameters, if compromised, could allow someone to counterfeit ZC. And Monero's design avoids the centralized point of trust because privacy is not optional within the Monero world. So yes, it's a little slower, a little clunkier, not as quick, but safer. So beyond Monero and Zcash, let's talk about the layer 2 protocol innovation. So the quest for digital privacy is not limited to dedicated coins. New innovations are integrated privacy into existing chains and layer 2 solutions. Let's talk about layer 2 privacy solutions. So Tornado Cash Mixers. They use smart contracts and ZK snarks on Ethereum to break the on-chain link between source and destination addresses. And CoinJoin and CoinSwap. And there are going to be protocols where multiple users combine their transaction inputs and inputs into a single large transaction, making it impossible to map individual transfers deterministically. And advanced zero knowledge. ZK snarks, right? It's a newer version of ZKPs that removes the need for a trusted setup. It's trustless, making them more decentralized and mathematically pure, though computationally more intensive. But we got to remember, just like I just talked about on the last slide, security is going to be optional. So the encryption, right? So the homomorphic encryption, right, also known as the HE, it allows computation to be performed on encrypted data without decrypting it first. And this is still highly theoretical for fast decentralized currency. So ZK snarks, once again, a lot quicker, but still raises a lot of concerns due to the fact that privacy is going to be optional. Keep that in mind. So regulatory focuses, right? Laws, governments got to have their piece of the pie and got to make sure things are safe too. Anti-money laundering companies and governments, the SEC, etc., got to make sure cryptocurrencies are being managed within a safe way so people aren't just getting rug pulled on, getting scammed and getting their money duplicated, etc. So regulators globally are increasing scrutinizing protocols that offer strong privacy, viewing them as potential tools for money laundering, right? And the future balance will be between innovation and compliance, likely favoring optional, audible private solutions like Zcash's viewing keys, okay? So as long as certain government entities get behind it, the anti-money laundering entity, SEC, etc., are all monitoring it, then we could have a pretty safe, decentralized world. Although, even though it's being monitored by regulators, it's truly decentralized, okay? Let me know in the comments below. So let's talk about adoption, compliance, and the fungibility imperative. So primary use cases. So journalism and activism, right? Used to protect donations to whistleblowers or political dissidents from oppressive regimes, okay? So journalism is being implemented, trying to spread the worldwide spread of cryptocurrency, okay? Spreading how people can do their transactions and just making it more known to the government. And the government itself has been buying cryptocurrency recently as of 2025, and TradingView has now implemented as of October 10th, 2025. You can actually start seeing some cryptocurrency news being linked. So government's really adapting it. Its future's looking strong as far as the cryptocurrency space. So let's talk about some privacy, all right? So e-commerce privacy. Preventing competitors or data miners from tracking suppliers, sales volume, or customer bases. Extremely important for privacy, and then know your customer laws are going to be extremely important to implement on brokers where we put our cards in order to buy some cryptocurrency. And salary protection. Individuals who don't want their employer's treasury balance or personal wages publicly visible. Super duper important for anyone who wants to stay safe or stay anonymous. Okay? You don't got to flex and pop it on everyone if you don't want to. So corporate secrets. Hiding internal fund transfers and merger acquisition activity until legally required disclosures, okay? So pretty much not exposing deals until things are fully done. So some key challenges Exchange delisting. Many major regulated exchanges, let's say Coinbase or Binance, for example, refuse to list privacy coins due to compliance pressures, limited liquidity, and adoption. And there's going to be some regulatory classification. The lack of transparency often leads to classification as high risk by financial authorities, creating friction with traditional banking rails. And when things are classified as high risk, people aren't going to feel as safe to invest into it, and leading to less liquidity, since now it's going to be, once again, investing into it. And let's talk about the scalability and computation. The advanced cryptographically required, especially for ZK snarks, can increase transaction processing time and costs, though this is actively improving as laws get passed, governments start to analyze cryptocurrencies, regulate things, consumer sentiments start coming out, and things just start getting talked about. And the ultimate success of privacy coins depends on their ability to prove that the financial privacy is a fundamental human right necessary for a free society, and while demonstrating that the tools exist to meet legitimate law enforcement needs. So they're trying to keep everything safe because, once again, a lot of big scammers and stuff like that within the cryptocurrency world, but able to get caught, people are able to return money and stuff like that too. And the cryptocurrency world just really progresses over time. There's been some things I've talked about in previous other lessons too, where there's been instances where, let's say, like a certain amount of Bitcoin Cash, right, got hacked, and people were able to reverse the transactions, giving all their money back, right? And certain things like that just being implemented just to keep the safety protocol of everyone's money flow. Things just get better as people start to, one, come up with more scams, and as people come up with more scams, people can come up with a stronger defense in order to fight it. So thank God for everything getting more secure, locked down, so we can have a safe crypto trading environment. And privacy isn't about hiding that bad deeds, right? It's about protecting individuals' autonomy in a financial system where every transaction can be linked and analyzed. So, Monero, XMR, it's absolute, and it forces mandatory privacy rights through the ring signatures, stealth addresses, and ring safety. And it favors fungibility above absolutely everything, regardless of the transaction time. So it doesn't care about that. It doesn't care how slow a transaction time is, as long as it's safe, making sure that it's locked down, and it's mandating privacy. Let's talk about Zcash, right? The SECC. So optional privacy using ZK snarks, offering the highest cryptographical guarantee with control disclosure, right? Viewing the keys and the future of everything. Moving toward layer 2 and modular privacy solutions that integrate ZKPs across multiple blockchains. All right, guys. So let me know what you guys think about the future of cryptocurrency. Stay prayed up to God. Keep grinding. Head over to stackmode.net to learn how to trade, how to invest, and how to grow your business. Peace. Class, let's go and let's jump into why you have to be disciplined, especially if you're going to be on a funded account, on a prop firm account, or trying to get any type of withdrawal. And let me tell you guys something. There's been times where I've lost a withdrawal on day 4 out of 5 of my payout. Okay. Due to what? Due to me being undisciplined, due to me being greedy, due to me having too much ego. And I don't want you guys to go through the same things. Okay. There's no reason to be going through that. There's no reason to be that disgusting and sloppy. And I want you guys to learn to just be consistent. Okay. There's going to be a lot of cost that come when you trade without your rules, when you let your ego get to you, okay, when you don't humble yourself, okay, and there's a reason why God tells us to be humble and have humility, okay, because you can really destroy yourself. Even when you're running up that big bag, okay, I was excited, okay, running up that big bag, posting PNL on social media, and this was before I was even Stackmode Chris, okay, like super duper excited, overzealous, over trading, and guess what? Destroyed it all, okay, ended up getting no payout and lost the account at day 4 out of 5 out of my withdrawal. Okay, what was I doing? Okay, and I was up way over the amount than needed to crash out the account. Okay, and it was just completely my fault. I realized I had too much ego. I needed to humble myself, and I realized that I just couldn't believe that I was wrong on that one trade, especially after one streaking to earn the account in the first place. And prop firm can kind of screw up your head and screw up your whole mental realizations. This is why I personally do recommend, even if you're on a prop firm account, even if you guys are good in getting withdrawals, okay, start a real account, okay? Do these 2 things. Take the prop firm profit, okay, and reinvest it into account A. This is gonna be your long account, okay? Your long accounts are either gonna include your cryptocurrencies, your stocks, okay? Make sure you guys are trying to buy shares. So this way, you guys' money is always gonna be making you money, okay? Because don't forget, prop firms can shut down. Certain things like that are possible, okay? So just make sure you guys are taking your time, putting everything into perspective, and really just reading through the lines of absolutely everything. Okay. So account B. Okay. Replicate whatever you're day trading on wherever you're day trading on your prop firm. So if you're day trading futures, for example, on prop firm, then start a real account and copy trade on there. Okay, the same trades that you do on your prop firm account, just do it on your live account, even if the size doesn't correlate. So this way you're always going to have your money in your hand. So even if the prop firm shuts down, whatever happens, whatever correlation decides to go within a downward spiral, okay, you're always going to have your income there on the side. So you got account A, always making you money. Your money's always making you money. Okay, instead of indulging in consumerism. Okay, a lot of reason why people can't pay their rent and stuff like that is because, one, they're not stacking up. And you can't only stack up. You got to make sure your money is being used as a tool. It's being utilized. Okay, then rent's not going to mean nothing. Bills aren't going to be nothing. But you got to sacrifice. If you don't sacrifice, you won't get wealthy. Okay, and once again, getting wealthy is not for everybody, and that's okay. Okay, but if you're a person who wants to get wealthy, you have to learn how to sacrifice. If you don't do that, you'll never get to where you want to be. Okay, so when you have account B, make sure that you're keeping your profits in there. Okay, use your prop firm account as your income engine. Keep your profits in account A and B and keep stocking it up. Keep stocking it up. If you get to the point where you do find consistency on the prop firm, okay, you do have discipline and you found yourself a consistent edge to where you can constantly withdraw, that's amazing. Okay, alhamdulillah. Now, account A and B, don't touch them. Okay, just keep funneling money into them. Keep funneling money to them. Keep going, keep going, keep going, keep going. Okay, until either the A, the prop firm shuts down, or B, you just want to get off a prop firm entirely and just start focusing on account B and playing with your leverage and not playing without any rules or anything like that. So you can really use prop firm to get ahead and generate some income. So discipline is going to be the gateway to success and capital in general. So proprietary trading firms are not testing a strategy. They get paid based off of knowing the fact that you're going to be someone who's not disciplined. Okay. So prop firms only make money whenever you lose. So once again, whenever I didn't get a withdrawal on day 4 out of 5, right? I couldn't believe that I was taking a loss, right? Prop firms will kind of gas your head up. You know, they'll give you the nice fancy certificate, you know, after you guys went through all that hard work. Okay, so you start feeling like a good trader. You might start thinking you're better than you even are. Okay, then from there, they gate your profit behind certain days. Okay, so this is going to be a psychological game they play, because don't forget, unlike brokers like Robinhood, Webull, etc., where you invest your money, okay, the brokers get paid off of whether you put the trade now. So whether you click sell or buy, they make money. So it doesn't matter. They're not really betting on whether or not you win or lose your trade. They don't care, because they already get their fees as soon as you click enter. Okay, they get their fees. And everyone pressing enter, the conglomerated fees turns into their capital and their income as a company. Okay, so a broker is a really good business to start, honestly, as long as you just set up the software and get all the approvals. It's a really, really, really strong business, since you just get paid based off of fees. Okay, you just need participants. So, but prop firms, for example, okay, prop firms, they only get paid when you buy an account. Okay, so they're going to psychologically change everything, and they might put into retrospect like it might be easy to go ahead and get a withdrawal, etc. But behind the thin lines, behind the challenge rules, etc., they're hoping that you fail. Okay, so winning 5 trades is not normally how it goes in order to get your money on a real account. Okay, and they know that, so they're trying to take advantage of giving you the quote unquote capital. Okay, even though it's really a tenth of that. Okay, say if you have a 50,000 account, it's really like a $5,000 account, especially with the drawdown, etc. Okay, so don't get tricked by the numbers. Don't get tricked by certain things that are just in your face. You got to really read between the lines. And the reason why a lot of prop firms get successful or enforce a little more rules, like having to send proof of you taking the trades and stuff like that, or breaking down your trades, stuff that you just don't really have to worry about in a real account. Okay, so if you want to trade prop firm, that's going to be you. But if you want to stay down, stack up your bread, run it up, and then invest, that's a highly recommended option. Okay, but if you master prop firm, you master the rules, and you found yourself able to get withdrawals consistently, use it as an engine to fund your real accounts. Okay, so preserve your capital, especially once you guys start winning. Certain prop firms like Top Step, for example, the drawdown likes to catch up with you. Okay, so even when you take a loss, you have to make sure that you're keeping everything inherently in perspective. Okay, keep up with your drawdown. It's not going to work like a normal account. And being a reliable steward of your money is going to come to whether or not you want your account to be alive? Okay. Are you chasing money, or do you want your account to be alive? Okay. Because if your account's alive, the money will always be there. Okay. I just checked my Webull portfolio today. You know, thank God, up a really nice percentage. Okay. Entered and just been stacking up and not looking at it, investing over and over and over and over again. Okay. But you guys have to learn how to sacrifice, have to stay down. I've been wearing the same clothes every single day. Okay. Haven't been buying anything new. Just been paying bills, taking care of what I've needs to be doing. But I go look in the stash and I'm happy. I'm cheesing. Okay. So don't worry about whatever anyone has to say in real life. Okay. You know what your stash looks like. Okay. You can go and put in the stash. You can go pull out 100K. You can go pull out 10 bands whenever you want at any time needed. You can get up. You can go swap cribs whenever you want, anytime needed. It's not a lie anybody can tell you. Okay. You're good. So just focus on yourself. Focus on putting that money in the stash. Stay down. Okay. You don't need the newest phone. You don't need the newest shoes. You don't need the newest this, and that. Okay. Right now, you're probably broke. If you don't have at least 10K, you're broke. Okay. So you don't need to be buying none of that. Some of y'all have the newest phones and not 5,000 in the stash. And it's time to really change our mindset. Okay. Because I noticed when I was silly spending, I sat back and realized, wow, if all of this was invested properly, I wouldn't even be having to work as significantly hard in the future. Say when you're 60 years old, you have $2 million in ETF account. That alone will give you 70K a year. And that's just $2 million. Okay. Then you could have another M and some cryptocurrency generating you equity there. Okay. And that's by 60 years old. 60 years old is $3 million. Is not that much by 60 years old. Okay. That's many years. Okay. A lot of people become millionaires like 23 to 28. So it's a lot of years, a lot of time you have to stack up M's. Okay. So once you do that and you stay down and you invest, you'll never have to work again. Okay. You'll pretty much just be able to live for free. Investing is how you live for free. There's no such thing as free, but investing is how you live for free. Once your money is making you money infinitely, you live for free. Then you don't have to stress about anything. So it's about how you put in this mental perspective into your own account. And you got to just ask yourself, like, do you really want to be wealthy? Do you want to get to where you want to be? Because if you do, you're going to follow your rules. You're going to do what needs to be done. You're not going to be over trading. You're going to be trading between your risk parameters. Okay. And if you go over that, that's all you. You're just telling yourself that you don't want to get to where you want to be. So the discipline is really going to ensure that you stop yourself from destroying your account and just stop trading before you just hit the drawdown limit and you destroy your account without even realizing it, or you just blow up profit that you've been working really hard and consistently to grind. Okay. Just because you have one bad day, that doesn't mean just crash out the whole account. You shouldn't be hitting maximum daily drawdown at all. Okay. Take your one loss, hop off. Plot an even cleaner setup, come back and get back in your bag. You're good. So, true trading discipline, especially when it comes to futures, Forex, etc. Your mechanical execution is really going to need to be on point. Your technical analysis and the way that you fundamentally look at the chart, it has to be in a logical perspective, especially when you're trading stocks and crypto. Understand that's a left to right chart. Okay, just like us as human beings, we start from babies and we grow older. Okay, everything in the world works from left to right. Okay, everything has a start to finish. And understanding that, putting that into your technical analysis, you're going to understand, okay, this is why price is dipping here. This is why price is making a high here. It's finished at this point. It's going to go down and try and break that finish line again and continue, make a new finish line. Okay, making new highs, etc. So have a really good fundamental, logical understanding of the chart before you even try to boot up even a prop firm account. Okay, especially before you put your own money into a live broker. Okay, and don't forget too, prop firm accounts, you're still spending your own money. Okay, I know you guys are playing with the quote unquote like prop capital, but you're still swiping your card to buy the account. Okay, so all that money that you're using to swipe your card to buy the prop firm, you got to really ask yourself, like, okay, would this be more worthwhile in like an ETF or a profitable stock, or something that's just going to passively make you money pretty easily, maybe like a long option? Okay, so ask yourself that before you make any decisions. So enter trades only when the exact setup becomes present to you as well too. Okay, if it's not the setup that you want, don't be taking that. Don't be fiending for money. Don't be desperate. Okay, relax. Okay, especially when it comes to the market. Go work harder at your business, and you can't force trades. If you think you're going to force trades, and if you think you're going to be right at the market, okay, you'll learn. Okay, you'll learn that the market is right. And if you're wrong, you're just wrong. And you have to be okay with that. Okay. You'll plot on another trade. And I promise you guys, if you just stay disciplined, you keep studying the charts every single day, you'll start placing right trades consistently. Okay. Stick to the course, even when it's hard, even when you're frustrated, you just crashed out, you just destroyed your setup, whatever. Okay. Relax. You're good. I promise you, you're good. I've been through all of that. And I'm telling you guys, once you get to the other side of profitability, once you start just checking your account, cheesing, you just start seeing green, money making you money. Okay. It's a real blessing. Okay. It's a real blessing that God even put this in your mind. Okay. So you're good. Stick through it. I promise you, just stay down. And I promise you, everything's going to make sense in a couple of months. So trading without emotion. So think of that kind of like smart contract in the cryptocurrency world, right? That's like a machine without executing the code. So you can't really do that. You got to become a robot when it comes to trading and investing in general too. You got to become a robot. You can't be emotional. You can't be panicking when price is going up or down. Okay. And even when you are smiling at P&L, you can't be excited. You can't be quick to withdraw everything. You can't be like, I'm going to just go withdraw everything and go ball out. Go buy a car, relax. Okay. That's your future money invest in for your family. Okay, you can make real deal plans with that. Go buy some land, go buy some houses. You can make real boss moves with that. Once you get your capital to a certain percentage, it's so easy to just turn your money into more money, whether doing a lucrative amount of things, whether it be real estate, stocks, stock options, shares, crypto, whatever. Okay, so take that prop firm account money and siphon that into certain long-term investments and you'll be good. And your plan is really going to dictate everything. Okay, your discipline is going to ensure that you follow that plan. Okay, once again, whether you're feeling like you want to do it or not, like if you want to take that FOMO trade, go ahead and do it. But if your portfolio isn't looking like how you want it to be at the end of the year, you can only be mad at yourself. Okay, you can only be upset at yourself. But if you're sticking to each setup over and over and over and over again, you'll get to where you want to be. Okay, that's the real difference between the people who are successful in this world and who aren't. Too many people are too focused on emotions, like, oh, this is boring, this is whoop-de-whoop, this is etc. And that's why people just aren't anywhere. Okay, people don't know how to sacrifice. Okay, if you want to live in pleasure, if you want to live in leisure all the time, that's okay. You'll get that. You'll most likely have late bills. You'll most likely be driving a car that's not nice. Okay, and you just won't be doing the things that you want to be doing. But I promise you guys, if you sacrifice for a couple of years, you'll be living in extreme leisure. Extreme leisure. It doesn't even matter your income level too. You could be making 30K a year, 40K a year. If you're saving and you're investing constantly, stacking up every single dollar and using it as a tool, you'll be good. You'll be good. There's janitors who's retired as millionaires, okay, just by making the right decisions. It's all about decisions. Life is about decisions. And if you want to make the wrong ones, that's fine. But if you see someone flying down in their Rolls Royce, don't think that they got gifted that. No, I'm telling you, it's not many people who can give somebody a Rolls Royce. That person probably stayed down, stacked up for many years, many months, went through many struggles in order to get that. Okay. So make the choice. Do you want to be disciplined or not? So emotional trading is going to be your biggest threat. All right. If you want to be a pansy, that's fine. That's fine. But I'm telling you, if you want to come onto these markets, you have to be ironclad. You have to be structured. There's some serious people you guys are playing against. You guys are playing against people like me. You guys are also playing against other competitive players like Warren Buffett even. People who want it bad. And it's trading. Okay, don't come on here thinking that it's about to be light. You're coming into the arena. Okay, trading is very serious. Okay, it's called trading. This money isn't flying out of thin air. You're trading with somebody. Whoever's losing, you're taking their money from them. And when you lose, somebody's taking your money from you. Okay, you have to understand, why am I getting my money taken from me? Who's taking my money? What better players are taking my money? Whenever you're losing, someone is taking your money from you. I want you guys to really let that bake into your brain, especially my competitive people. Somebody's taking your money from you because they're more disciplined than you, because they're more patient than you. Are you good with that? I'm not. And that's why I had to humble myself real quick and get it in order, because I'm not good with people being ahead of me. Okay, I'm here to be the best. I'm here to win. And if you're here to win, it's time to be patient. It's time to be more disciplined than everybody. It's time to be more structured than everybody. Okay, while everyone is being loose and doing everything and being emotional, let them do that. Let them do that. Okay, but if you want to be pull up in your palace, pull up, driving whatever car that you want to drive, living how you want to live, eating what you want to eat, inshallah, okay, it's because you sacrificed. You stayed ironclad. Okay, you weren't worried about the pleasure. You knew the pleasure would come later. So don't be revenge trading too, okay? Some of you guys revenge trade because your mind goes into survival mode. Survival mode happens when you think you're about to just not eat, not have a roof over your head, etc. One, if you go into survival mode after you lost a trade, you're probably trading in a mode of desperation. Is this prop firm account like something that you're betting on? Okay, right? Because you should be fine without, whether or not trading works, okay, you should try to have income generated so that you could be fine until it gets to a point where trading can completely over dominate everything and by just your passive investments, okay, like ETFs, for example, okay, then that's fine. But until then, okay, you should be fine. Okay, whether or not your trades work out, you should be fine. And if not, you're investing too much. You're investing way too much. And you're probably over leveraging as well too. So don't increase your position side after a loss too. Don't lose $500 on your account, right? And then put on $1,000 worth of size, trying to make that up, trying to make that loss back up, and then profit after that. Just stop, okay? Come back to a completely fresh trade, completely new day, and start over again. And don't move your stop loss, okay? The automatic order that closes out your trade for a reason, don't move that. Keep that there. And don't exit prematurely, all right? God put this in your brain for a reason. Don't panic. Don't be closing that take profit too early, okay? Relax. Set your alerts and let take profit hit. If you close that take profit, if you close before take profit hits, okay, you're ruining your risk to reward. So if you're supposed to make $400 on that trade and then you only make $220, and then your next loss, you lose $310, okay, instead of you still having $90, right, instead you're just down, okay, you're down to $310 minus $220, instead you're just down, okay? So take your time, okay, and don't micromanage a trade that's moving in your favor, okay? Set your alerts, don't look at it, get up, go do something else, go get some more money. So having a funded trader mindset, focus on the process, prioritizing executing the plan amazingly every single day, okay? Study what you want to do, study how your setup should look, and get some data and evidence, especially month after month after month. You should understand how the market works. And results are going to be secondary. Consistency and execution is the only metric that matters to the firm. And you'll have a long-term view. A funded account is a career, not a single trade opportunity. And discipline smooths out the equity curve, turning random results into predictable income over months. Why? Because you're sticking to the same risk parameters. You're losing the same amount consistently. Okay, your wins are pretty much calculated, especially when it comes to futures and stuff like that. Okay, and don't worry about the risk. Okay, so don't worry about the risk. One, you have to know that not every trade that you're gonna win. Okay, so you can't just be thinking, what if I lose? What if I lose? What if I lose? Get that out of your head. Okay. But understand that you need to calculate your risk though, okay? In order to get that feeling out of your head, you're probably too leveraged in. You probably have too much money in a trade. And calculate your risk though, before calculating the potential profit. So instead of worrying about, oh, am I gonna lose? Am I gonna lose? Or worrying about how much I'm gonna make, how much I'm gonna make. Just calculate, okay, this is how much I'm gonna lose. If I lose, I'm okay with this. So even if the trade works out or not, you guys are gonna be okay. So discipline is your only true form of edge in risk management, all right? And discipline is really gonna be the separator between passing your test, okay? It's pretty simple to pass most of the prop firmer tests, okay? You can go ahead and just gain some consistent rules, and a lot of times you'll get your account. Now, keeping the account, this is a completely different deviation. Keeping the account is a different ballgame. It's about staying on this course of action year after year after year after year after year, okay? Not a single ego-ridden day, okay? Mistakes just aren't gonna be tolerated for. And if certain mistakes are made, your account will be punished. So if you wanna keep the account, I really recommend you guys just pray to God, okay? Keep your ego in check, stay humble. Even when you guys start withdrawing big amounts, stay humble, stay humble, stay humble. It's really gonna help you guys just stay focused on the process. Okay, and don't look at your P&L too much. Don't be looking at your money too much. Just wake up every day and grind. Okay, don't look at your money too much. Wake up and grind. Just keep going. And funded traders understand that rules equals money. Inshallah. Okay, stay prayed up to God. Keep grinding. Head over to stackmode.net for all trading education. Peace.
You don't got to make trading too difficult. I'm going to show you guys an easy way how to identify trending stocks and how to catch good plays. So identifying higher lows and higher highs aren't going to require any indicators, just straight candlesticks and chart work. Let's jump into it. All right, here's going to be top to bottom how to find an options contract. So first thing I like to go ahead and do is open my trading view. I'm going to look to the very right, and I like to open up the screener. So depending on your certain account budget or size, let's say I'm playing with the $2,000 account, or if I'm playing with the $3,000 account or even $1,000 account, right? I'll stick between like the 10 to 100 range, or even if I want to, I could come up here and edit it, and I could look at stocks that have the share price between 10 to maybe 150. Okay, in this way, you're going to be able to trade contracts that are within that range or within whatever account range that you're playing. If you're trading with 5 figures plus, then you could disable this and you could trade with everything. Okay. So you could come here, manual setup, and mark your parameters depending on your account size. So let's just say for this example here, I'll come manual setup, and we can do 10 to 100. Okay. Once again, if you wanted to change it, you definitely could. Change it here, 150. So I have access to all of these stocks on the list. So these are going to be all the stocks that are going to be relatively pretty good to play for a good budget within like 4 figures headed into early 5 figures, which I assume most of you are booting up at. Even if you are playing with like 5-6 figure account, these stocks, if you get some good plays, you could stack up some contracts, buy some far out contracts, hit some really good plays. So one, you're trading the United States stock market. So it's pretty much just meant to go in an upwards direction year after year after year due to multiple reasons. One, taxes. If these companies are able to hire more people, the government's able to garnish more wages for taxes. And the more taxes that are being able to be paid to the government, the richer the government will get. Okay. So as long as these companies are going up, the more profitable they're going to go ahead and be, and then the more they're going to be able to do for the United States government. So these companies and these stocks are meant to go in an upwards direction year after year after year. Take Exxon, for example, okay, the gas station. You can go ahead and see here, price headed in an upwards direction year after year after year after year after year. Okay, or this is an energy company. So constantly, price decides to rise due to the fact that it's a valuable company that affects the world. Okay, it's very, very helpful. And one thing you're going to notice about the chart is that it doesn't just go up in a straight line or straight down. Price moves within staircase scenarios. So price is going to move like an upward stairs. So identifying that lets us know that we have to get in at certain times, and also lets us know that market trends. So let's identify what the trend is and how to see an upward trend versus a downward trend. So when you're trading the United States stock market, a lot of the times you're going to be trading upwards trends, and you're going to be trading what's called pull backs. Okay. If market's meant to go up, then wait for market to come down, buy it, and then wait for it to go back up, and then catch your profit. Okay. Reverse engineer it and really just have your psychology on point. So once again, if market is meant to go in an upwards direction, you're trading the United States stock market, you're trading options or shares, whatever, and it's meant to go up, then instead of buying when it's all the way up, wait for market to pull down, buy it then, and then take it back up. So it's that logical. Okay, don't make it difficult. The charts are not mumbo jumbo. You don't need any indicators. Disable all the indicators on your screen right now. Just keep it easy, keep it fresh, keep it clean. So boom, you could see price heading in an upwards direction year after year after year. And one thing too, you want to be looking at price on your higher time frames. Time frames you're going to be needing in order to find your setups a lot of the times. You're going to be needing your weekly time frame. You're going to be on that first. It's going to give you that full vision, so make sure you can see every piece of price action. You don't want to be trading stocks that aren't trendy, otherwise you're pretty much just going to be wasting your time. Then you're going to go ahead and scale down to your daily time frame afterwards too. Your daily time frame is going to give you a little closer view, and a lot of the times your daily is where you're going to find your take profit. Okay, and it's where you're going to determine whether or not price is ready for your entry. Okay, so your daily is going to be for your take profit identifications and your entries. Weekly is going to be for the full bird's eye view, making sure you're not trading anything that's horrible. Then after your daily, you're going to scale down to your 4 hour. Now, there's a reason why you scale down to your 4 hour. The daily is one of my favorite time frames, but you do need your 4 hour. 4 hour is also one of my favorite time frames. And the reason why you need your 4 hour time frame is, check this out. If I'm on the daily time frame, I'm going to notice sometimes there's going to be little gaps in between the market. Okay, little gaps I'm going to be able to see here in between the market. But if I go on my 4 hour time frame, I'm going to be able to see price moving successively. Now, if you're still seeing gaps, what you're going to go ahead and need to do, if you're on TradingView or whatever brokerage you're looking at or trading on, you need to turn on your extended trading hours. If you're on TradingView, look in the bottom right and just turn on ETH and turn on extended trading hours real quick. Okay, this way you're going to be able to see every hour an ounce of price action, and you're not going to be able to see those little gaps. So after you're done with your weekly and your daily, make sure you scan your 4 hour time frame. From there, here's how I go ahead and find setups. I like to go ahead and scan my stock screener. I like to start on my weekly time frame, and I'm going to stay away from things that are near all-time highs. Okay, because I'm going to want price to be at a point where sellers have already sold and buyers are just now stepping in. I like to call it the V formation. So you're going to let sellers make the top left of the V. You're going to let early buyers make the bottom of the V. And then we're going to catch the rest of the V as confident, assured buyers. Okay, letting us know that the trend has swapped. We don't want to be buying falling knives, and we want to be buying when price is confirmed. In order to do that, make sure you're having at least 2 6 daily candles headed in an upwards direction, ideally that are going to be the same color, green, if you're using green and red candlesticks. Okay, whatever color you're using for buying, the more candlesticks you see going in upwards direction successively with the same color scheme, okay, is going to let you know the trend a lot of the times. And price moves in V formations. And what that means is, let's take this V formation here. Price decided to come up, make a sharp stop, and then price decided to fall downwards. So price made the top left of the V. That lets you know sellers stepped in here. This is going to be an area of resistance. After that, price fell down, made a bottom, made an area of support. That's going to let me know that buyers went ahead and stepped in. And price went ahead and filled in that whole area back to where sellers originally started selling, broke past it, and it's going to go ahead and try and make some new highs. Okay, fall down here, and then price will try and come back up, break that, and price will continue to zigzag, go up and down, and make staircase formations to new all-time highs over and over and over again. And that's how the trend works. Now, knowing when to get in, they're going to want to get on your weekly time frames and stay away from things that are, once again, at all-time highs. Price can pretty much only go down, find a low, and once it finds a good low, then you buy it and then take it back up. Okay, and ideally your take profit is always going to be where price originally fell down from. So even right here, let's say price decided to fall down from this area. Price trickled up, stopped right here, fell down, and made what's called a higher low. So this low right here is higher than this low down here. When you start seeing price making higher lows and what's called higher highs, which means that this high is higher than this high. Okay, when you start seeing price make higher lows, which means this low is higher than this low, and this low is higher than this low. When you start seeing price trend in a staircase like that, that's how you know you're heading in an upwards direction. Okay, so to find a good setup, okay, here's another one that I went ahead and marked as well too. My daily, I could see that price decided to fall downward from this area here. Price decided to make a heavy area of support, made a higher low off of that. I identified that, and price decided to went ahead and smash take profit within a couple of days. Okay. Within 6 days. So extremely, extremely simple when you're finding your setups. You want to buy when the buyers are buying. Okay, and if it took 6 days, try and buy these contracts. Ideally, if you're taking smaller take profit setups using your daily and your 4 hour, you can buy contracts as far as like 2 weeks out plus, at least try and be 2 weeks out, and then you can build your account from there. But having at least 2 weeks on your contracts gives time and price to fluctuate in case it does or in case some news comes out or anything. But even an example here on Disney, could see price meeting up with this area of resistance. I marked this a couple of days ago, and you could see buyers fiending to have price trickle back up to this area. Even if you're a trend line type person, you could do that too. You could see a little retest off the trend line here, and price headed in an upwards direction as well too. Okay, and if you wanted to, you could play the remainder gap to the resistance if you wanted to. Okay, you could buy at least like 2 weeks out, could buy 17 days if you wanted to, and take it up here, catch a nice flip. November 12th. And then you could buy your contracts. You could buy like 2 weeks out, 15, 12, $3. So yeah, 188 to $3 there. And you'd be able to just flip your money consistently there, even if you went 10 days. You'd be able to catch your flip there as well too. So play market how you would like to be playing it. Even a scenario like here, I kind of like this maybe potentially. I like how price is making higher lows here. Confident in that. Looks like buying wants to step in here from this low and the new low. Go to my daily. We got multiple green daily candlesticks. So 4 hour, honestly, I might take this up to at least this resistance here. And then that might be a clean little trade as well too. Pep. So about like 2-3 weeks out. About 145 and take it up. Yep. So cool. That's how I make it simple. That's how you find options contracts. Just no fluff, no BS. Just straightforward price action, reading the candlestick chart, understanding buy zones and sell zones, and just really taking the trades that you need to be taking. And understanding when buyers are buying is really important. Say this, for example, I could tell buyers are buying here since I see higher lows are being made. And the more you live on TradingView all day, the better your eyeballs get, really. So chart time is really important. Okay, I could check here on the weekly, see prices that have to fall from here. Get on my 4 hour. Price falling down from this area of resistance. I see this area of resistance before it here that happened on the 2nd. I like that. I'll even hop on my 1 hour with it. I have this area of resistance too. Okay, so even if I wanted to close on this 4th area here, could definitely do that. Yeah, these contracts are a little far actually. So 120 minimum. So yeah, you'd have to play for like up here. So it'd be worth it to just buy some months out. I'm sure these are probably cheap, yeah. And you could catch this flip if you want to and hold these for a minute. So yeah, all types of scenarios, different ways to grow your account. It's just choosing the most effective ways and staying patient. Okay, play the stocks that you know you're good at. Pick stocks that have good volume, and really just take your time with your setups. And yeah, that's how you find options trades. Head over to stackmode.net. I pray it helped. Peace.
I'm not the richest person in the world, but I've bought over $10,000 worth of Bitcoin at 22. All credit to God. And here's a couple reasons why. One, Bitcoins come clutch for me. Many times at night, my bank might be going through certain maintenance, and I'm able to go ahead and send over some Bitcoin to my Coinbase card and spend it and make the purchase that I need to. Or say I want to send some money to somebody in another country easily and without worrying about any holds, stoppages, or anything like that. Or if I want to just turn my money into more money by investing into the future, Bitcoin was one of the many options that I chose in order to stack my money. We're going to go ahead and jump into some great reasons and why I personally invested in Bitcoin, and you guys can see if you want to jump into it as well too.
All right, let's jump into it. Let's go and let's talk about Bitcoin, why we're purchasing, and let's take a look at this chart. So I want you guys to start focusing on your higher time frames. So for this example here, we're going to be paying attention to the weekly time frame, okay? Some of you guys are too caught up on the 5-minute, 15-minute, etc. Make sure you guys are at least on your daily time frame whenever you're analyzing your chart before you scale down to your lowers, just so you can get the real bigger picture. So let's check everything out. So I'm zoomed all the way out here. We can see Bitcoin had a beginning price here, and price decided to trickle up year after year after year. And you could see price has been going within a vertical direction year after year after year, not sideways like certain Forex markets or other crypto coins as well too. So crypto, especially Bitcoin, is mirroring the stock market a lot of the times as well too. So if you pull up the S&P 500, you're going to be able to see some correlation between that and Bitcoin. So let me go ahead and show you guys something, for example. So pay attention to this April 2025 low here in Bitcoin, correct? And then I'm going to go ahead and pull up the S&P 500, also known as SPX, and you'll be able to see the same low mirrored within the same place, okay? So Bitcoin is also going to be a limited quantity asset, okay? There's not an infinite amount of it. So that generates scarcity, and the scarcity alone makes it a great investment. Very similar to why people invest into gold, buy diamonds, buy certain expensive pieces of jewelry, rollies, APs, etc., due to the fact that there's a limited amount. Okay, limited amount of something, especially with large amounts of amounts on this earth, and more people spawning in every single day, scarcity is going to pretty much equal value 100% of the time, especially in a situation dealing with digital currency where more and more people are starting to spend money online. Since we have the ability, thank God, to save the headache from going to certain stores now, Bitcoin is going to be a really, really good asset that people are going to be looking to park tons of money into, since they can pull it out any single time. Okay, you can transfer it to either a Coinbase card, for example, spend the crypto just like that, or transfer it over to your bank account. Okay, so you have a couple other options. I have a presentation for you guys, and let's jump into the specifics of why I invest in a Bitcoin, why I think you guys should too. Let's go. All right, let's go and let's cover Bitcoin's uses for the future, its technological fundamentals, and its place within society. So the foundation of everything, right? The scarcity and decentralization. Let's talk about it. Scarcity. So when something is limited, one, it equals value, okay? Take certain cars, for example, okay? A Lamborghini is significantly more valuable than a Honda, for example, due to the fact that the materials are more scarce, okay? Since there's a limited amount. Okay, so scarcity, a lot of the times, especially when it's something that's going to help society, okay, or make a human feel a certain type of emotion, value is going to be presented by making things scarce. And let's talk about decentralization. So decentralization is pretty much meaning that there's no human higher power controlling the funds. Okay, so within the bank world, if you try and send a wire transfer to somebody, the higher power within everything that can see all transactions has the ability to decline or approve said transaction. Okay, but now if you're trading within the decentralized world, trading cryptocurrency, if you want to send 10,000 to somebody, you can instantly do it as long as you have their receive address. Okay, so decentralization is putting power back in the people's hands. Okay, and you're going to be able to send money to people all around the country, all around the world within an instant time, whether at 3 a.m., 6 p.m., no waiting for the traditional Monday through Friday window as well too, that centralized banks use. So Bitcoin's power is derived from its two defining characteristics, which solve fundamental flaws and really put the power back into people's hands once again. So the Bitcoin protocol is hard-coded to produce a maximum of 21 million Bitcoin. Okay, so there's 21 million Bitcoin in total. And if you don't know how Bitcoin is created, here's how it's done. So people take computers, okay? In order for a computer to work, it has to be fueled by hour, okay? So POWs are going to be the unit that's needed in order to create Bitcoin. So it's not like fiat currency or the United States dollar where it can be put into a printer and infinitely printed out, okay? No, there's a fixed, stable amount, finite amount of Bitcoin, okay? So power is then converted into the mining software, okay? So it's looking for certain hash codes within the blockchain, and once enough of those are mined, all of those come together and you'll have a Bitcoin. So now you'll see a lot of people going to other countries where power and stuff like that is a lot cheaper than, let's say, the United States, and are mining Bitcoin and then selling it for profit. So the future is really changing the way people are living as far as where their country's main residence is. Okay, so some people are starting to have houses in multiple different countries due to the fact that Bitcoin mining is a really profitable way to get ahead in the future and make some good income. So this fixed limit makes it the hardest money ever invented. Unlike gold, where new supply can still be mined and total supply is really unknown, Bitcoin's supply schedule is perfectly transparent and predictable, declining exponentially until approximately the year 2140. Okay. So gold, we don't really know how much gold there is. We don't know how much diamonds there are as well too. Okay. But Bitcoin, just the fact that there's a finite amount gives people more of a haste to purchase every single low as well too. And let's talk about the monetary pausing as far as the halving. So every 210,000 blocks, roughly every 4 years it occurs, the reward miners receive for securing the network is cut in half. And this halving event systematically reduces new supply, mimicking the increasing difficulty of mining a rare metal and making it mathematically impossible for any entity to inflate the supply, keeping it stable. Okay. And decentralization and censorship resistance. The network is run by thousands of independent nodes across the globe, meaning no single government, bank, or corporation can control the supply. Everything is done by autonomous, automatic, smart contracts. Okay, so no single bank or corporation can halve transactions, halt transactions, seize funds, or freeze funds. Okay, and this distributes power and ensures the network remains neutral and permissionless, putting power back in the people's hands, ensuring a safe peer-to-peer transaction system. As much as humans love jewelry as well, we do love buying things online, especially as we progress into more of a digital future society. So using Bitcoin as digital gold is also going to be one of the main reasons why it continues to go up year after year. And the primary investment case for long-term holding, right, is going to be buying the dip. Okay, so one Bitcoin falls down in certain places, right, even after making new all-time highs, people are going to be quick to buy the dip due to the fact that people already see it as a digital gold. So when the dip happens, you have to capitalize. You can't be scared. You have to be ready to put that money to the side and invest and really sit on your investment. People have been holding gold for decades, eons. Okay. So you have to think of it as that. Don't expect to instantly make money overnight. Okay. You have to have that long-term, decade-based mindset. And I'm telling you, the money will be in your hands a lot quicker than you think, inshallah. So it's also protection against fiat debasement. So traditional government currencies, which are fiat, are subject to inflation, as central banks can print unlimited amounts, eroding purchasing power over time. So take real estate, for example. People wonder why rent and stuff like that has gone up substantially over a course of a few years. Here's the reason why. The government has been printing significantly more funds as of the years have gone by. Okay. So certain other things like programs that increase the US debt too, such as like food stamps and stuff like that. So the government has to compensate for giving out money. So they compensate that by printing more money. But as we can see, year after year after year, that does not work. And that leads to economy crashes and inflation being at all-time highs. So thank God people who coded Bitcoin decided to come out with a counter to that. Okay, so if you're able to still make purchases all around the world without having to exchange your currency, which would be a lose of value depending on a certain economy. Okay, let's take the US, right? If $10 in 2025 doesn't get you as much of food as it did in 2008, that means that the value that you exchange, even year after year after year, won't be the same. But Bitcoin, a lot of the times, will be that stable debasement. Okay. It's also going to have some superior physical characteristics compared to gold and diamonds too. You don't got to worry about getting robbed in certain ways physically. You don't got to worry about stashing your house, or if your house burns down, or God forbid you run into any type of unfortunate event, you're not about to lose all your wealth. You keep it parked though. Okay. Keys are going to be really important. Don't give anybody your secret key. There's also going to be things called cold wallets too, where you can keep all of your Bitcoin on USB drives, physical drives. But if you get it wet, destroy it, lose it, or something like that, you can also lose all your funds that way too. So choose what's the best option for you. So portability, right? Gold bars are cumbersome. Bitcoin is borderless. You can trade all around the world. You can buy stuff all around the world and send money to anybody all around the world. And it can be transferred via a simple 12-word phrase called your secret key. Make sure you guys don't give that to anybody. Keep that safe, keep it around, and you guys will always be able to get back in your wallet. Okay. Indivisibility. Gold is pretty hard to divide. If you have a nugget or a bar, that's pretty much what you have. It's not easy to split that down the middle or make some kind of easy trade. Somebody has to be down to accept what you have. And one Bitcoin is divisible into 100 million Satoshis, for example. Okay, allowing for microtransactions and small investments, or if you just want to purchase something. Okay, if you have 50 gold bars and they're 3 pound solid gold bars, it's not easy to exchange that for currency immediately. Bitcoin, you can easily send it to a broker like Kraken, Coinbase, or something like that, and instantly get your money in your hands quickly. And gold requires specialized assays as well too. Okay, so you can't just pull up on anybody in the world and give them a gold bar and expect some money. Okay, they're gonna want to verify the gold, want to do certain tests, make sure that the quality is decent that they want, and see what carat it is, and all that is really going to determine how much you're going to get. And all that also is really based upon how well you're taking care of the gold bar too. Bitcoin, you just buy and hold, and that's really the beauty of it. Buy and hold. So it comes to the point of, okay, instead of you buying that McDonald's for the day, you bought some Bitcoin for the day. So it's really a test of who's feeding their flesh and who's being disciplined. Okay, if you're being disciplined, inshallah, you'll be rewarded. Okay, so because Bitcoin is still early in its adoption, right, compared to gold, which is still at all-time highs as of this recording, right, investors view it as an emerging store of value, and this is just massive potential. Okay, and a lot of asymmetric upside, especially as we start seeing stuff like the U.S. government invest into it, start seeing other countries start teaching it within schools and stuff like that, and we could just see the world going into a lot more borderless financial revolutionary and freedom era within society. Whether you're a boss trying to place some employees in a whole another country, Bitcoin is really going to be an efficient way for easier payments. Just like I spoke about in the beginning of the video, there's been times where my bank has had maintenance at 3 a.m., 2 a.m., and I haven't been able to make some transactions, but was able to go dig in the crypto stash, go to my Phantom wallet, transfer it to my Coinbase, and was able to make the purchase that I needed to. Okay, so once again, having that decentralized, safe, and pretty much having your money parked away into a world that's not controlled by maintenance times and centralized control, whether it comes to banks, whether it comes to power with when you can send your funds and how you can send your funds as well too. Banks also come with certain things such as deposit amounts and withdraw amounts too. So a lot of things are really outside of your control when it comes to that. So having your money parked into a world that's going to be a bit more free is going to be best case scenario for yourself, for your survival as a human, and for your family if you have one too. So beyond its role as a reserve asset, Bitcoin and scaling layers are solving critical pain points in global payments, making transactions a lot faster, cheaper, and more transparent than the legacy banking system. Then it really streamlines international remittances. That's really the biggest part of Bitcoin, and it's really a blessing. It lets people from other countries be able to receive funds in case you want to send some money to your family, or you might have somebody that works for you or work for somebody in another country, and you'll be able to get paid quickly within the crypto. Okay, and traditional wire transfers can be extremely slow, like 1 to 3 business days, and don't forget, that doesn't include the weekends, and it can get declined due to the fact that they don't have to let that go through if they don't want. They could be expensive. You're going to be paying that wire transfer fee a lot of the times, and pretty opaque, right? You're not going to know when the money exactly is going to hit. It's not going to be direct, and you're not going to be able to check certain things. When you send Bitcoin, you immediately can go check the confirmation link, and you can go see it on the Blockchain Explorer, see exactly when the transaction is going to get confirmed. And what a confirmation is pretty much lets you know when the other person has received the funds, most likely. Okay. And it utilizes layer 2 solutions like the Lightning Network, which allows the value to be settled globally in seconds, bypassing multiple correspondent banks and drastically reducing fees dramatically. Okay, so let's talk about the Lightning Network. It's a second layer protocol built on Bitcoin that enables near instant zero fee payments for the most part, almost zero fee. And this technology is being adopted for everyday purchases and micropayments, proving Bitcoin's capability as a medium exchange, not just a store of value. And transparent security. So every transaction is permanently recorded on the immutable public blockchain ledger. And this enhanced auditability reduces fraud risk and fosters greater trust between distant parties, which is often lacking in complex legacy cross-border payment systems. Okay, so you don't have to worry about any things like weird holds, weird stoppages, or things like that, which could be extremely frustrating when you're trying to do business or just buy something pretty simply. And it's definitely a big help to society, right? It's bringing in the democratization of finance. Bitcoin's greatest societal contribution is arguably the empowerment of financially undeserved and its ability to act as a lifeline in politically or economically unstable regimens. and banking the unbanked. Globally, billions lack access to traditional bank accounts due to high fees, certain things like ID requirements, and stringent KYC, which stands for Know Your Customer, and AML requirements, or geographical remoteness. Bitcoin only requires an internet connection and a smartphone or computer, and the wallet-based infrastructure opens up participation in the global economy to literally anybody on planet Earth, regardless of their location or documentation status, which means that even if people in other countries don't have their papers and stuff like that, doesn't mean that they have to starve. So you have the ability to send people who don't have their papers and stuff like that, or have a traditional bank account, money, even if they're working for you, helping out family. So it really just comes in clutch in a lot of areas. And it's a refuge in hyperinflationary economies. So in countries experiencing currency collapse, like for example, Venezuela, Lebanon, or Turkey, citizens often see their life savings wiped out by government mismanagement. Okay, because at the end of the day, if the government controls the fiat currency, Bitcoin is decentralized. So it's not fair that you wake up, pray every single day, grind, and slave for your family. And just because the government wants to go to war or help out too many other countries, your life savings are now pretty much obsolete. So keeping our money in Bitcoin is going to be a really, 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 really strong scenario if you really care about your family's well-being and future as well too. Because you can see governments consistently go into debt, lose certain funding, shut down, and a lot of things happen. And Bitcoin provides a permissionless escape, allowing individuals to store their wealth in a digitally scarce asset that cannot be devalued by local central banks, thereby preserving purchasing power. And users must take direct responsibility for their Bitcoin's custody, right? So you're pretty much like your own bank. You got to be responsible of your secret keys. Don't be being loose with your information. And while channeling, this promotes a culture of self-determination and deepens understanding of monetary policy, leading to greater personal financial literacy. Okay, so be your own boss. Take control of your own account. And you don't even have to have your cryptocurrency on a network with a password and username. You could just hold it on a cold wallet or hold on a network like Phantom, which is just held by secret keys. So pretty much no one can go in and grab your money, not even the IRS. And how you make your money is going to be baked into just purchasing the asset. The potential for profit is rooted in Bitcoin's fundamental economic design and its non-correlated nature relative to traditional assets. And the supply shock mechanism. The price is a function of fixed declining supply meeting exponentially increasing demand. When a halving event occurs, which is once again when 210,000 blocks decide to get put into the cycle and halve, the daily supply of new Bitcoin is suddenly cut in half, while global demand from institutions, ETFs, which stands for exchange traded funds, and retail remains constant or increases. This creates a severe supply shock that historically precedes major price action, and it's going to be a lot more superior than other cryptocurrencies due to the fact that it's finite. Okay, so this is a really, really, really superior supply shock compared to other things too. Okay, a lot of other cryptocurrencies are going to be infinite. So don't expect other cryptocurrencies to hold the same base or store of value that Bitcoin has. You have to remember that finite superiority baked within it. Okay, it's not the same as other cryptocurrencies. And institutional adoption and validation. The introduction of Bitcoin spot ETFs and the allocation of Bitcoin to corporate and hedge fund balance sheets provides massive new avenues for capital influx. And institutions have longer time horizons and deeper capital pools, which adds legitimacy, reduces volatility over time, and drives up the baseline demand, especially as we see more governments holding it. And the power of long-term holding, right? The long-term strategy known as hodling leverages Bitcoin's historical performance, the fact that it's an asset that helps future. And a lot of the times when it comes to cryptocurrency or stocks, inshallah if God wills, you don't even have to look at the chart. If you invest your money into something that's putting a smile on people's faces and helping the world, a lot of the times you'll end up with the positive P&L within like 1 to 5 years, a good chunk of the time. It's plenty of millionaires of people who've never even looked at the chart once. Okay, so take that into consideration when it comes to your psychology of where you're investing. So despite extreme short-term volatility, right, it's a side effect of inelastic supply, Bitcoin has delivered superior annualized returns over the past decade compared to most traditional asset classes, rewarding patience and a belief in its technological and monetary fundamentals. So keep all those strong choices in mind when it comes to why Bitcoin is going up year after year after year. There's a lot of reasons. And Bitcoin is not just a high risk investment. It's a foundational technology designed to offer a superior form of money, one characterized by digital scarcity, righteousness, and offers borderless transaction capability. So feel free to help anyone around the world, help your family, or hire people from other countries due to the fact that now that we have this currency, we can easily have peer-to-peer transactions without a centralized base controlling and holding everything. No more getting your transactions declined. No more the bank stopping your payments from coming through. And by buying and holding Bitcoin, participants are betting on the continued adoption of a sound, mathematically enforced monetary system that stands as an alternative to the inflationary pressure of a fiat currency. And its utility ranges from institutional portfolio diversification, like digital gold, to providing essential financial services to the world's most vulnerable populations. Stay prayed up to God, keep grinding. And if you guys want to learn how to invest, head over to stackmode.net. Catch you in the next one. Peace.
All right, let's talk about how to buy stocks and crypto at the right time. So we'll talk about trend trading and we'll talk about pullback trading. So both are going to be great ways in order to make some profit, both used in different scenarios. And we'll talk about pullback trading first. So pullback trading is going to be when you're buying in an area below where current price already is. So if price is going in an uptrend, you can just wait for price to come back down, buy it again, and take it back up. Okay, this way you could catch an even bigger trade, catch larger profits, and you might even be able to sit on your trade with a lot more safety too, due to the fact that price already dipped. And we know that the stock market and crypto markets are markets where people want to go ahead and hold and gain APY per year. That stands for annual percentage yield. So people are trying to gain APY on their money. I know I definitely am, by holding in something that has value, whether it be in a cryptocurrency that has value or a stock that has value. Okay, so you invest in the future, buy at certain lows, and let's go ahead and let's talk about how we can identify certain lows and how we can buy at these certain areas. So let's go. So first thing we're going to go ahead and have to do is hop on our higher time frames. Higher time frames are going to be important. We got to see everything. We cannot be tunnel vision on the smaller time frames. Okay, if you're on the minute time frame, you might see a downtrend, but then whole time when you're on the daily time frame or weekly, you'll see the trade going up in an upwards direction month after month, week after week, year after year. So make sure you're on your higher time frames, doing your analysis before you scale down. You can use your smaller time frames, but you can really just use them in order to get in at your entry. Okay, so you can use like your 1 minute to get in at your entry, but all your analysis for the most part should come from these two key time frames. They should come from the daily, and they should come from the 4 hour. Daily and the 4 hour are going to be your two time frames that you're going to have to use in order to catch some profitable trades. You've got to see the real trend. So the daily is going to come in play, and then the 4 hour time frame is going to be used in order to show you any candlesticks that you can't see on the daily. Okay, due to the fact that stock market is only Monday through Friday. So sometimes extending trading hours is going to have to come into play. So your 4 hour is going to show you certain candlesticks that you might not be able to see using only the daily candlesticks. Okay, so that's your 4 hours going to have to come into play. And then you could scale down to your 30 minute as well. Okay, personally, I like to go down to that after my 4 hour too, just to verify my entry on an even smaller time frame. Make sure everything correlates, make sure it all lines up before I get in a trade. I'm not going to risk my bread doing anything on the block. I'm going to make sure that playing structured trades that have logistical planning behind them. Okay, one of them making sure we're making some bread in the markets, not wasting money that we've worked hard for. Okay, so buying pullbacks are going to be extremely important. Stop buying at all-time highs. Okay, don't hop on Twitter, don't hop on Instagram, YouTube, or anywhere and see hype being talked about. Okay, a lot of people are just now buying in Nvidia, for example, and a lot of times by the time things are being posted, stuff is probably already at all-time highs. Okay, by the time media gets things, it's already too late for the most part. So here's how to identify real dips. So one, use your daily time frame and see where current price is at in the first place. Okay, current price is at all-time highs, you have to wait for a pullback. Okay, don't buy at all-time highs, because one, think of it logically. People got in way over here to the left. Okay, some people have been holding these trades for years, way over here. Okay, they're going to sell eventually. So anytime price makes an area of resistance and falls in a downwards direction, all it is people taking their bread off the market. Okay, nobody's about to sit and hold for an unlimited period of time. Once people are up some profits, 1,000% plus, okay, people are going to be like, you know what, these are some great gains. Let me go ahead and take some money on off. Okay, especially when they've been holding for a few years
definitely down to go ahead and get paid. Okay, it's a lot of money increase within these past couple of years. Okay, if you've held Nvidia for 5 years, for example, could have got in at around $50 a share. Okay, and price today is at $252 a share. Okay, so that's almost a 4x of your money. Okay, so you can put your money in a shares calculator too to go ahead and check everything out and see the actual percentage yield you would have gone ahead and returned based off of that. Okay, so prices at all-time highs. Don't buy at all-time highs. Wait for price to pull back. Okay, so you're going to be looking for two things on a pullback. You're going to be looking at an area of support to be touched again. Okay, price can either mirror supports, okay, the same support area that it bounced off of another time, or it's going to go ahead, bounce down, and try and turn an area of resistance below current price into support. Okay, and that's primarily where your pullback areas are going to come from. It's either going to be an area of support below current price or an area of resistance below current price that you see on your 4-hour or daily time frames. Okay, so my daily time frame, I can see where all-time highs. Let me go ahead and put a line here at the top of all-time highs resistance. Let me get on my 4-hour time frame, zoom out. Okay, and let's go ahead and identify how we can find the best levels here. So stocks is going to be a bit different. I'm going to go to my indicators here. Turn on that market open marker indicator here, the one by Charmeager. Okay, then from here, I can get on my 30-minute time frame. Okay, so I'm going to go ahead and look at areas in between these green shaded boxes. This is going to be for stock market. Okay, cryptocurrency is going to be a little bit of a different analysis, but for stocks, this is how it's going to go. Look at these green shaded areas. I'm going to go ahead and put lines at the 9:30 a.m. areas. Okay, so it's showing me when market opens. Market opens at 9:30 a.m. Eastern time. Okay, hence it's why it's called the New York Stock Exchange. Okay, everything is based off of Eastern time. New York is in Eastern time. So I'm going to look below current price. Okay, current price right now is going to be 253. So I'm going to look at 930 levels below current price, expecting price to go down to these levels and give me a bounce back up. Okay, so let's go and let's mark some levels. So let's jump into it. So I'm going to stay on my 30-minute time frame, and I'm going to look below current price at certain levels that I'm going to be paying attention to. Okay, so I have a 930 level right here too. Boom. Go. And just check the direction and the flow of where the chart is going. Okay, if you can't tell which way the direction is going from the candlestick, then you feel free to hop down to something like your 15-minute time frame, where you can see things a little bit more cordially. Okay, so let's say I delete everything here. Okay, price is at 253. I look below current price. Okay, have this area of support right here. And that matches this area of support over here. Okay, so we know that this could be a potential area right here. Now I'm going to keep looking at areas below current price. Have this area of support down here. Area of support down here. And even down here. As you can see, some of these areas are going to line up with each other. Okay, the more areas that you see line up with each other, the more probable that area is going to be tapped again, inshallah. Okay, so use your past information as data. So we have this area down here too. So, and you can even go down to your 5-minute too to see things just a little bit closer, just to verify that these 930 levels are exactly what you're looking at. Okay. Nice, so right here, up here, okay, very, very clean. We're going to put a line down here.
Looking below current price here. Have an area of resistance right here. And area of support down here. Yeah. Then I can go to my 4-hour time frame. And I can wait for price to pull back to any of these levels. Okay. So if I see price pull back to any of these levels, I can be like, okay, you know what? I'm going to go ahead and trust that price wants to potentially give me a retest off of any of these areas here. Okay, these are all 930 areas here that are going to be extremely just key levels here. 930 levels are going to be important because it's when market opens. Okay, when market opens, everyone's excited. There's going to be a large rush, and that's going to be the time where the most orders are going to be in place. So Eastern traders are trading, okay, or American traders in general, and European traders are both trading in the same session. Okay, so a lot of the time, the volume is going to be extremely high. Okay, so if you've heard of London session, that's going to include New York session during this time. So for stocks, that's going to be an easy trick in order to find the cleanest areas of support and resistance in order to identify where you want price to pull back. So if price pulls back to any of these levels, okay, and personally, I like to wait for a 4-hour close. Okay, so 4-hour close is going to mean I'm never going to really take the first wick like this, how price tapped the black line and then went up. I don't normally take the first wick. I'll take something like this, the second wick, or the second candlestick with a wick above where my zone is. This way I know that price truly wants to reverse in an upward direction, potentially get pulled back on. And then you can be upset and be like, you know what, dang, I shouldn't have taken that trade. You know, I didn't know if it was ready. And you don't want to be getting pulled back on for no reason. Okay, so take your time. Let the trade verify itself and catch the whole sweep in upward direction. Okay, so let's go over another example here. And this works for all stocks, all popular stocks. And we'll talk about a trend trading example here. Okay. So when you're trading with the trend too, it's going to be a lot of volume. What volume is going to be? It's going to be the amount of people trading. Okay. So when there's a lot of people trading, your trading should happen in a quick direction. Okay. Because everyone's expecting price to go in the direction in which your trade is planned in. Okay. So let's do it. So if I got on my 5-minute time frame here, I got on my market open marker. I'm going to look above current price. I'm going to go ahead and mark this area of support here. Okay. Okay, just so we have this area here as data. I got this area up here. It's going to represent some resistance. Okay. Or I could do the support area right here. Breakout area in between it, very clean. Okay. We have this area up here that matches with this area. Okay, so as you can see, one area of resistance right here matches with another area of 930 resistance here. Okay, the more taps, the better. Okay, more taps, the better. And as you can see, we have a tap here from previous levels. So we know that these levels are going to be probable. A lot of levels here working out extremely nice. I'm going to go ahead and put a line here at this area of resistance. So you can see price went in a downwards direction. Okay, so that's why I put it at the top, signaling where the resistance is. Another candlestick wicking off of previous data. Okay, so the more data that we see, the more probable we know the trade is going to be, inshallah. So up here, resistance as well too. We got right here an area of support. Okay, because we know price is going in upwards flow here, and then price bounced off the area of support again. Okay, so take your time when you're reading the chart. You can do this on your 5-minute time frame too. Okay, it's easy to read. This area of resistance kind of close right here. Yep. And then if you run out of candlesticks or if you don't have premium data, then you could go back and do like the 15-minute stuff like that. But I know not everyone has that, so yeah, just read your higher time frames as best you can. And then, yeah, waiting for price to pull back to these zones here.
this area here. Okay, so these are going to be just very clean areas that I'm going to be relying on. As you can see, the more taps that we have, especially on past lines, the better. Okay, another tap right here. Another tap right here. All these taps are reacting off of each other. Once you do these levels once, you're going to be good. You don't have to continue to do them all over again. Okay, they're going to be here for you. Okay, and you can just update them as price decides to go ahead and continue in an upwards or downwards direction. Okay, so right here. And as you can see, another area of resistance being reacted off of right here. Okay, so after you do all your levels like that, you can go back to current price, go back to your higher time frames, and you can check everything out. Okay, so say I'm on Amazon here. Okay, I could either wait for price to get above, let's say, this black line here. Okay, I could wait for price to break and retest and take it up to this area here. Okay, take this as first take profit, and then I could take up here as the second one. Okay, if I wanted to. Okay, so you can be very flexible once you have your levels down. Okay, even if price decides to come down, give me a pullback off of here, that'd be fine. Okay, or even if price goes up and gives me a pullback at this level, that'd be valid. Okay, so even if price gets above these black lines and gives you a pullback, that's going to be valid. So whether you pay the head break and retest or wait for price to pull even back further, okay, it's going to be just up to you depending on the market. And once you have your levels down, you're going to be good. You're going to have your information. You're going to know what to do, and you're not going to be panicking. Okay, so I also have this strong area right here too. This is the 30. Yep. But then you could check your 4-hour time frame too. Just scan it all. Make sure everything makes sense. Okay, so I can see. Yep. So I can see, okay, price wants to potentially come back to these levels here. If I see price give me a 4-hour close above or below these levels, then I'm going to be like, okay, these are going to be some clean levels. Okay, so let's go over another example here. So we'll do Google. Or actually, you know what? We'll do Tesla. Okay, big stock. I know a lot of people like to invest in that. Let's do it. So starting off on my daily time frame here, it's going to give you my bird's eye view for absolutely everything. Okay, it's going to help me see what I need to see. Okay, it's going to help me put everything into a global perspective. So when it comes to the global stock market and cryptocurrency, I know that price is trying to go in an upwards direction. Okay, due to the fact that companies aren't putting in hard work for their stock to not go up in value. Okay, there's dividends and company owners get paid more depending on their share status. Okay, so billionaires and stuff like that. It's not $1 billion in a bank account. There's not bank accounts that can really hold like hundreds of millions of dollars and stuff like that. So a lot of the time it comes from a person's company share value is what makes them a billionaire. Okay, so not the pure fiat cash value. So knowing that, we know that the value of certain currencies are trying to go up, whether it be it a cryptocurrency or a stock, okay, like Tesla. It's always trying to innovate, always trying to get better, and always trying to improve with these things down here called financial earnings. Financial earnings are letting you know if a company is profitable or not. If a company is beating these, like slamming these year after year, month after month, making bread, you know it's going to be a good company. Okay, sometimes Tesla beats earnings, and sometimes it misses it. It can be inconsistent, but then you'll take a company like Nvidia, for example, that consistently beats earnings over and over again. Okay. So I'm not saying things that don't beat earnings consistently are going to be bad investments, just they can have more fluctuations due to the fact that the earnings are going to be negative sometimes. So still, same logic stands. Price is trying to hunt the area of resistance above current price. Okay, so we know it's trying to hit this all-time highs here because it's trying to make some new all-time highs. This price is trying to keep going. It's not trying to stay in the same place. Okay, it's just like real life. So you can see from 2018, shares were $20 a share. Now they're $434 a share. Okay, many millionaires were made by just buying and holding. Okay, so all it takes is just a couple of years of buying and holding,
M's will be made. Okay, but just like the plays I've been really just researching and really just planning yourself in the future, we have opportunities over and over again. Okay, during this Tesla time, Apple coming out with AirPods, Face ID and stuff like that, 2016, 2013, a lot of millionaires made there. Okay, there's always going to be an opportunity. There's going to be a lot of new AI companies, inshallah, hitting the stock market soon. Okay, so any good AI companies hitting the stock market will definitely go ahead and be a good play. Okay, so investing in the future, depending on whenever you're watching this, is going to go ahead and be important. Just keep investing into the future. Whatever time period you're in, invest into the future. Okay, as of 2025, cryptocurrency and AI are two things that's really innovating anything forward. So NVIDIA, for example, has been going in a very bullish standpoint due to the fact that AI chips are produced from it. Okay, so anything AI related as of like 2025, it's going to be extremely popular. Okay, so cryptocurrency is also going to be something that's popular too. So brokers like Robinhood, okay, as of 2025 has able to shot up, okay, within a pretty instantaneous standpoint. Wow. So due to the fact that people know that it's a great company, okay, people need it in order to trade, okay, and it's very, very user friendly. Okay, so people invest into the future and make some money with the share. So we know that price is trying to always hunt new resistances and break out from those resistances. Okay, you can even see this resistance right here. Go to my 4 hour. You can see right here. Price created an area of resistance right here. And as you can see, resistance got broken and turned into support right here. Amazing break and retest. And then price decided to go up in this upwards direction. Okay, we filled this area of resistance up here. Okay. And we're trying to fill this area of resistance into this area of resistance all the way up here. Okay, extremely, extremely nice. And we see which way price wants to head. All the way up here to all-time highs. So here's how to trade pullback levels, even if price is all the way up here. So same thing I would do, just like before. I could go to my 5-minute time frame. I can go back as far as I possibly can. So on the 5-minute time frame, let me go all the way back. I'm gonna start placing out levels below current price. So my current price is currently 436.32. Okay, 436.32. We look below current price. Mark this area of support. Why? Because it's below current price. Same right thing right here. Mark this area of support because it's below current price. So I'm going to stay on the 5-minute time frame. Keep marking areas of resistance. Okay, area of resistance right here too. I'm going to keep marking areas of resistance or support. Okay, depending on the direction of the candlestick. Okay, so if I see price going in a downwards direction after the 930 candlestick, then I can assume that the top of the candlestick is going to be where the level started. Okay, so put it where the level started. As you can see, you're going to have correlations. One tap right here where price decides to fall downward, and a whole another tap right here. Okay, so price a lot of times will mirror itself too. That's what makes trading simple. Okay, have your levels marked out, and you're the only thing that can self-sabotage anything. Okay, everything's already done for you. So look, the resistance here was created, did it again a couple of days later. Okay, it's double resistance mirror. Okay, and as you can see, price got broken, turned into support, and then price filled up to the next area up here. Okay, that's a 4-point trade. 4-point trade is very nice money on it. Okay, especially on Tesla. It's crazy money. Okay, it's times on Tesla I've been in a trade for like 2 minutes, like 3 figures, and just instantly closed. Okay, and just stuff like that. Okay, so yeah, especially my early days. So yeah, Tesla, it can be wild. But when you start playing it logically, like I was just playing like a fool, okay, when you actually play it how it's supposed to be played with levels and just all your analytics down, it's going to be lethal. Okay, it's a great way to make some just profit. So these day trades, especially when you have all these levels down, it's going to be really clean. So right here, we have this area of resistance. And just go as far as you can with the 5-minute time frame here. Down here, key area of support. It's literally going to give us the best levels here. Okay, the key levels that we got to be paying attention to
Okay, and then price decided to go in an upward direction here. Price created resistance here, fell down. Price created support down here, went up. Resistance right here. Another support down here. Support or not resistance, not support. Price went up. And then breakout in between that level 2. Really nice level there. 930 support right here. Price went in the upward direction, so bottom of the candlestick. And we have another high up here. Okay, even up here. Area of resistance. So the more levels we have filling in the space is going to be just the better. Okay, bottom right here. Okay, and then I'm going to have this area right here too, where price decides to go in the downwards direction. And then down here. Yep, this area right here. Okay, and then let me go ahead and mark this area right here too. So let's just say I did all these levels, for example. I can go to my 4-hour, check everything out here, okay? So I can know that, okay, if price pulls back to any of these levels here, okay, I could potentially go ahead and take a day trade, okay? So even if price decides to give you some break and retest, okay, you can also take trades based on that too. Okay, so either that or wait for price to just pull back to these levels simply. Once again, all-time highs all the way up there. So you can just wait for price to pull back to any of these levels, give you a 4-hour close, and then go ahead and take your trade. Okay, in between here, this whole gray space, I would just go on like your higher time frames, go to the left. Since the price action is too old, even on 30-minute, it can be too old. If you're not a premium user, and just put it down the best levels you can. So at the top of the resistance here from the 30. Top of the resistance here from the 30. Okay, which lines up with this one. Okay, got the bottom right here. Price went in upwards direction. 930. 930 resistance up here. 930 support. Not resistance, actually. Price support right here. There we go. And a lot of these levels, once again, are gonna correlate for sure. Okay. There we go. So then from there, after you have all your key levels down, okay, you have all your information. So even if market decides to go in a bear market, okay, if you see a sweep from any of these levels below current price, okay, then you know, like, you know what, this is actually going to be a pretty decent buy area. Let me go ahead and take my chances. Okay, you can check out your levels too on your 30-minute time frame. Okay, just make sure everything looks how it's supposed to. But if price goes down, gives you a 4-hour close from one of these sweep areas, then go ahead and take the trade and show up. Okay, let's go over some crypto examples. So crypto is going to pretty much be the same for the most part. Only thing on crypto is that you can't do the 930 strategy. For the most part, you have to primarily just use your daily in your 4-hour time frame, which is still going to be extremely strong. But yeah, let's go and let's cover it. So we'll cover Bitcoin first, for example. So Bitcoin. Okay, if I wanted to read Bitcoin, start off on my daily time frame, just like I always would. I'm going to be putting a line at all-time highs because I know people wanted to break all-time highs in order for price in order to progress in a bullish scenario. Okay, so think of it from a human standpoint. People wanted to see numbers go up, So I know that my goal is always going to be all-time highs. Okay. Now, on the daily time frame, I'm going to go ahead and analyze certain setups. Okay. So I can go ahead and see, okay, price has this area of support down here. Okay. Price might want to feel this area of support right here. Okay. So waiting for the right time, waiting for pullbacks, it's going to be important. Okay. So we don't want to just buy willy-nilly. Okay. We're going to see, okay, you know, was price want to break this trend line? Okay. If it does, then we know the support wants to get reached. Okay. Then you'll see if the support will be held or broken. Okay. If support gets broken, then you're also going to be able to, pull back to the next level. Okay. And you can use your 4-hour and your daily levels. Crypto is also going to have a lot more levels too, because it's 24/7. So, but still, areas of support are going to be valid because you can see this right here. Check it. Look at this area of support all the way over here. Bounced once, came down to the area of support, bounced again. Okay. And then came back a couple months later, bounced again from the same area. Okay, so on crypto, supports can also be extremely powerful and strong in order when making your TA. Yep, and we're always going to be waiting on our 4-hour candle close. So yeah, 4-hour candle close is just going to give us a good jurisdiction, like, you know what, this is a good trade. And you can see the timer all the way to the right and whatever broker you're on too. So yeah. So after that, you can go ahead and see, okay, you know what, price created this ultimate level. Okay, but price doesn't always have to come down to an area of support. Okay, once again, it can stop in an area of resistance. Okay, it can turn resistance to support, and then it can go ahead and bounce. Okay. So plot out your trades neatly. Okay, make sure it's a strong area of resistance that you think is going to be successful. Okay, take this example. This area right here of resistance decided to get broken and it turned into support right here. Okay, clean. Okay, break and retest, extremely clean. So I could, once again, try to buy at the areas of support below current price, okay, and see if price wants to give me the same bounce. Or I'm looking below current price and marking areas of resistance that are going to be strong and heavy and seeing if price wants to give me a retest level. Okay, check this out. Area of resistance 1 and resistance 2. Okay, guess what? Price broke out of the resistance over here, break and retest. Okay, and then price continue in the upwards direction. Okay, and same thing over here. After price support mirrored here, all it did was do it again. So support mirror. Okay, price will mimic itself. It's just about finding the key good reactions. Okay, and that's when the price did it, it decided to blast off. Why? Because when price did it right here, it blasted off. Okay, so just know what you're investing into and know where. Knowing where is going to send you to a different realm. Okay, you're really going to understand what's going on when you know where to get in and where to exit. Okay, those are going to be the two most important things other than risk management when it comes to these charts, is knowing what to get in and knowing what to exit. Okay, you cannot be cooking your trades, holding way too long for no reason. Okay, so that's how you find pullback levels even without the 930 strategy. Okay, or you can wait for an area above current price to be broken, turn it to support. Okay, and that's going to be trading with the flow. Okay, and it's going to be different depending on what your goal is.
So if you're trying to hold a cryptocurrency for years, then trading with the flow like that might be different than trading pullbacks. Okay. Because you want to be buying at the lows. Okay. You're expecting to hold for years. Okay. So when price is dumping, you should be happy. Okay. But if you're a day trader, option trader, or just a trend trader in general, okay, then you might want to wait for resistance to be broken. So this is support. Okay. Make sure you can trust the trade. Okay. And let it rock out. Let it do its thing. All right. Yep, resistances below current price. We're going to go ahead and do, because we know resistance can be broken and turn into support. And then we're also going to do sometimes the supports. Let's check this out. Amazing example on XRP. So right here, as you can see, this low right here got met up with this low right here. Okay, so supports a lot of the times we'll try to meet, especially if it's a bear scenario. Now, will it not break is another question, but a lot of the times Chicago support and certain things like that within the stock exchange is really going to be imperative. Okay, so look at the support, look at the key levels, and make sure everything just makes sense. Okay, so look at the bull. Okay, so bull. Okay, so think of the Chicago Bulls, think of a U. A lot of the time your trade is going to go ahead and look like a U. Okay, it's going to look like a horn. So your sweeps, whether in a downward scenario, okay, price might try to sweep down, meet the supports. Okay, bullhorn down. Or in an upside formation, price might try to meet these areas of support here and then sweep to an upwards direction up here. Okay, so an upwards U. Okay, so price can go up in that direction or go down in a certain direction. Okay, so if it's just hit an area of resistance and it's falling in a downwards direction, price might be trying to hit an area of support below current price to try and meet at and then try and bounce again like it's doing here. Or it's going to try and find an area of resistance below current price and try and bounce there due to the fact that resistance can be broken and turn into support. Okay, so it's about catching the flow and just making sure that we're trading the right things properly. Okay, so it'll be trying to bull rush down, okay, to an area of support or resistance just so people can buy it again. Okay, because on the daily time frame, just like we talked about in the beginning, if I zoom out, price is nowhere near where it was like a couple years ago. Okay, 2022, price was at 0.30. Okay, and price now is at 2.8. Okay, really big jump in XRP. Okay, over the course of a couple of years. Okay, so it's just about where you're buying, catching the sweeps, and holding your positions, even though certain things are going to take time. Okay, so let's go and let's check out this example here. So you know price once again is going to try and hunt certain areas of supports, just like the other cryptocurrency we just looked at. Price decided to hunt the area of support that was right here and bounce at the area again. Okay, and we are getting some 4-hour closes, so we'll see if it wants to hold. Okay, but in this instance here, you could also wait for an area of support above current price to be invalidated. Okay, so this area of support, and if support below current price gets ran through, or if support below current price gets turned into resistance and then ran through, okay, then that area could be a decent area. Okay, so I get on my 30-minute here, see the strong area of support. Okay, price has the potential, and you could see some support candles here too. Okay. Price has the potential to break above this area and give it a support mirror. Okay, so I call this inverse break and retest, and price can definitely do this too. Let's say it wants to go ahead and fill like the resistance area up here. Okay. or even just up here. And then check everything on your higher time frames. So you can see, okay, higher time frame support is obvious here. So if price decides to go up, okay, turn this area of support into support again by inverse breaker retesting, that can go ahead and be a valid area to play too. So let's go over this. Okay, so we'll go over some meta. All right, so we can go ahead and see price all the way up here. Okay, price is trying to hunt all-time highs, and we're currently in dumping period. Okay, when you see heavy, aggressive red daily candles like the one right here, then you know price is trying to hunt for a low in order for price to retest, okay, or just find a certain support low and bounce its way back up to certain all-time highs. Okay, check it out. I zoom all the way out. I look at the daily here. See, over the course of the years, price has just been going in an upwards direction. Okay, flowing. So, knowing that, area of resistance above current price, we can go ahead and keep that here. Okay, why? Because we know price has to break areas of resistance in order to progress. Okay, so we're going to put that here as my take profit and my goal. Okay. Then from there, put my 4 hour time frame. Okay, and let me look down below current price. Okay, so I can just see the structure here. Okay, I can see price meeting up with this area of support here. And since it is the stock market too, unlike cryptocurrency, I can actually swap over to my 15-minute or 30-minute time frame and use the market open marker indicator. Okay, so I can check out the lows and see if anything does make sense. Okay, so I'm looking at levels below current price, and we're going to see if price wants to bounce at any of these areas potentially. Okay, we have this level right here. Price decides to go in upwards direction from here. And then price right here. Upwards direction. Have our area of support down here too. And we're going to go on the 5-minute too, make sure everything is clean how it should be. Okay. This area of support makes sense on the 5-minute. This area of support makes sense on the 5-minute. Same thing with here. Okay, so the 15-minute and 5-minute going to give you really clean, accurate entries. Okay. Right here, we got this area of resistance right here. Actually, not support. We're going upward direction. Support right here, lining up with it. Resistance lining up with it over here. We got support right here. Price lining up with that. Resistance right here. The price is falling in a downward direction here. Price here, falling down. Price down here, bouncing upwards direction. Then right here. We got this level here. Okay. And a lot of times I like to wait for a good 4-hour close. So price is kind of starting to bounce at this black line right here, okay, indicating a level. Okay, so if price decides to keep going in an upwards direction, this could be a potential pullback level that's valid. Now, if price decides to break below it and it tries to retest from this level here, that's fine. Okay, it could break this one and try this one, or here, or here, or here. You get the gist. Okay, any of these levels that give you a good 4-hour close and a sweep, or you could even wait for a daily close too for even more safety. Okay, you can go ahead and just plant buy years out, okay, depending on your options contracts. Okay, you can buy years out or as many months out as you can, or you could just buy shares. Okay, sit on it, hold, and just hold positions until certain take profits, like let's say all-time highs up here, something like that, for example. Okay, let price do its thing. Let price gain equity, okay, and let your money gain APY by just putting down good profitable trades. Okay. So price could potentially want to hold this area here, okay, especially after this heavy area of dumping in a downwards direction. Okay. So might want to hold here, and something that makes this area more exciting too, I can see on the 4-hour this area of support right here too. Okay, so price decided to make the same area of support here and then blast it in upwards direction. So this area of pullback here could mostly be pretty good. Okay. So when you're doing examples, make sure you're paying attention to key parameters. Okay, let's go and let's do Palantir. So Palantir here, price is trying to go ahead and chase this all-time highs. Okay. I can go to my 15-minute here. I can look below current price if I wanted to. Or I could look above current price and play the trend continuation, okay, if I wanted to. Or once again, I could look below current price. Okay. Or for pullback, so we got this area here. I'm getting my 5-minute. Make sure I got accurate entries. 930 support here. 930 support here. And we got this area right here. And then price decided to go in upwards direction right here. Okay, so the more lines in the zone, ideally the better. And that zone is going to be pretty strong for the most part. Price bouncing in upwards direction from here. Down here, price bouncing in upwards direction. Price shorted right here. Shorted right here. Bounce in the upwards direction here. Okay. Some short here. Okay. Getting all these reactions down. Resistance here. Yep, support. Okay. Support down there. And like you see right here, sometimes the levels are going to go ahead and correlate. 1, 2 taps of the same level. Okay, the more taps of the level that you see, the better a lot of the times. And the 930 strategy only works for stocks. Cryptocurrency, you got to use your daily 4-hour in your smaller time frames to verify everything normally. Support. And then resistance. Okay. And down here. And then we can go to current price. Go to our 4-hour time frame. Check out everything. Okay. So I know if price pulls back, honestly, I could just make this one big zone here. So I know if price pulls back to any of these areas, price could potentially give me a good bounce. Okay, price could give me a good bounce to a higher direction. Okay, so that's what I'm going to be looking for ideally. Okay, so price could come down to this black line, give me a 4-hour close, try and bounce in upwards direction. If not, we could try this zone here, or try this line, or here, or here, or here, or here. Ideally, these are going to be some strong levels we're going to be able to play. okay, if price decides to go in a downwards direction. Okay. Then from there, we can buy the pullbacks and buy months and weeks out. Yep. So yeah, 4 hour daily and then 30-minute for crypto, and then time frames for stocks for the market open maker. It'd be like your 4 hour, your daily, and then like the 5-minute. So both of those together, or all of those together, are going to be like an extreme combination. But especially your 4 hour and your daily together is going to be your 4 hour and your daily together. It's going to give you good combination. Okay. So yeah, we'll stop there. Hey class, we're going to be talking about the future of cryptocurrency. Let's go and let's break down Web3, AI, and the interoperability of the whole blockchain and decentralized technology space. Let's jump into it. So let's talk about Web3. It's the ownership revolution. So Web3 is the next evolution of the internet, and it's characterized by decentralization and user ownership of data and assets. And it's the big shift from renting to owning. So right now, we currently use the Web 2 system, and it's run on centralized platforms like Google and Meta, and they own your content and data, which is susceptible to hackers and certain things like that as well. But Web 3, what the future is going to go ahead and concur, the users own their identities, data, and digital assets via NFTs, tokens, and the blockchain decentralized system, which means that transactions have to operate via autonomous codes called smart contracts, instead of a centralized system like banks, where transactions have to be confirmed by a centralized intermediary. And the transition empowers individuals and reduces reliance on large tech intermediaries. So decentralized finance, also known as DeFi, its financial service uses smart contracts systems without banks. Okay? And DAOs stands for decentralized autonomous organizations, and their governance run by code and token holders. So Web3 is a really, really big shift. It's putting power back into people's hands. So instead of having your money being declined, let's say, for instance, you wanted to send money to someone in a different country. Let's say they built your website, for example, and, as online business increases, people from other countries are also going to be participating as well too. And quick way in order to send transactions, invoices, whatever, is cryptocurrency, okay? Without any intermediaries, no fees, no wire transfer fees, and no ability to get declined. You try to send like $1 million USD to someone in Thailand, bot, right? It's going to be a lot different, okay? You're going to run into fee issues. They might think that it's fraud, and it's a large chance that the transaction just won't go through, okay? But whenever you're sending it via cryptocurrency on the smart chain system, it's not worried about that. Everything is automatically being run through. Think of it kind of like a vending machine. When you go up to the vending machine, you put in that dollar, you get what you want. Okay, that's how cryptocurrency works. But when you go to the drive-through, the person has to hand you the food. Okay, the person could drop the food. The person could do a lot of stuff to the food. Okay, they could crumble up the food and throw it away. There's a lot of stuff that can happen. Okay, but if you go up to the vending machine, you put in your dollar, you're gonna get that. Okay, so it's up to the person whether or not they really want to give you your food, even if you paid. So that's the traditional centralized system. But decentralized is going to be the vending machine system. If you put in that dollar, it's going to automatically give you whatever you selected. Okay, it's a lot more efficient, it's quicker, and no deception or human emotions can even cultivate in the existence of your transactions. Okay, and you're dealing with money, you're not trying to be worried about getting your transaction declined. Okay, you're a human being, you got stuff to do, you got bills to pay, I'm sure you have people to take care of. You're trying to get from A to B. Okay, so cryptocurrency is going to be a good place to run transactions and large invoices relatively quickly. So doing big deals via cryptocurrency is going to be a really good way to quickly do transactions without having to wait for banks to confirm it, freeze your account, etc. So interoperability. All right, let's go and let's talk about breaking down the walls. So blockchains currently exist as walled gardens, and the future requires them to talk seamlessly. So the problem fragmentation, a part of it. So assets and data are locked onto the native chain, so such as Ethereum and Solana. And high friction is involved when moving tokens between the chains. and developers are limited to one single ecosystem. Okay, but as time progresses, as more development and coders implement different types of technology in order to make things more efficient, I can see things changing within the future. And users have fragmented digital identities across different chains as well too, making it extremely secure. So the solution: crisscross communication. And protocols are building bridges and standardized layers, also known as layer zeros. And bridges allow asset transfers. Okay. So whenever you're trying to swap a meme coin, for example, let's say you hopped on Phantom Wallet, Coinbase, whatever. Okay. If you're gonna go ahead and get Pepe the Coin Frog, right? In order to purchase Pepe the Coin Frog coin, you need Solana first. Okay. So Solana is gonna be the first asset you're gonna need in order to buy a meme coin, for example. And that's gonna be a bridge. And layer zero is gonna be the infrastructure, like Cosmos or Polkadot, for example. And it's designed to connect independent chains. And the goal of it to provide a single fluid digital economy where value can move instantly and people can get what they want. So let's say, for instance, if you wanted to exchange USD for, once again, Thailand's currency, right? Thailand's currency is going to be bought, for example. Okay, let's say Swiss, okay? Or if you wanted to exchange Thailand bot for the Swiss franc, okay? Say if you're swapping certain things like bot from USD currency, then the bridge is going to go ahead and what's to be allowable with the asset transfer class. And layer zero, that's going to be the infrastructure like Cosmos, Polkadot. That's designed to connect the independent chains and link everything all together. And the goal is for really to provide a decentralized space where it's single, fluid, and it's a digital economy where value can move instantly and people can exchange for what they want. So if you're going to the currency exchange, it could take some time. There could be fees and quite some other things involved when exchanging one currency to the other. You're also going to need another bank account system. Okay, in some cases too, if you're not getting all cash, and just a way to go ahead and spend that other currency as well too. Whether you're just getting a cryptocurrency card, you're going to be able to spend that all across the world as long as they take Visa, for example. Okay, so if you were to get like a Coinbase card that provides Visa or certain other brokers provide it too, then you could use that all over the world and use that to spend money. Okay. And AI in crypto. Okay, AI can monitor blockchain data for anomalies and instantly detect fraud or exploits of smart contracts. So certain things too, like bank hacks, can be susceptible due to certain errors, okay, and things like that. Certain transactions that could be completely legitimate could be declined, okay, due to human error as well too. But when everything is being dealt with via the smart contract system and AI, everything's going to be a lot more automatic. And things are going to be seamless, okay, transitional, and stuff is not going to be as barrier locked. And AI models manage vast liquidity pools, optimizing lending rates, and they execute complex low latency strategies, implementing quick transaction swapping too. Okay, so even if you do $1 billion transaction from one person to another, it's all going to be automatically calculated, and it should be in one person's wallet within a couple of minutes or hours. And autonomous DAOs, and AI can automate repetitive governance tasks, and it deals with the treasury management, proposal filtering, and it just makes DAOs more efficient. And AI becomes the intelligence layer running on the decentralized foundation of Web3 in general. And the converged ecosystem, so powering the future, and universal access. Let's talk about interoperability. Developers build once, deploy anywhere, and utilize liquidity and user base across every single chain. Okay. So whoever's developing a token or enhancing the Web3 space in general, everything is going to be seamless, okay? And when it's on the decentralized space, it's power back to the people, okay? Once again, that's what we talked about. And DApps, they evolve their own functionality and security protocols based on real-time data analysis. And users can also retain sovereign control over assets which interact with intelligent cross-chain applications. And this trio of systems creates an internet that's smart, seamless, and owned by its users. Okay, so instead of transactions being declined, instead of superpower or someone being able to control a whole pot of the pie, everything is being dealt with power of the people. AI is really going to keep everything stable and safe, so no human superpower can take over one area of the finance space. Okay, so Web3 is going to bring fairness back to the global economy. And Web3 is the foundation. So the blockchain provides trustless ledger for ownership and transactions and a safe place to keep your money stored as well too. And interoperability is scalability, and the ability for chains to connect determines the speed of adoption and utility in general. And the next generation of innovation lies at the intersection of decentralization and machine intelligence. So if you want to learn more about cryptocurrency or the whole decentralized finance, DeFi, or blockchain space, head over to stackmode.net. Step right up to God, keep grinding, and I'll catch you in the next one. Peace. Let's go and let's jump straight into the lesson. This is going to be the differences between stocks, shares, and options. Let's go. And at their core, stocks and shares refer to the same thing, a unit of ownership in a corporation or a company. And the terms are often used interchangeably, and though shares typically refers to the number of individual units held by an investor, and while stock is more of a general term used for the entire collection of shares. Okay, so for example, I own 10 shares. 10 shares is going to be the amount, the percentage of the company that you want to be a hold of. Okay, the amount of shares equals the amount of percentage ownership that you have in the company. Okay, so if you want to own 10 shares of Apple stock, okay, and Apple is going to be the primary stock. Okay, shares is the percentage amount that you own, and the stock is going to be the name. And here's what they represent. Owning a share means that you're a partial owner of a company, and as an owner, you have to represent. Okay, and you also have a claim on a portion of the company's assets and earnings. And this ownership gives you a right to the company's profits. And it's distributed as what's called dividends. Okay, and dividends, especially if you have enough shares invested into, then dividends will go ahead and be paid out to you. And this way you can be able to make money just by being an investor. And in saying the corporate matters though, it's also going to give you some voting rights depending on the amount of share that you have. And for every share that you own, you typically get one vote. Okay, so the more shares that you have, the more votes that you're going to have. Okay, so you're going to have one vote per share, for example. Okay, and that allows you to influence key decisions like electing the board of directors and who's going to be controlling the future of the company's growth. And why do companies issue them in the first place? Companies sell shares to the public to raise capital, and this money can be used for expansion. So whenever you guys see millionaires, billionaires, stuff like that, and they're company owners, a lot of the time it's not in raw dollar currency, okay, sitting in a bank account. A lot of the time they're rich through the company they own, and a lot of times it's on the stock market, okay, and then that company generates money. And since they're associated with it, or the leader, they get the money associated with the tag, so then they get to be a billionaire. For example, any creator of, like, say, company.com, okay, say they have $500 a share worth, okay, the owner of it, let's say the company does $10 million a year, okay, the owner of it would be classified as a billionaire because he's the owner of it. So that's normally how that works. So they sell shares to the public to raise capital and raise money. And this money can be used for future building expansion of the company, research, paying off your debt, and other business goals. And this process is known as an initial public offering, also known as an IPO. And this transforms a private company into a public one. And this is when shareholders, okay, can invest like me and you if we wanted to. And for a company like Google, for example, a public offering allows them to raise billions of dollars to fund new ventures. And when you buy shares directly from a company during an IPO, you're participating in a primary market. And after the IPO, shares are bought and sold among investors on exchanges like the New York Stock Exchange or NASDAQ, then that's going to be the secondary market. Okay. So when you're buying shares directly from the company during from IPO, okay, that's a primary market. And after the IPO shares are bought and sold among the investors, okay, on exchanges like your New York Stock Exchange, that is the secondary market. So let's talk about equities. The broader view is ownership. So the term equities is a broader financial concept, and it encompasses all ownership interests in a business, which includes common stock, preferred stock, and retained earnings. And it represents the value that would be returned to a company's shareholders if all assets were liquidated and all debts were paid off. And on a company's balance sheet, it's often referred to as shareholders' equity or owner's equity. Let's talk about shareholders' equity. This is a fundamental metric used by analysts to assess a company's financial health. Okay. So, and it calculates it by calculating the assets minus the liabilities. Okay, so what assets are things that a company needs. Let's say like the light bill. Okay, a company might need a light bill in order to run a factory, for example. That's assets, something that's needed. And a liability is something that's not needed. Okay, any business expenses that's just going to be extra. Okay, like giving all your employees a vacation or something like that, for example. Okay, and then that's going to equal shareholders' equity. Okay, so common versus preferred stock. Common stock. This is what most people mean by stock, and it comes with voting rights in corporate matters, but it's secondary to preferred stock in claims on a company's assets during liquidation. When you're a true owner, sharing in both the upsides and the risk. And let's talk about preferred stock. These shares typically do not come with voting rights, but have a higher claim on a company's assets and earnings than a common stock. And holders of preferred stock receive dividends before common shareholders, and this makes them a hybrid security. And it's often seen as less risky than common stock, but without the same growth potential. Okay. So, stock options, my favorite. Okay. One of my favorite things I like to trade, and it's pretty much when you get paid based off of the direction of a stock. Okay. If you think the stock is going to go up, then ideally you would purchase what's called a call contract, which we'll talk about here. Okay. And if you think the stock is going to go in a downwards direction, okay, then you would buy a puts contract. You can also have expiration dates on your contracts too, to choose how long you want to hold the trade for. And when the contract expires, it's going to automatically close on its own. So you either sell the contract before it expires, or it'll go ahead and just close on its own. Yeah. So stock option is a contract that gives the holders the right, but not the obligation to buy or sell an underlying stock at a predetermined price. Okay. And that's also going to be known as the strike price. So let's say a stock is at $32 a share currently. Okay. Let's say a stock is at $32 a share. You think it's going to go to $34 a share. Okay. Then you could buy a strike price contract of $34. Okay. Or even $33, since that's above $32. Okay. So you could buy any number above your prediction, but below your take profit. Okay. And that's going to be a good strike price in order to purchase, inshallah. Okay. So when you do that, you're going to go ahead and get paid based off of your prediction. Okay, say for a put example, let's say share price is going to be at 20, for example, right? And you think price is going to go down to 15. Okay, so if price goes down to 15, you could buy a 19, 18, 16, or $15 strike price contract. Okay, because you're going to get paid based off of your prediction. So just focus on what you're doing. All right. Just focus on what you're doing. You're going to get paid based off your prediction. Okay. And it's also going to be within a specified time frame that you purchase. Okay. And the higher the expiration date that you go, the more expensive that it's going to be. And it's a derivative instrument, meaning that its value is derived from the performance of the underlying asset. And they're a popular form of compensation for employees and a powerful tool for investors to leverage their positions. So a call option, it's the right to buy stock at the strike price. Okay. Which is going to be the pretty much price that you're wanting price to go to. And an investor would buy a call option if they believe the stock price is going to rise above the strike price and you're betting on the stock's upward movement. Let's talk about a put option. And it's the right to sell a stock at the strike price. And an investor would buy a put option if they believe the stock's price will fall below the strike price. And this is betting on the stock's downward movement, often used for hedging. Yeah. And also sometimes companies often grant stock options to employees as a form of non-cash compensation. Okay. So incentivizing them to work towards the company's increasing value, because as the company keeps innovating, putting smiles on people's faces, okay, creating more product, generating more revenue, then inshallah the share price is going to increase, making their options worth more. And most of the time, inshallah, they're going to be getting paid in like some long-term cost contracts, I assume. So risk, reward, or purpose. So while all these terms are related to company ownership, they serve different purposes. Okay, so stocks. Okay, stocks are going to be the name. Okay, stocks are going to equal the name. Okay, stocks are the name. So let's say I open Stackmode. Okay, let's say I open Stackmode on the market. Okay, if I put Stackmode network on the market, okay, inshallah will happen one day. If I put Stackmode network on the stock market, that's going to be the name. So if you just hear the term stocks, that's going to be talking about the name. Shares. The term shares is going to be talking about the percentage ownership that you're trying to purchase within the company. So you can own 1 share, okay, or you can own 50 shares. And the share price is going to be determined on the current price. So if the current price of a stock, okay, remember the stock is the name. So if the current price of Stackmode is $32 a share, for example, okay, and I think it's going to go to $600 a share, okay, or $700 a share, okay, then whatever the current price is going to determine what the share cost is. So if price is at $32 a share, 1 share will cost $32. If price is at $700 a share, 1 share will cost $700. Okay. So inshallah, try your best to get in at a dip or a low and then catch the sweep up. And that's how money is made. Okay. That's how growth equity is created, by trading shares. Okay. And stocks and equities. Okay. The primary goal of these are going to be long investment. Okay. There's going to be also a lot of tax benefits when you hold your trades for over a year. And the primary goal is going to be long-term investments when it comes to shares and equities as well too. And the reward comes from dividends as well too, which is going to be quarterly money that's going to be spread out to everyone who has a decent amount of shares. Okay. So you'll get paid by dividends and capital appreciation. And the risk is that the company's value could decline, leading to a loss of your initial investment. But no risk, no reward. We're only here one life. Okay. Just trust God, take a risk, keep going. Let's talk about some options. The primary purpose is speculation or compensation, and the reward can be much higher due to the leverage they provide, and it makes you control a large number of shares for a small upfront cost. And this risk is that if the stock price does not move in your direction that you purchase, then the stock price could tank on the contract. Okay, but it's going to be fine. If it expires worthless, you just try again. Don't lose hope. Trust God. Keep going. Okay, and you could potentially lose your entire investment, but you could also play into that. Okay, whatever your stock option cost is, you could use that as your stop loss. So if it costs you $70 to open a contract, that could be your stop loss. Okay, instead of buying a $500 contract trying to play with a $70 stop loss, that might not always work in stock options as cleanly as you might want. Let's explain leverage. And with the call option, you might only pay a few dollars for the right to control 100 shares with leverage and the time expiration. And if the stock price goes up by just $1, you've made a significant percentage gain on your small initial investment, far greater than you would have buying the shares outright. Okay, but it also has time expirations on it. Okay, so this is why the longer the time you're going to buy on a certain play, it's going to be the better. Okay, give your trade time to work out. Okay, but the longer that you go trying to buy out, the more expensive that the contract is going to be. Okay, so for practicality, for example, if an investor wants to build a retirement portfolio, okay, you could buy stocks. Okay, so you'd be buying shares of those stocks for long-term growth, for long-term tax benefits, and just holding trades year after year, keeping money in the stash, keeping stack mode, okay, implemented into your portfolio. Staying down, not touching the bread, okay, staying down. And if a trader is looking to profit from a short-term market movement, then stock options would be able to amplify your return. So you can use the stock options profit to buy some more shares, but stock options in general is just going to be better to go ahead and generate some more income. Okay, so it's going to be time to just start going harder, get more education, and really understand what we're doing before we put money into the market. All right. Market capitalization, valuation, how a company is priced in general. So understanding that a company's market cap, okay, also known as the market capitalization, is pretty much how much a company is worth. And the valuation is crucial for making informed investment decisions. Now, market cap's not going to be everything. You could do your research and catch a good trade at the low, and then the market cap turns huge later. Okay, but market cap is just going to be a good decision to see if something's going to be a strong value play. And market cap is going to be the total value of all the company's shares, and it's a key metric used to determine a company's size. So here's the market cap formula. The calculation is pretty simple, but does a lot, and it's quite advanced. So market cap, okay, the calculation concurs of, it's the current stock price, okay, so Stackmode is worth $700 a share, okay, then it's worth $700 a share. Okay, so you take the current stock price, $700 a share, times the number of total outstanding shares, so whatever that would be, and that's going to give you the market capitalization. Okay, so this tells you what the market currently values the entire company, and it changes every minute as the stock price fluctuates. People are always going to be putting in orders, selling and buying, and especially something that has a high market cap is always going to be more orders flowing in due to the fact that it's popular. So there's some different market cap categories. Companies are often categorized by the market cap, which influences their risk growth and their potential. Once again, it's not going to be everything, but something to look for. So a mega cap, it's going to be something worth over 200 billion in market cap. So for example, big giants at the time, like Apple, Microsoft, for example, they're generally seen as stable, mature companies. And let's talk about large caps. It's going to be 10 billion to 200 billion. Okay. And they're established leaders in their industries. You got mid caps, 2 billion to 10 billion. That's companies with solid growth prospects. And small caps, 300 million to 200 billion market cap. They could be a bit higher risk if they don't decide to grow and have some future innovation, but with the potential, they have a bunch of high expectations, certain companies, and they could explode super duper hard. Okay, like for example, Palantir and microcap and nanocap and below $300 million. And they're the riskiest category once again, because it's fresh, new startups, new ventures. Sometimes it could be people with a bunch of money investing into it and then it doesn't go anywhere. So make sure it has some future value. So let's talk about valuation versus price. So it's important to distinguish between a company's price and its market cap and its intrinsic valuation. Valuation is a more complex process that attempts to determine a company's true worth based on its assets, earnings, future cash flows, and growth prospects. And a savvy investor is going to be looking for stocks where the price is lower than the company's estimated intrinsic value in the first place. So we'll talk about valuation methods. There are many methods for valuation, including the discounted cash flow, the DCF model, and a company's price to earnings ratio. Comparing that to its others ratios of other companies is going to be a good way to determine if what company is making more money than others. Okay. And these are essential tools for a fundamental analyst if you want to be an investor. So let's say, for example, let's say company A has 10 million shares outstanding. Okay. Let's say Stackmode has 10 million shares outstanding. Okay. And its stock is trading at $50 a share. Okay. And its market cap is going to be $50. Okay. Because that would be the current price. Okay. You're going to be multiplying the current price times the number of outstanding shares. So let's say Stackmode has 10 million outstanding shares. You're going to multiply that by the amount of outstanding shares. So 10 million. So $50, the current share price times the number of outstanding shares, 10 million. And that's going to equal 500 million. Okay. And that's how the math is done. That's how you find out market cap. Let's say company B, for example, let's say it has 5 million shares outstanding and its stock is trading at $150 a share and its market cap is 750 million. And even though company B's stock price is higher, company A might have a higher intrinsic valuation based on future growth projections and its expectations. So the differences at a glance. So to summarize, it's essential to recognize the distinct roles of each of them. So shares and stocks. Stocks represent actual ownership in a company and they're tangible assets that can be fractional and traded on exchanges. Okay. Any stock exchange is going to be a broker where you can put in your bank account, your card, and buy some stock for yourself. Okay. That's what an exchange is, also known as a broker. So let's talk about equities. Equities are a broad term for the total ownership of a value of a company. It's an accounting term that includes all forms of ownership interest, and equities is the larger category, which includes stocks and stock options. They're a contract and a right to buy and sell shares, not the shares themselves. Okay, and you get paid based off of the direction that you think price is going to go into. And they're a tool for speculation or compensation and are not an ownership stake until they are exercised, until someone's to fill in the contract. So think of the company as a pie, okay, also known as the stock. A fraction of the pie, okay, is going to be known as a share. And let's say you're about to deliver pie. Let's say you project to sell 4 slices of pie. If you think that, you could buy an option based off of that. Okay. So put all of that into retrospective and understand. Okay. So if you think you're about to sell 4 slices of pie, then you buy an options. Okay. But the pie in and itself is going to be the shares. Okay. And the store name, let's say it's Stackmode Pies, is the stock. Okay. So that's how it all works. So by understanding these core concepts, you're just not a spectator anymore. You're getting informed, understanding the market, not a gambler, and you're becoming an active participant with the knowledge to navigate the complex world of finance. Alhamdulillah. So while the terms may seem confusing initially, their distinct definitions and functions are critical to building a robust financial vocabulary. And remember, stocks and shares equal ownership. Okay, they equal ownership. You can hold them for however long that you want. So use that money. Don't go buy clothes, stay down. Don't go buy drip. Don't go buy the best whip right now, paying the high monthly payments. Stay down, invest, and go ball out later. Let your money make infinite money and then go buy what you want. And equities are going to be a broad ownership value. And stock options are going to be the directional bias that you can get paid based off of. You can use all of these to create future value, provide for your family, and provide for yourself. Stay prayed to God. Head over to stackmode.net for all trading education and business education. Love you so much. I'll catch you in the next one. Guys, let's talk about crypto arbitrage trading. The risk-free profit in digital markets. Welcome to the lecture. Welcome to Stackmode. And let's jump into it. So the essence of arbitrage. Arbitrage is fundamentally the simultaneously buying and selling an asset in different markets to profit a temporary difference in price. It's the closest thing to a risk-free profit and opportunity in finance. And in the cryptocurrency space, this occurs because the global market is highly fragmented, with hundreds of independent exchanges that are not perfectly synchronized their prices in real time. This creates transient imbalances within the cryptocurrency community. So arbitrage is not about predicting the future prices, right? That's going to be speculation. It's about capitalizing on the current now price discrepancies for the same asset at the exact same time. So why do discrepancies exist in cryptocurrency in the first place? So latency and speed. Network delays mean that a price change on one major exchange may take a few milliseconds to reflect on a smaller, slower exchange. And this tiny window is the opportunity that people use in order to capitalize on some profits. So let's talk about some regulatory and geographic factors. Differences in regulatory frameworks or capital controls in various countries can cause persistent price differences. The community premium is a classic example. And liquidity differences. Exchanges with low trading volume might have larger bid-ask spreads, leading to minor price offsets compared to high volume exchanges. And we'll talk about transfer fees and withdrawal delays. The cost and time associated with moving capital between exchanges also contribute to price gaps that need to be larger to be profitable. So the foundation. Let's talk about simple exchange arbitrage. So the two exchange model. And this is the most straightforward form, involving just two exchanges and one asset. For example, Bitcoin, also known as BTC, BTC USD. The goal is to exploit a direct price difference. So step one, right? So this is how you do it. For example, you would buy low and simultaneously place a market order to buy one Bitcoin on exchange A, where the price would be $50,000, for example. And then step two, you would sell at high. At the exact same moment, you would place a market order to sell one Bitcoin on exchange B, where the price is $50,050. And result, a gross profit of $50, okay, and less trading fees and withdrawal costs. Okay, so capital allocation challenge. For this strategy to work instantaneously, an arbitrage must have the capital prepositions on both exchanges. This is known as the capital risk or funding issue. So the required capital setup. You must have the fiat currency, for example, USD, okay, dollars, stable coins, etc., ready on exchange A to buy, and the asset, for example, let's say you're buying Bitcoin, ready on exchange B to sell. If you have to transfer the asset after buying, the price gap will likely close and the opportunity will most likely vanish. And due to razor thin margins, the speed required, this strategy is almost exclusively executed by automated trading bots that operate in milliseconds. So the advanced strategy, right? Triangular arbitrage. So 3-act cycle. Triangular arbitrage occurs on a single exchange and exploits inconsistent pricing between 3 different currency pairs, creating a closed loop trade with a net profit. The core idea is that the implicit exchange rate calculated from 2 pairs does not match the exchange rate